Hello champions, I hope you are doing really well. So I had uploaded an exam-oriented marathon for CA Inter DT just a few days back wherein I had discussed all the new and the difficult questions from the recent RTPs, MTPs and the September 25 question paper. And I did not know then that that video would be of that much use for you all. So now with the same objective, I have created a similar video for you all for law as well. Even this is going to be an exam oriented marathon, and just like the DT marathon as well, this marathon also is not going to be a concept marathon. Concept marathon for law I have already uploaded. You can watch that. Now I'll tell you what is the whole objective. Why exactly have I made this second marathon for law? There are three reasons. Reason number one, there are some very unique and different questions in your recent RTP, MTP and the September 25 question paper. When I say recent RTP, I'm talking about your Jan 26 RTP. When I talk about mock test papers, I'm talking about 4 mock test papers over here. Your September 25 mock test paper 1, September 25 mock test paper 2, Jan 26 mock test paper 1 and Jan 26 mock test paper 2. Okay. And your September 25 question paper. So 1, 2, 3, 4, 5, 6. These 6 resources are what I'm focusing on in this video. In these 6 resources, guys, I found a lot of difficult questions, new questions, questions which we have not seen in the past. Alright. And I wanted to discuss these questions with you because know that no matter how much conceptual knowledge we have, we do need some amount of practice, some level of practice we need in applying those concepts in law. Students think that I will do questions only in theory, only in practical papers and not in theory papers, because theory papers I anyways have to go and write answers. Yes, no doubt in theory papers you should be having some really sound and sharp conceptual knowledge, but at least to some extent some application you should be doing before your examination, so that in the examination you know exactly how to think. And with that objective, I picked all these new and difficult questions for you so that your time gets saved. You're not doing all the unnecessary simple questions and questions which you've already seen. I've eliminated that. I've picked only the new and the difficult questions, and those questions I've discussed with you in this video. Okay, so once you're done with this video with me, you do not even have to look at these 6 resources, guys. Nothing is left for you to do on your own from these 6 resources. And one more thing that I did is in this video, what I did is, there are some, especially in your Companies Act, when they give you case-based MCQs, the MCQ may touch upon various chapters. Have you noticed that? The same MCQ may have one adjustment from your holding subsidiary company, another adjustment from your, let's say, Prospectus chapter, another adjustment from accounts of companies chapter. So like this, the case-based MCQs which are touching upon various chapters, I have done that as well for you to give you some amount of practice with MCQs before your examination. Okay. And one more thing I've done for you in this video is I have done the entire discussion chapter wise. Alright. That way what will happen is I'll tell you how exactly you will make the use of this video. I'll tell you why exactly I have made this video chapter wise. What you will do is you will first take a particular chapter. Like for example, let's say accounts of companies. Okay. Now this chapter you will finish your concept revision. Whatever you have decided that you will be doing for this particular chapter to revise before your examination, you will finish the entire revision, the concept revision, whatever you've marked and kept, everything you will finish. Then you will come to this video. So once you're done with the concepts learning of this chapter, you will come to this video and you will finish the questions of this particular chapter. Then you will go to the next chapter. Let's say you go to the dividends chapter. Same way you will finish the concept revision first, and then you will come to this video and you will watch the questions of the dividends chapter. So this is the reason why I made this video purposely chapter wise, so that I can give you proper timestamps that which chapter is done from what time to what time. So that way once you're done with a particular chapter, you come to this video and you watch the questions of that particular chapter, and with that you can very confidently close that chapter and you can tell yourself that you're exam ready now. Okay, and the questions handout, total 55 questions are there, guys. This questions handout with these 55 questions and my classroom notes, both I will upload in the Telegram channel itself. You can take from there. Alright, so ensure you share this video with your friend. Help me reach out to the maximum number of students possible, because I know for a fact that this video is really going to add a lot of value to your preparation and make you real exam ready. Trust me when I say this, it's going to make a big difference to your preparation. Alright, that's it guys. Now the main part of the video begins. So starting off with the first question, I'm starting with something very simple. We're going to start off with our entrenchment provisions discussion from your MoA AoA chapter. Let me give you a quick reminder of the concept first. See, listen to me. Whenever the company wants to alter the AoA, yes, alteration is possible. For that, you have to pass a special resolution. That is 75% majority is what you need. But however, if the company inserts an entrenchment provision in the AoA, then I'm not saying it cannot be altered. You can still alter it, just that it becomes more restrictive, it becomes more difficult to alter. Understanding? So because of entrenchment provision, we require something more than a special resolution. We require something more than 75% majority. So first of all, don't have the misconception that if there is entrenchment provision, I cannot alter the AoA. No. I can still alter the AoA, just that it becomes a little more difficult. It becomes a little more restrictive to alter the AoA. Okay. Now see this entrenchment provision, two options we have. Okay. When, at what time? Basically the two options are with respect to the timing. That at what time will this entrenchment provision be inserted into the AoA? There are two options. Option number one, when the company is getting incorporated, that time the AoA is getting prepared, guys. So in that original AoA itself, the entrenchment provision can be inserted. But one more option we have, and that is later, the company can alter the AoA. Understanding, later the company can alter the AoA and can insert the entrenchment provision. But in the second option, there are more formalities. Like for example, if it's a private company, then you need unanimous resolution. That means you need the consent of all the members. And if it's a public company, then you need special resolution. Only then you can amend the AoA and insert the entrenchment provision. Now this entire question, guys, is based on this extra point only, this extra formality only. The question says entrenchment enhances the protection. ABC Limited, an existing private company willing to insert the provisions for entrenchment, it can amend the AoA by passing ordinary resolution? No. For a private company, if you want to amend the AoA and insert the entrenchment provision, you require a unanimous resolution. Ordinary resolution will not be enough. Then you can amend the articles by passing a special resolution? No. Had it been a public company, then special resolution would be enough. But my company is a private company. It can amend the article if it is agreed by all the members. This is correct, guys. Option C. We require a unanimous resolution, which means we require the consent of all the members. So unanimous resolution, nothing but 100% consent we want. That is, it has to be agreed by all the members. So option C. Okay, so this was it with our question number 1. Now moving on to our prospectus chapter, we have a very interesting question over here from a September 25 question paper. Before we discuss the question, let me give you a quick revision of the concepts involved first. So in this question, guys, there are two sections which they're targeting. One is section 25 and the other is section 28, and both are very interesting sections. Listen to me, you will enjoy them. So in my first section, section 25, what's happening is the company is allotting securities to an issue house, let's say some intermediary or let's say some merchant banker, with a view that those securities will then be offered for sale to the public. So there are how many transactions now? There are totally 2 transactions, guys. Transaction number 1, company is allotting securities to the issue house, and transaction number 1, the issue house will then later offer the same securities for sale to the public. There are 2 transactions. Okay, now let's talk about the first transaction first. When the company is allotting the securities to the issue house, the allotment is made with a view that those securities will be offered for sale to the public, which means both the transactions are interconnected. Why is the company making the offer to the issue house? Why? What is the reason? What is the objective? The objective is that later the issue house will offer the same securities to the public. So the whole reason why the first transaction happens is because the second transaction will happen later. So with the objective of offering the securities to the public later, with that objective, the company is offering the securities to the issue house first. Okay. Now see, don't lose track. We are still talking about a first transaction only. Okay. Where the company is allotting securities to the issue house with a view that those securities will then be offered for sale to the public. Now a question arises that in which situation can you say that this allotment happened with a view that the securities will be offered to the public later? When can you say that the first transaction has happened with this view? For that, we have 2 conditions, guys. Out of the 2 conditions, if any one condition, either of the 2 conditions, which means if any one of the 2 conditions is fulfilled, then in that case we can say that yes, the offer has happened with a view that the same securities will be offered for sale to the public later. What are the 2 conditions? Condition number 1, see, we will check when did the company allot the securities to the issue house. From that day, within 6 months itself, the second transaction should happen. So securities are offered to the public within 6 months after the date of allotment. First condition. The second condition is that when the issue house is making the offer to the public, at that time, on that date, the company has not received the full consideration. Basically, when the company would have allotted the securities to the issue house, the first transaction, the issue house should have given some consideration to the company, right, in return for the shares. But however, on the date on which the issue house is making the offer to the public, as on that date, if you see, the company has not received the full consideration. The company is yet to receive the full consideration. So out of these two conditions, any one condition has to be fulfilled. Either of these two conditions have to be fulfilled. Only then you can conclude that this whole allotment, this whole first transaction has happened with a view that the issue house will then later offer the securities to the public. Okay, so this with the view that those securities are offered for sale to the public becomes your key term. This conclusion you will make only if any of these two conditions are fulfilled. Okay, so this was my entire discussion about the first transaction. Now let's talk about the second transaction, wherein once the issue house is getting the securities, the issue house is then offering the same securities for sale to the public. Now when this happens, don't you think they will make a document, guys? To offer the securities to the public, they will make a document. Now that document will be deemed to be a prospectus, which means it will be assumed to be a prospectus. But in that document, there has to be signature. Now whose signature? See, whose signature will depend upon this issue house's intermediary. Is it a company or is it a firm? If the issue house, if the intermediary happens to be a company, then in that case it has to be signed by at least two directors of that company. If that intermediary, if that issue house happens to be a firm, then it has to be signed by at least half of the partners of the firm. Okay, so this was our entire discussion that is relevant under section 25 for this question. So there are totally two transactions, guys. Company has allotted securities to the issue house with a view that the issue house will later offer the same securities for sale to the public. So two transactions. Transaction number one, company is allotting to the issue house, and transaction number two, later the issue house will offer the same securities to the public. Then after this, the second point that we learned was, when can you say that the company has offered to the issue house with a view that the same securities will be offered to the public? When can you conclude that this was your objective? You will conclude that the company's objective was this yellow part only if any of these two conditions are fulfilled. That is, either the securities should be offered to the public within 6 months after the date of allotment, or the full consideration company should not have received as on the date on which the securities are being offered to the public. And finally, we learned that when the issue house is offering the same securities to the public, that is the second transaction, in that case also they will prepare a document. The document will be deemed to be prospectus, but the document has to be signed by whom? It depends upon, is the issue house a company or is it a firm? If it's a company, it has to be signed by two directors. If it's a firm, it has to be signed by at least half of the partners. Okay, now keep this point in your mind and come to the question. There is section 28 also involved in the question, but section 28 I'll come to it a little later. Let's talk about section 25, this part first. The question says, Sridhar Bookmarks Limited, a public limited company engaged in publication of books related to labor and industrial laws, is planning to raise 10 crore from the public to fund its upcoming project. Okay, so the company wants to raise 10 crore from the public. Sridhar Bookmarks Limited has assigned two different merchant bankers, namely ZFG and Associates and Bull Investments Limited, to act as intermediaries for 60% of the above fund, and the rest to be directly issued to Mr. Kuber, an investment banker who intends to offer the shares for sale to the public through inviting bids above the floor price. So the main point is that the company wants to raise 10 crores from the public, guys. Now this 10 crore, the company is making two plans. The first plan is that the company will offer 60%, basically out of 10 crore, 6 crore the company will give to intermediaries, ZFG and Associates and Bull Investments Limited. This point, intermediaries, itself indicates to us that this 60% is going to be section 25, wherein the issue house, the intermediary over here, are two merchant bankers, ZFG and Associates and Bull Investments Limited. And what about the balance 4 crore? The balance 4 crore will be directly issued to Mr. Kuber, who will then make an offer for sale to the public. So this section, this green part, this Mr. Kuber part, this is going to be section 28, guys, which I have not discussed with you till now. Right now we're talking about section 25. Okay, now who are the intermediaries in our example? Who is this issue house in our question? Two issue houses we have. One is ZFG and Associates and the other is Bull Investments Limited. Okay, Then the question says ZFG and Associates is a partnership firm and they were allotted equity shares worth 4 crores on 1st April 24 to be sold by them to the retail investors. See, I've made the diagrams for you. Shrita Bookmarks Limited wants to raise 10 crore rupees from the public, guys. For the first 6 crore, that is for 60%, the company has chosen two intermediaries, that is two merchant bankers. One is ZFG and Associates, which is a partnership firm, and the other is Bull Investments Limited, which is a company. Then the question says to ZFG and Associates, company has allotted equity shares worth 4 crores, and this allotment happened on 1st April 24. So to ZFG and Associates, company has allotted securities on 1st April 24. Okay. Then Bull Investments Limited is a company by incorporation. They were allotted equity shares of 2 crores. So the company wants to do through the intermediaries for 6 crore, right? So to ZFG and Associates, they have given shares which are worth 4 crores, and to Bull Investments Company worth 2 crores. That's how total 6 crores. Okay. Then the question says, offer documents were issued by ZFG and Associates and Bull Investments Limited on 10th October and 25th September respectively. So I've mentioned that as well over here. ZFG and Associates has given the offer document on 10th October 24 and Bull Investments Limited has made the offer document on 25th September 24. Then the offer document in case of Bull Investments Limited was signed by only one director of the company. So Bull Investments Limited, the offer document was signed by only one director. This itself is definitely going to be incorrect, guys. This point itself will make this offer document invalid, because remember we had learned that if this issue house, if this intermediary happens to be a company, then it has to be signed by at least two directors. But here it is signed by only one director, so I don't even have to check anything else. I will straight away say that this offer which Bull Investments Limited has made on 25th September 24 will be invalid. Section 25 will not apply over here. It will become invalid. It will become defective. Then what happened after this? Both the intermediaries have paid off the full consideration to Shrita Bookmarks Limited till the date of offer to the public. So even ZFG and Associates has paid the full consideration to the company. Even Bull Investments Limited has paid full consideration to the company. So because the company has received the full consideration, do you agree with me? The second condition is not fulfilled over here, guys. Second condition says full consideration is not received by the company, but your company has received full consideration from both the intermediaries. So therefore the second condition is not fulfilled. Therefore can I say that the first condition is only going to be my subject matter of discussion over here. Okay, now see, the second transaction, that is Bull Investments Limited, I don't even have to check any 6 months condition. I don't have to check anything else, because this is straight away going to be invalid, because it was signed by only one director. It should have been signed by two directors. But however, the ZFG and Associates, if you see, here they're not talking about the signing point. So which means I'll check my conditions, guys. Out of the two conditions, any one condition has to be fulfilled. Only then you can say that the company had allotted securities to ZFG and Associates with a view that the same securities will later be offered to the sale to the public. Now, so which means my first condition has to be fulfilled. First condition says that ZFG and Associates should have made the offer to the public within 6 months from the date of allotment. The date of allotment here is 1st April 24. 6 months will be 30th September 2024. But see, ZFG and Associates made the offer to the public only on 10th October 2024, guys, which is after 6 months. So therefore, even this will become invalid in law, guys. Even this is not fulfilling your section 25 conditions. So now my conclusion is that both the intermediaries are not fulfilling my section 25 conditions, guys. My first intermediary, the partnership firm, the reason why it is invalid is because the allotment is happening to the public. The offer is being made to the public only after 6 months from the date of allotment. And the second intermediary, the company, here the section 25 is not getting fulfilled because the document is not being signed by two directors. So therefore, at the end of the day, both the intermediaries, section 25 conditions are not being fulfilled. Okay, then what happened after this? Mr. Kuber, to whom the balance 40% of the shares were issued, he then further offered to the public the shares through an offer document. The board of directors of Shrita Bookmarks Limited have opposed such offer document, claiming that the same does not contain the name of the person or persons or entity bearing the cost of making such offer of sale. So this green part is entirely relating to section 28, which I have not discussed with you till now. Now they're asking us two things: whether the offer for sale made by the intermediaries ZFG and Associates and Bull Investments is valid in law. No, both are invalid for different reasons, but both are invalid. And then secondly, what is the whether the objection made by the board about the defect in the offer document issued by Mr. Kuber, will it sustain or not? Let's now talk about this Mr. Kuber part, the section 28 part. See, in section 28, what happens is the company has already allotted securities to the members, okay, and those members then later want to offload their securities to the public, but not directly to the public, but instead through the company. So the company, so that even over here there are two transactions. Transaction number one, company has allotted securities to a person, so that person has become a member of the company. Now he's an existing member of the company because he's holding shares of the company. Now this existing member wants to later offload the shares, which means he wants to offer the same shares to the public, but he does not want to directly go to the public. Through the company, he wants to come to the public. Classic example, LIC, guys. Same thing happened even in ICA. Company had, for example, company over here is LIC, let us say. LIC had allotted securities to the government. So the government of India became the member of LIC. Now the government wanted to offload the shares. Government wanted to make money for itself. So the government had then later made a sale to the public, but it was through the LIC, it was through the company. So this is what happens in section 28. Now in section 20, there's a condition. Even over here, see, at the end of the day, we are reaching out to the public, guys. Because we're coming to the public, even over here, we'll have to make a document. That is, a prospectus has to be made. Now in the prospectus, we have to mention the name of this member, guys. We have to put the name of this person who, because see, don't you think at the end of the day, it is this person who will end up making money through this entire transaction? See, listen, is a company directly offering to the public? No, guys. Company has already, like LIC has already allotted shares to the government. Company has already received money from the government. Now government wants to make the money. So government will then sell the shares to the public through the company. So whatever money is raised from the public, that money will not go to LIC. That money will not go to the company. The money will go to the member only. So now, of course, for this entire transaction, whatever expenses are incurred. See, when you're going to the public, of course, there will be a lot of issue expenses and all. So whatever expenses are being incurred to go to the public, all those expenses have to be reimbursed. They have to be met by these existing members only. Okay. So in the team prospectus, we have to mention the name of this person, the name of this existing member who is going to bear the expenses. We have to put his name. But in the question, if you notice over here, the board of directors have opposed the offer document, claiming that the same does not contain the name of the persons bearing the cost of making the offer. This is wrong. In the offer document, we have to mention the name of this existing member, guys, whose shares are being offloaded to the public. Because we have to see, because see, at the end of the day, he is the person who's actually raising the money through this entire transaction. At the end of the day, whatever expenses are incurred for this issue, those expenses will be reimbursed. Those expenses will be borne by this existing member only. So his name has to be mentioned in the prospectus. But here the question says the document does not contain the name of the person who's going to bear the cost. So therefore, now answer my question, whether the objection made by the board of directors about the defect in the offer document, will it sustain? Yes, guys, the objection of the board of directors will sustain. It is valid. The offer document will be definitely invalid over here, because the offer document should contain the name of the member who is going to ultimately bear the cost. So therefore, the board of directors are objecting the offer document. The objection of the board of directors is perfectly valid. Alright, so this was it about your second question, covering two sections on the prospectus chapter, section 25 and section 28. Now come to the third question. We have some more questions on the prospectus chapter. Now this one is relating to private placement, guys. So let's discuss the concept first. See, in private placement, the company is not making an offer to the general public, right, guys? Here, instead, the company is making the offer to a selected group of persons, to an identified group of persons. Now the question arises that the company can make an offer to how many such persons? The law says the company can make the offer to 50 persons in a financial year, or such other number as may be prescribed. And in the rules, the 200 number is prescribed. So we all know for a fact that the effective limit now at the end of the day is 200 persons, guys, right? So the effective limit is that the company can make a private placement offer to how many persons? To 200 persons. Now if you see in the examinations also, in the RTPs, in the MTPs also, this 200 persons number is nicely tested. And it's a very simple point also. I'll quickly explain it to you. Listen to me carefully. Point number 1. will this 200% limit apply forever, or is it a per annum limit? It's a per annum limit, guys. It's per financial year limit. So every financial year this limit will get reset. So it's 200% per financial year in a financial year. Okay. Point number 2, when you're counting this 200% limit, 2% you will not consider. You will not consider qualified institutional buyers, and you will not count the employees being offered securities under ESOPs. So when you see the company has made private placement to how many people, when you're checking whether the company has crossed 200 or is it within 200, you will not include these 2% qualified institutional buyers and employees who are being offered securities under ESOPs. Okay. Then comes the third point. This 200 limit itself is not applicable to two companies. It is not applicable to NBFCs and to housing finance companies. For these companies, the 200% limit itself is not applicable. Then comes a very important point, the point which is tested in this question as well. Will this 200% limit apply to all the securities put together, or is it per security? It is per security, guys. Per security means in a year, the company can make the private placement offer to 200% for just equity shares, to another 200% for just preference shares, to another 200% for just debentures. Understanding? So the 200 limit is per financial year, per security. It is per security. Okay. Then another question arises, guys, that what will happen if the company exceeds the limit? What will happen if the company is making the private placement to, let's say, more than 200%? Then in that case, it will become a deemed public offer. It will be deemed to be a public offer. Actually, it is private placement, but if you make the private placement offer to more than 200%, it will become a deemed public offer. And if it becomes a deemed public offer, gone, guys. The whole SEBI regulations, SCRA regulations, all that also will start applying. Okay. That's all what the question is. That's all what the concept is that is relevant in this question. Now come on, have a look at the question. The question says Devarshi Limited. So definitely this company is a public company, guys. It has made a private placement. Tell me, can even a public company make a private placement? Yes, no problem. Any company can make a private placement. So it made a private placement in 23-24 by offering as follows. Equity shares, it made the offer to 210%, out of which 20% were offered shares under ESOPs. So I will exclude this, guys. So even though we offered the shares to 210%, we will ignore this 20, right? When we are counting this 200% limit, we will not consider qualified institutional buyers and ESOPs. So from this 210, if I ignore these employees to whom ESOPs are being offered, then in that case, we have made the private placement offer to 190% only, which is within the limit, guys. Per security, we can make the offer per year to 200%. Here we have made equity shares private placement offer to 190% only, within the limit. Then debentures, another 50. Now tell me, for debentures separate limit, equity share separate limit, or both aggregate 200 limit? No, it is separate limit. So for debentures, a company can make an offer to another 200%. Company has made the offer only to 50%. Now these debentures were secured, so which means they are secured debentures, charge and all was created, doesn't matter. As per the provisions of the Companies Act, determine the maximum number of persons to whom Devarshi Limited could have offered its securities under private placement. So how many more persons company can make the private placement offer for? Now look at this table, guys. See, for equity shares alone, the company can make a private placement offer to 200%. To debentures alone, the company can make the private placement offer for 200%. So basically the limit of 200 is per security. Point number 2. Company has already offered the private placement shares to how many persons? For equity shares, actually 210, but this includes employees to whom shares are being offered under a scheme of ESOPs, 20%. So this 20 I will exclude. So out of 210, I will consider as if only 190, only to 190% company has offered securities under private placement. Okay, so how many more can the company offer, guys? Company can offer to 10 more persons for equity shares private placement offer. Similarly, for debentures, company has a fresh 200 limit. Company has made an offer only to 50%. So company can now make an offer to how many more persons, to maximum how many more persons, to 150 more persons. Getting it? That's all, guys. So the company has already made an offer to 190% for equity shares. Company can make a private placement offer within the same financial year itself for equity shares to 10 more persons maximum. Similarly, for debentures, company has already made an offer to 50% for debentures. In the same financial year, for debentures, company can make an offer to 150 more persons. So what does this question test you upon? It tests you on two things. Thing number 1, the 200% limit is per financial year per security, not for all securities put together. Thing number 2 that it teaches you is that whenever you're counting the 200% limit, you will not count qualified institutional buyers. You will also not count employees to whom shares are being offered under a scheme of ESOPs. Okay, this was simple section 42 question. Then comes another question, guys. This is from your mock test paper. The question says, this question is about shelf prospectus. Okay, see, let's discuss the concept. I've brought it for you over here. Very simple discussion, guys. Now we know what exactly is a shelf prospectus, right, guys? Here we issue a prospectus which has a validity period of 1 year. Now in this 1 year, the company can make any number of further issues. Again and again, a prospectus is not required. Instead, every time the company makes a subsequent issue during that 1 year period, company just has to prepare one document called as information memorandum. So that shelf prospectus plus information memorandum put together become the deemed prospectus for all the subsequent issues. This is a concept. Now see, in the information memorandum, what will the company write? What are the contents of the information memorandum? Like for example, let us say in the month of January, the company issued a shelf prospectus. Now this shelf prospectus will be valid for 1 whole year, guys. Now in the month of March, when the company makes a further issue, the company does not have to prepare prospectus all over again. No need. The same shelf prospectus itself will be valid, but company will have to prepare one information memorandum. This information memorandum will contain all the changes that have happened since January. So the information memorandum will contain 3 important things. Number 1, details of all the new charges which have been created. Basically, since the time the shelf prospectus was issued, from then till now, any new charges have they been created. Then any significant change in the financial position of the company since January. Then we'll see when was the last prospectus issued. Since the prospectus till now, is there any major change in the financial position of the company? Any other significant prescribed changes? Okay, now come to the question. Wave Power Limited plans to raise funds through multiple tranches of securities. This word tranche itself indicates to us, see, we see this word tranche in 2 places, okay. One is shelf prospectus, what we're discussing right now. Another place we see tranche is a deposits chapter, guys, that convertible note point, okay. So as soon as I see the word tranche in my CA Inter company law paper, these are the 2 concepts that will immediately come to my mind. Anyways, continue reading. Here they themselves are saying that the company is going to use a shelf prospectus. After completing the first offer, company is preparing for the second offer under the same prospectus. Allowed, guys? Yes, it is allowed. Now the second offer will also be under the same prospectus. So a new prospectus altogether is not required, but however, company will have to prepare information memorandum. So before proceeding, Wave Power Limited needs to know what information must be filed with the ROC along with the information memorandum. You as a chartered accountant are required to list the details that the company is required to include in the information memorandum. So what are the things? 3 things have to be put into the information memorandum. Number 1, details of the new charges which are created. Detail number 2, any change in the financial position of the company since the last offer was made, and any other changes as may be prescribed. That's all, guys. So this information memorandum has to be filed with the ROC. That shelf prospectus plus this information memorandum put together will be the prospectus for this second offer. Okay, so contents of information memorandum, don't forget. Details of new charges created, any change in the financial position of the company, and any other prescribed changes. Easy only. So these were 3 questions from your prospectus chapter, guys. So first we spoke about memorandum of MoA and AoA discussion. We discussed about the entrenchment provision concept. Then in the prospectus chapter, 3 concepts, 3 questions we have seen. One was section 25 and section 28 put together. Another was a small adjustment from private placement, and then we had a question from shelf prospectus. Now come on, let's move on to our share capital chapter. This very first question over here that you're seeing is relating to section 67 about financial assistance. Company giving financial assistance for purchase of its own shares. An extremely important section. We'll first discuss the concept and then we will take up the question. See, look at the concept, guys. Very simple concept. No tension. Listen to me. Under section 67, it is very clearly written that if the company happens to be a public company, then this public company cannot give financial assistance to any person to purchase its own shares, either its own shares or to purchase the shares of a holding company. In simple words, if I am a public company, I cannot give a loan to any person to use that loan to buy my own shares or to buy the shares of my holding company. Not allowed. Public company cannot give such kind of a loan. But however, guys, there are 3 exceptional cases where a public company can give financial assistance to purchase its own shares or to purchase the shares of its holding company. 3 exceptions, very easy. The first exception, the company happens to be a banking company. So if it's a banking company, it can give a loan in the ordinary course of business. It's a bank, so its day-to-day business is to give loans. Now, even if the borrower uses that loan to buy the same bank's shares or to buy the bank's holding company's shares, it's okay, not a problem. Bank has given loan in ordinary course of business. Now there are no restrictions. Then comes the second exception. Second and third exception, listen carefully because the whole question is relating to the second and third exception only. Now, in the second exception, the company is giving financial assistance. The financial assistance is given to whom? It is given to a trustee. So the company is giving a loan to the trustee and telling the trustee that, hey, listen, use this loan to buy shares, either the company's own shares or the holding company's shares. But these shares will be for whom? For whose benefit? For the benefit of the employees under the employee share scheme. Understanding? Company is giving financial assistance to a trustee and is telling the trustee, use this financial assistance, use this loan to buy the shares of the company or the holding company's shares. But these shares will be for whose benefit, guys? See, I have a trustee. So because I have a trustee, that has to be a beneficiary, right? So who's going to be the beneficiary of these shares? The employees. Alright. Now, there are some conditions relating to the second exception. Like, for example, condition number 1. For this exception, a prior special resolution is required. This is one condition. Another condition is that these shares have to be fully paid up shares only. Another condition is a limit, that how much money can be used, how much financial assistance can the company give to the trustees under the second exception. The limit is 5% of paid up share capital plus free reserves. So this is the maximum financial assistance that the company can give to the trustees under the second exception. Okay, so this was a second exception. Now comes the third exception. In the second exception, the company was not giving the loan to the employees. No, company was giving loan to a trustee and telling the trustee, use this loan to buy my shares or the holding company's shares for the benefit of the employees. But in the third exception, the company is directly giving a loan to its employees. To whose employees? To the company's own employees. Okay, so in the first exception, banking company is giving a loan in the ordinary course of business. In the second exception, the company is giving financial assistance to trustee to buy securities for the benefit of the employees. In the third exception, the company is directly giving the financial assistance to the company's employees. Now, even over here, there are some conditions. Like condition number 1, the employee should not be director or KMP of the company. Then condition number 2, whose shares are we buying? Either the company's shares or the holding company's shares, but however, even over here, they should be fully paid up shares. One more condition we have over here, and that is the maximum loan that can be given in the third exception is up to the 6-month salary of the employee. Alright, so there is a maximum limit on the loan in the second exception also, in the third exception also. You understood the whole thing more or less, right? I'll give you a quick revision once again. Will you listen to me? Yes, guys. So general, what's my general rule? My general rule is that there's a prohibition. Basically, my general rule is that a public company, you cannot give financial assistance to anybody to purchase your own shares or to purchase a holding company's shares. But however, there are how many exceptions? There are 3 exceptions. In the first exception, the company happens to be a banking company and it is giving a loan in the ordinary course of business. Okay, then in that case, even if that loan is being used by the borrower to buy shares of the banking company or to buy shares of the holding company, it is fine, not a problem. Then comes the second point. In the second point, the company is giving a loan to a trustee. The loan is given to the trustee to buy shares of the company or to buy shares of the holding company, but the trustee will buy the shares for whom? Who's a beneficiary? The beneficiary is the employees of the company. Okay, now here there are some conditions. Like condition number 1, we require a prior special resolution over here. Then condition number 2, the shares have to be fully paid up shares. And condition number 3, there's a limit. How much financial assistance can be given? The limit is it should be within 5% of the paid up share capital plus free reserves of the company. And then come the third exception, the last exception, wherein the company is giving loan to the employees directly. But whose employees? Employees of the company. And this loan can, even over you have conditions. Condition number 1, they have to be fully paid up shares. Basically, the employee of the company will use this loan to buy shares of the company or to buy shares of the holding company, right? Those shares have to be fully paid up shares. And condition number 2, what's the maximum limit? How much maximum financial assistance can be given over here? The maximum financial assistance is 6 months. 6 months salary or wages of the employees. And one more condition we have over here, and that is the employee to whom the loan is being given, that employee should neither be a director of the company nor should he be a KMP, a key managerial personnel of the company. Okay, so this was your discussion of section 67. Now come to the question, guys. With this much knowledge, very easily you will be able to handle the question. The question says Forward Troopers Limited is a public company engaged in the manufacture of wearable protective gear and accessories, including helmets and shields, for supply to the armed forces in the country. It is a subsidiary of Security Troopers Limited. So Security Troopers Limited becomes a holding company, and my company Forward Troopers Limited becomes a subsidiary company. Okay. Now the financial position of the Forward Troopers Limited is given to you. Paid up equity share capital, reserves in surplus, loan from a bank, and sundry creditors. The Board of Directors of Forward Troopers Limited have planned upon the following schemes of financial assistance to facilitate the purchase of its shares by employees. See, generally, it's a public company. Public company cannot give financial assistance for purchase of its shares. But 3 exceptions we do have. Keeping that in mind, let's read the question. The first point, to create an institution in the form of a trust which would be responsible for the purchase of shares of Forward Troopers Limited with the help of a loan of 110 crores by the company itself. The trustee therein would purchase the shares worth the above mentioned account on behalf of employees in accordance with the employee share scheme. So guys, my first proposal over here is nothing but this second exception. Right, company is giving financial assistance to a trust. The trust is going to use the loan to buy shares of the company. Now see how much there are 3 conditions in this particular exception, but condition number 1, they have to be fully paid up shares. Question doesn't say are they fully paid up shares or partly paid up shares. Let's assume that condition is being fulfilled. Then a prior special resolution has to be passed. Question doesn't say whether SR is passed or not. Let me assume SR is passed. But condition number 3, I have a limit. Maximum how much financial assistance can be given? 5% of paid up share capital plus free reserves. Let's do that calculation now. Paid up share capital plus free reserves, 5% of this. That's going to be how much, guys? 1145. Plus 1012 is 2157. This into 5% will be the maximum financial assistance that can be given in the second exception, which is 107.85 crores. But company, you have given 110 crore loan, which is more than the limit. Hence, tell me, is this proposal valid? This proposal will be invalid. Company, you can give a financial assistance to a trustee to buy shares for the benefit of employees, you can give, but as a maximum limit. You are giving a loan more than the maximum limit, hence the proposal will be invalid. Then comes a second proposal to provide a loan directly to employees, which means I'm talking about the third exception now. Maximum 5 month salary to enable them to buy fully paid shares in Security Troopers Limited. See, this loan is being given to buy shares of Security Troopers Limited. That is to buy the shares of the holding company. Yes. In the second situation also, in the third situation also, we are providing financial assistance to buy fully paid shares either of the company or of the holding company. So holding company point is not a problem. Then it is 5 month salary, which means it is within 6 months salary. So it is within the limit also. And they are fully paid up shares, guys. So your conditions are fulfilled. The question does not say that we're giving loan to directors or KMP. So let's assume the employee is not a director, not a KMP. All my conditions are fulfilled. Therefore, I can say that the second proposal is perfectly valid. Right? But now then look at what the question says. Mr. Strong, one of the directors, has although approved the first scheme, but he has opposed the second one, claiming that the employees can be granted loan for purchase of Forward Troopers Limited shares, but not of holding company. Mr. Strong is wrong, guys. Mr. Strong, listen. Under section 67, under the exceptions, we can give financial assistance not only to buy shares of the company, but also for the shares of the holding company. So this is not a problem. So Mr. Strong opposing the second scheme is definitely not right. Now what happened? What are they asking us? Considering the provisions under Companies Act, answer the following. Validity of the decision by the Board of Directors of Forward Troopers Limited to provide a loan worth 110 crores to the trust to aid the employee to buy the shares. This is going to be invalid, guys. Just now we discussed the first proposal is invalid because 110 crores is more than the limit of 107.85 crores. Then the second point, the validity of the contention of Mr. Strong on grant of loan for the purchase of shares of Security Troopers Limited. Here read the question a little carefully. They are not asking you whether the second proposal is valid or not. Had they asked whether the second proposal is valid or not, you would have said that the proposal is valid. The scheme is valid. This is what you would have said. But they're not asking you that. They are asking you whether Mr. Strong's contention is right or not. Mr. Strong is opposing the second scheme. No, he is contending that the financial assistance is to purchase the shares of holding company, not of the company. So therefore, Mr. Strong is contending that the second scheme is not right. So is Mr. Strong's contention right? No, Mr. Strong, what you are saying is invalid. The company can do the second scheme. The second scheme is perfectly valid. Mr. Strong is opposing the second scheme. His contention of opposing the second scheme, that is invalid. Understanding? So the first question is whether the first scheme is valid or not. The first scheme is invalid because the loan is more than the limit. And the second question is Mr. Strong's contention valid or not? Mr. Strong's contention is invalid. The second scheme is valid, just that Mr. Strong's contention is invalid. Alright, this was your first question targeting section 67 and the exceptions. Now coming to the second question, one more question from your share capital chapter, guys. Now this one is relating to buyback, that is section 68. Very simple question. Let me quickly tell you about the concept which is involved in this question. Two basic concepts only are being tested over here. Point number one, we all know that whenever a company wants to buy back securities, first of all, AoA authorization is required. So if the AoA does not authorize, then the company has to first alter the AoA, get AoA authorization, only then it can buy back securities, guys. And one more precondition is there in buyback cases, and that is a prior special resolution is required. But however, if two conditions are fulfilled, then the special resolution is not required. Condition number one, the amount which is being spent on buyback is within 10% of the paid up equity share capital plus free reserves plus securities premium. And second condition is that a board resolution has to be passed. So there are two preconditions when it comes to buyback. Precondition number one is that AoA has to authorize, and precondition number two is that a special resolution has to be passed. But special resolution is not required if two conditions are fulfilled. Condition number one, buyback is within 10% of paid up equity capital plus free reserves plus securities premium. And the second condition is that board resolution has been passed. If both of these conditions are fulfilled, then special resolution is not required. Okay, guys. And one more concept is maximum. How much money can the company spend on buyback? The maximum the company can spend 25% of paid up share capital plus free reserves plus securities premium. Alright, see, if you actually want to gain a little more clarity, I can draw one small chart for you over here. If the company is spending money on buyback, what's the maximum limit possible, guys? Maximum limit possible is 25% of paid up share capital plus free reserves plus securities premium. Okay, but if the company is spending only up to 10% of paid up equity share capital plus free reserves plus securities premium, if this much money only the company is spending, then in that case just a board resolution is required, SR is not required. But if the company is going to spend more than this 10% number, then maximum up to how much company can spend? Only up to 25% company can spend, but for more than 10% number, special resolution is required. Now there's clarity? Yes, so keep this in mind and now have a look at the question. The question says Apiroc Limited is a public company that has been performing well financially and it has accumulated a substantial amount of cash reserves. Company's management has decided to buy back some of its shares to improve earnings per share, return on equity and enhance shareholder value. Below are the financial details of Apiroc Limited. Paid up share capital, free reserves, secured loans, unsecured loans, current market price and total number of shares outstanding. All this information is given to us. Company's management wants to buy back 10% only, guys. So which means just a board resolution will be enough. I don't require a special resolution. The company's articles has already authorized. They have passed ordinary resolution. I don't care whether ordinary resolution or special resolution, what is passed, I don't care. Simple board resolution only is required over here because you're not buying back more than 10%. Then the question says its board has authorized the buyback of shares. So I'll assume that the board has authorized by way of passing a board resolution. Then they plan to use the free reserves to fund the buyback. Whether the and by the way, can you use free reserves to fund the buyback? Yes, of course. You can use free reserves, you can use CRR, you can use securities premium money. So you can use free reserves also. Whether the company can buy back 10% of its shares as per the provisions of Companies Act under the given circumstances. Yes, the company can buy back. It does not require SR. It requires a simple board resolution only because it is not more than 10%, and board resolution has been passed, so the company can buy back 10%, not a problem. Then they're asking us what is the maximum amount that is allowed. See, the maximum amount possible is what? 25%. That is 25% of paid up share capital plus free reserves plus securities premium. Paid up share capital is 50 crores, free reserves is 100 crores, and securities premium is 0. So 50 plus 100 is 150 crores. This into 25% is 37.5 crores. So company can spend maximum 37.5 crores on a buyback, but then because a company is spending 25%, because it is more than 10%, a special resolution will be required. Just ordinary resolution not allowed. So if SR is passed, then maximum 37.5 crore is how much the company can spend on buyback. Understanding? So two things they had asked us over here. Number one, buyback 10% just with board resolution, is it okay? Yes. Up to 10% just board resolution is enough. Then they asked us what is the maximum amount that can be spent on buyback by the company. Maximum amount is 25% of paid up share capital plus free reserves plus securities premium. But in that case, if the company is going to spend 37.5 crore, then a prior SR will be required. Okay. So this was a question testing just 2-3 concepts from buyback. Now coming to question number 7, guys. This is a simple question relating to your securities premium discussion. The question says Crystal Harvest Limited has an authorized share capital of 150 equity shares of 100 rupees each and a balance of 1.75 crore in securities premium account. Securities premium, guys, section 52, it can be used only for certain specified purposes. Now the board of directors is considering the use of this balance for general business purposes. Can the company do that? No. The company can use money in securities premium account only for 5 specified purposes. Like the company can use the money to issue fully paid bonus shares, or the company can use the money to buy back securities, or the company can use securities premium money to pay premium on the redemption of preference shares or debentures. Then the company can use the securities premium money to write off preliminary expenses, and also for your share issue expenses, debenture issue expenses. For all these purposes only the company can use securities premium money. It is like a sacred money. It cannot be used for any random purpose. It cannot be used for general business purpose, not allowed. It can be used only for these 5 purposes. So whether the securities premium account can be applied for such purposes, the answer is no, it cannot be applied. Okay, this was a simple question from share capital. So 3 questions we saw from your share capital chapter. Your first one was relating to section 67. This was a very interesting question. I hope you grasped it well. Your second question was from section 68, and your third question now is from section 52, your securities premium. Now moving on to the deposits chapter. In deposits chapter, guys, you know very well the most important concept is the exclusions from deposit, your rule 21C. Now, apart from the exclusions, the second most important concept in your deposits chapter is tenure, the tenure of deposits. Both of these concepts are getting tested in your first question over here. Let me quickly discuss the concept with you first. So the tenure of deposits, whether you accept from the public, whether you accept from the members, the tenure of the deposits has to be anywhere between 6 months and 36 months, guys. Minimum 6 months and maximum 36 months. But however, the Companies Act does allow you to accept deposits for short-term requirement even less than 6 months, provided it is not less than 3 months. In simple words, nothing to get worried, no complication. The general tenure of deposits, whether you are accepting from the public, whether you are accepting from the members, the general tenure of deposits is that it has to be between 6 months and 36 months only. But however, for short-term requirements, you are allowed to accept deposits for the period of 3 months to 6 months. But however, for this we have a limit, and the limit is 10% of your paid up share capital plus free reserves plus securities premium. Alright, so the minimum tenure, look at this now. Minimum tenure is 6 months, maximum tenure is 36 months. Payable on demand is prohibited. You cannot have deposits payable on demand. They have to be payable only upon maturity, and the maturity can be anywhere between 6 months and 36 months only. Payable on demand is prohibited. And in case you want money for short term requirements, even less than 6 months, even that is possible, but it should not be less than 3 months. Minimum tenure is 3 months, and for this short term requirement, maximum how much money you can raise? 10% of paid up share capital plus free reserves plus securities premium. So this is one concept which is involved in the question. Now have a look at the question. The question says SK Textiles Limited wants to accept deposits of 1 crore from members for a tenure which is less than 6 months. So because the tenure is less than 6 months over here, definitely it's going to be deposits for short term requirement. So short term requirement less than 6 months, is it permitted? Yes, it is going to be permitted, but then you'll have to write about the conditions. How many conditions are there? 2 conditions. You can accept deposits for short term, but condition number 1, it should not be less than 3 months. The tenure has to be minimum 3 months. It can't be less than 3 months. And condition number 2, the maximum limit will be 10% of paid up share capital plus free reserves plus securities premium. Okay, this is your first subdivision over here. And now coming to the second subdivision. For this, I have to give you a quick revision of one more concept, the exclusions, guys. See, look at this. I have brought the exclusion over here, but still I want to draw it and explain it to you. It's a very, very important exclusion, also very simple. Let's say I have a company, and let's say I have this person. So this company has issued a convertible note to this person, and against the convertible note, of course, this person, Mr. Blue, has given the company some money. Now, this money will not be considered as deposit provided some conditions are fulfilled. Condition number 1, this company has to be a startup company. That means this company has to be a private company which is recognized as startup by DIPP, Department of Industrial Policy and Promotion. Then condition number 2, this convertible note, either it should be converted into equity shares or it should be repaid. Basically, it is not compulsorily convertible. Either it will be converted into equity shares or it will be repaid within 10 years. And condition number 3, this money happens to be, this money has to be at least 25 lakh rupees, and this money should be received in one single tranche, which means this money should not be coming in bits and pieces. So I have 3 conditions. Condition number 1, the convertible note has to be either converted into equity shares or it has to be repaid within 10 years. Then the company has to be a startup company, a private company recognized as startup by DIPP, and the money has to be at least 25 lakh rupees, which came in one single tranche. If all these conditions are fulfilled, then this money which the company has raised against convertible note, that money will not be considered as deposit. Keep this point in mind, and now come to the question. The question says, S, one of the directors of ATC Technologies Private Limited, a startup company, requested K, one of his close friends, to lend to the company 50 lakhs in a single tranche by way of convertible note, repayable within 6 years from the date of issue. Let's check whether the conditions are fulfilled. Condition number 1, it should be a startup company. It should be a private company which is recognized as startup by DIPP. Yes, my condition number 1 is fulfilled. Then condition number 2, this convertible note should either be converted into equity shares or it should be repaid within 10 years. Here it is repaid within 6 years. 6 years is within 10 years, guys. So even this condition is fulfilled. And the third condition, the money has to be at least 25 lakh rupees and it should be coming in one single tranche. Here the money is 50 lakh rupees coming in a single tranche. 50 lakhs, guys, it is at least 25 lakhs. All the conditions are fulfilled. Therefore, this money of 50 lakhs which the company is going to receive from Mr. K, this money will be excluded from deposits. It will not be considered as deposit. Simple, right, guys? So 2 concepts we spoke about here. Number 1 was about the tenure of deposits and short-term deposits, and then we spoke about the convertible note exclusion. Okay, now come to the next question over here. Question number 9, again from your deposits chapter, a mock test paper question. Now for this question, you have to know one small point, eligible company. See, first of all, which company can accept deposit from members? If you want to accept deposit from members, you can be a private company or you can be a public company. You can be any kind of a company. You can accept deposits from members. But if you want to accept deposits from public, you have to be only a public company, and that too, not all public companies. Only eligible public companies can accept deposits from the public. So which company would this eligible public company be? Now, eligible public company is Condition number 1, obviously a public company. Condition number 2, either its net worth is at least 100 crores or its turnover is at least 500 crores. Condition number 3, it has obtained consent of the shareholders in a general meeting, sometimes by special resolution, sometimes by ordinary resolution. And finally, condition number 4, by chance special resolution was passed, that special resolution has to be filed with ROC. So there are 4 conditions. So by the way, what are we talking about? If a company wants to accept deposits from the public, it has to be an eligible company. So what is this eligible company is what we're trying to understand right now. Condition number 1, it has to be a public company. Condition number 2, either the net worth has to be at least 100 crores or the turnover has to be at least 500 crores. Condition number 3, sometimes ordinary resolution is required, sometimes special resolution is required. And condition number 4, if special resolution has been passed, that special resolution has to be filed with ROC. Alright. Only if all the conditions are fulfilled, the company will become an eligible company, and only if it's an eligible company, it can accept deposits from the public, guys. Now come on, have a look at the question. Following are the extracts of information as per the latest audited balance sheet in respect of Play World Limited. Paid up capital, share premium, free reserves, turnover. Company wants to accept deposits of 50 crores from the public and it has obtained credit rating. Tenure of the deposit is 36 months. In light of the above data, referring to the provisions of Companies Act, answer each of the following. Question number 1, can Play World Limited be permitted to accept deposits from the public other than its members after passing an ordinary resolution? Now see guys, they're not asking you about the tenure over here. They're not asking you about the amount over here. They are just asking whether this company accept deposits from the public or not by passing OR. That's all what they're asking. So I'm not going to talk about the deposit amount. I'm not going to talk about the tenure. I'm just going to check whether this company is eligible to accept deposits from the public by passing OR or not. Okay, listen to me now. Question number 1. Which company can accept deposits from the public? Only an eligible company can accept deposits from the public, guys. Eligible company means what? First of all, it should be a public company. Tell me, is your company over here a public company? The name of the company is Play World Limited. So definitely it's a public company. Then condition number 2, either the net worth has to be at least 100 crores or turnover has to be at least 500 crores. Here the turnover is 510 crores, guys. Yes, turnover is at least 500 crores. Condition 2 is also fulfilled. Condition number 3, sometimes OR is required, sometimes SR is required. Now here the company wants to pass an OR only. Now see, understand. If the company is accepting deposits which are within section 181C limit, then OR is enough. If the company is going to accept deposit which is more than section 181C limit, then only SR is required. Company wants to accept deposit only by passing OR. So company, you just have to ensure that you are accepting deposit which is within the 181C limit. So now they're asking you, can this company accept deposits from the public after passing OR? My answer will be yes. Why will my answer be yes? First of all, I will conclude that this company is an eligible company, because it's a public company and also the turnover is at least 500 crores, so it does become an eligible company. Then point number 2, I will say that company, listen, if you want to pass only an OR, then you have to ensure that the deposits are within section 181C limit. So company, if you can ensure that your deposits are within 181C limit, then just by passing an OR, you can accept deposits from the public. It will be allowed. No need of filing with ROC and all, because all that is required only in SR. No need of SR if you are accepting deposit within 181C limit. Understanding? So can it accept deposits from the public? Yes, it's an eligible company. And is OR going to be enough or not? That depends. Company, if you're going to accept deposits within 181C limit, then in that case, yes, an OR will be sufficient. Okay. Then they're asking you, Play World Limited needs 5 crore of funds for short-term requirements and promises to repay the deposit within 5 months. Can the company raise deposits under Companies Act 2013 and the applicable rules? Come on guys, short-term requirement, just now we learned. Short-term requirement means what? Generally the tenure is 6 months to 36 months, but short-term requirement means it can be anywhere between 3 months to 6 months, which means tenure can be less than 6 months also, only two conditions have to be fulfilled. Condition number 1, it should not be less than 3 months. It should be minimum duration 3 months. Yes, here it is 5 months, guys, which means it is for minimum 3 months. Condition 1 is fulfilled. Condition number 2, the maximum limit of deposits for short-term requirement will be 10% of paid up share capital plus free reserves plus securities premium. So here if you see, the paid up share capital is 20 crores, the free reserves is 30 crores, and the securities premium is 10 crores. So 10% of this number would be 6 crores, guys. So this is a maximum amount which the company can raise for short-term requirement. Company wants to raise only 5 crore for short-term requirement. 5 crore is within 6 crores. So both my conditions are fulfilled. Hence, tell me, guys, can the company raise 5 crore for short-term requirement of 5 months? Yes, the company can. Both the conditions are fulfilled. Short-term requirement means tenure is less than 6 months. But two conditions. Condition number 1, tenure should be minimum 3 months. It can't be less than 3 months. And the limit is maximum 10% of paid up share capital plus free reserves plus securities premium. Both the conditions are fulfilled. Hence, yes, the company, you can accept money for short-term requirement. So, two questions we did on deposits, guys. The first question was on tenure of deposits, and we also spoke about the convertible note exception. And our second question was again on tenure of deposits, and we also spoke about eligible company and OR and SR. Alright, now coming to your question number 10. This is one last question from your deposits chapter, but this is a nice in-depth case-based MCQ, guys. But this entire case-based MCQ targets only one concept, and that is relating to warranty exclusion. So first let me explain the warranty exclusion to you, and then we will look at this case-based MCQ. See, whenever the company receives some advance money from a person, okay, this advance money will not be considered as deposit provided this advance money comes under any of the 7 situations. Right now, our entire focus is this 5th situation, guys. See, let's say there's a company which has received any advance relating to warranty or relating to any maintenance services in the future. Now, this advance money relating to warranty, relating to maintenance services will not be considered as deposit provided the tenure, the period is as per the common business practice of 5 years, whichever is lesser. This one point, right now you may not have proper understanding, but let's have a look at the question, you will understand. Okay, the question is a case-based MCQ. The question says, Supertalk Engineering Limited is a public company engaged in the manufacture of domestic and commercial automobiles. Company has been providing automobile dealership in and across the country to various entrepreneurs. Out of 56 such dealers, LD Motors Limited in city of Jaipur, Rajasthan is one of the prime selling joints for domestic automobiles. So therefore, guys, my company is Supertalk Engineering Limited. This company has various dealers. One of the dealers for this company is LD Motors Limited. Okay, then what happened? Supertalk Engineering Limited entered into a contract with this dealer for providing warranty services to customers, and it has provided advances, namely 1.2 crore and 1.25 crores. So Supertalk Engineering Limited has given two advance monies to LD Motors Limited. The first one is for 1.20 crores and the second one is for 1.25 crores, and both are relating to warranty. Okay. The former advance being for providing warranty relating to engine fault repair within 2 years. So for this first advance, the first advance money, the warranty period is 2 years, and for the second one, the warranty period is 6 years. And here they are saying that 7 years is as per the common business practice. Now see, what did we just now learn? We learned that if the advance money is relating to warranty or relating to maintenance services, then this advance money will not be considered as deposit if the period for the advance is within whatever is the period as per the common business practice. As per the common business practice, it is 7 years or 5 years, whichever is lesser. Obviously, which is lesser, guys, over here, 5 years. So if the advance period is within 5 years, then it is not deposit. So the first advance money, if you see, it is 2 years only, which means it is within 5 years. So this 1.2 crore, because it is within the limit of 5 years, this will not be considered as deposit. But the second advance money is for 6 years, guys. It is for more than 5 years. So this 1.25 crores will be considered as deposit. That's all, guys. As easy as that. So whatever advance money we are getting for warranty services or for maintenance services and all, will it be deposit or not fully depends upon the period for which this money is. If it is within the limit, then it is not deposit. If the period is more than the limit, then it will be considered as deposit. The limit is whatever is a period as per the common business practice, which here was 7 years or 5 years, whichever is lesser. So 5 years became our limit. The first deposit was for only 2 years, which is within 5 years, hence not a deposit. But the second advance was for 6 years, which is more than 5 years, and hence it became a deposit. So come and have a look at the options. Which option is correct? Neither of the advances is deposit. This is wrong because 1.25 crore is a deposit. Then the advance of 1.25 crore can only be treated as deposit within the meaning of Companies Act. Yes, option B is correct. 1.25 crore only is deposit. 1.20 crore is not deposit. So your answer will be option B. Understanding? So any advance relating to warranty or maintenance services, check the period for the advance. If the period is within the limit, then that advance money is not deposit. If the period is more than the limit, then the advance money will be deposit. And what is the limit? The limit is whatever is the period as per the common business practice or 5 years, whichever is lesser. So here the period as per the common business practice was 7 years. So 7 years or 5 years, whichever is lesser, clearly 5 years will become the limit. Understanding? That's it, guys. So with this we are done with 3 questions from your deposits chapter. Now come on, let's move on to one small simple question from charges chapter. Simple question but very important question, guys, relating to your section 77, your time limits. Okay, see, from the date of creation of charge, the company will have to register the charge with the ROC within 30 days. If you do that, you'll only have to pay fees. But if you're not able to register within 30 days, it's okay. You can register within 60 days from the date of creation, that is within the next 30 days, but in that case you'll have to pay additional fees. If you don't do the registration within this extra 30 days also, then you can do the registration within the next 60 days, but in that case you will have to pay ad valorem fees. Right, guys? So within 30 days you only have to pay fees. If you're not able to register within 30 days, you can register within 60 days from the date of creation, that is within the next 30 days. In that case you'll have to pay additional fees. If you're unable to do the registration within that much time also, it's okay. You can register within the next 60 days, but for that you'll have to pay ad valorem fees. Okay, now keep that in mind. And by the way, one more thing, don't forget, whenever the company wants to do the registration of the charge in this extra time limit after 60 days, yes, no doubt the company will have to pay extra fees, but the company also will have to fulfill extra responsibilities. Company will have to file an application with the ROC. Company will also have to prove to the ROC that the company had a justifiable reason for not registering the charge within 30 days. Only then ROC will allow you to register the charge within these extra time limits by paying extra fees. Okay. Keep this in mind and come to the question. The question says a charge was created by Black Limited on its office premises to secure a term loan of 1 crore from Amro Bank Limited through an instrument of charge executed on 16th February 2025. So in our example now, what is the date of creation of charge? 16th February 2025. Inadvertently, company could not get the charge registered with the concerned ROC within the first statutory period permitted by law. Default was made known to it by the lending banker with a stern warning to take immediate steps for rectification. Basically, within the first 30 days, they were not able to register. The latest date within which the company must register the charge to avoid paying ad valorem fees is when? See, when will the company have to pay ad valorem fees? Only if the company is registering in these next 60 days. Which means if the company registers by this first 60 days, then the company does not have to pay ad valorem fees. Only if the company does not register within these 60 days, if the company is registering in the next 60 days, then only ad valorem fees. And here the company wants to escape from ad valorem fees. So we will tell the company, listen, you could not register within first 30 days, it's okay. Register within the next 30 days. That is, register within 60 days from the date of creation of charge. If you do that, then you will not have to pay ad valorem fees. So let's do the calculation. So 16th February 2025, guys. So this date plus 60 days is what we have to count. So let's see how the calculation would be. In February 28 minus 16, you have 12 days. March, you will have 31 days. Total 60 days. So 60 minus 31 minus 12 would be 17 days. I need 17 days in April. So 16th February 25 plus 60 days would be 17th April 2025. Company, listen, by 17th April 2025, ensure you complete the registration of charge. If you do that, you'll only have to pay additional fees. You will not have to pay ad valorem fees. If you register after 17th April 25, then you will have to pay ad valorem fees. Simple, right? Company could not register within first 30 days. Company wants to avoid ad valorem fees. So therefore, company, your only option is finish the registration within 60 days from the date of creation of charge, that is by 17th April 25. If you do that, then you will not have to pay any ad valorem fees. But see, you will still have to pay additional fees because you did not register within 30 days. So additional fees will still apply, but ad valorem fees will not apply. Alright, so this was your question number 11. Now coming to question number 12, guys, this is where your management and administration chapter begins. Now when it comes to this chapter, I have 7 questions for you. Each question will throw open a lot of new learning for you. So without any tension, without any worry, let's take up these questions one by one. Let's start with question number 12. Now question number 12 targets your EGM section, section 100. We know very well that there are 2 meetings of members, guys. One is the annual general meeting and the other is extraordinary general meeting. Now when it comes to extraordinary general meeting, who calls a meeting? The board of directors calls a meeting. Either the board of directors can call the meeting on their own, or the board of directors can call the meeting upon the requisition of the members, that is upon the request of the members. The members who are going to request for EGM, those members are called as requisitionists. Okay. Now of course, guys, 1 or 2 members are going to request. Of course, board won't listen. So how many members have to send the request? How many members have to send the requisition? The requisition has to be sent by members put together who are holding at least 1/10 of the paid up share capital. Easy, guys. So if the request is sent by members put together who are holding 1/10 of the paid up share capital, then the board will call them EGM. The board will call the EGM within 21 days from receipt of requisition, and then they will actually hold the meeting within 45 days from the date of requisition. 2 time limits we have. Once the board receives the requisition, from the receipt of requisition within 21 days they will call the meeting, and from the same date of receipt of requisition within 45 days they will actually conduct the meeting. They will hold the meeting. Call the meeting, basically they will send the notice to call the meeting, and then within 45 days from the date of requisition they will conduct the meeting. They'll actually hold the meeting. Okay, but however, in case the board does not call the meeting within 21 days, then in that case the members themselves may go ahead and call the meeting within 3 months from the date of requisition. Totally 3 time limits I'm having over here now. Time limit number 1, once the board receives the requisition, within 21 days itself they have to call the meeting, and within 45 days from the date of receipt of requisition they have to conduct the meeting. But in case the board does not call the meeting within 21 days from the date of requisition, then the requisitionists, the members, they themselves may call and conduct the meeting within 3 months from the date of requisition. Okay, now our next entire discussion is going to be about this part, that is where the board is not calling within 21 days and therefore the requisition are themselves going ahead and calling the meeting within 3 months. So in relation to this part, we have some more points to understand. See, point number 1. Whenever a meeting is held, okay, when in the meeting there are 2 kinds of businesses we know. One is ordinary business, one is special business. We have 4 ordinary business, like declaring dividend, then adoption of your financial statements, then appointing auditors and fixing their remuneration, then appointing directors. So these are your ordinary businesses. Apart from ordinary businesses, everything else is special business, guys. And for each special business, we have to put an explanatory statement in the notice. But however, if the board did not call the meeting within 21 days, and if the members themselves went ahead and called the meeting within 3 months, when they are giving the notice for this meeting, in such case, explanatory statement is not required. Understanding? Generally, for each special business, we need explanatory statement. But when the requisitionists are themselves calling the meeting because the board did not call within 21 days, in that case, for that meeting, explanatory statement is not required. This is one point. Then listen to the next point. Now, in this situation, the requisitionists, the members, they themselves are calling the meeting. So they only have to issue the notice for the meeting also. Now, this notice will be signed by whom? If the requisitionists themselves are calling the meeting because the board did not call the meeting within 21 days, in that case, the notice has to be signed either by all the requisitionists or it can be signed by a requisitionist authorized in writing by other requisitionists on their behalf. Either, like for example, let's say there are 10 requisitionists. Either all the 10 will sign, or let's say one of them, Mr. A alone, is going to sign, but the remaining 9 will authorize him. The remaining 9 will give a written authorization saying that yes, they are okay with Mr. A signing on their behalf. So either all the requisitionists will sign, or it will be signed by a requisitionist who is authorized by the other requisitionist. Okay. This is another extra point. Then this notice will be sent by what mode? It can either be sent by speed post, or it can be sent by registered post, or it can be sent by email electronically. Then the notice has to be sent to whom? It has to be sent to the members. Now which members? You should be a member of the company as on which date? What will the record date be in such cases? That question will arise. For that also a provision has been made in the law. The law says we will see what is the date of receipt of requisition, okay? And from that day we will see 3 days. So from the date of receipt of requisition plus 3 days, by this third day, whoever's name is there in the register of members, those persons will be eligible to get the notice for this EGM. Alright, so the two members whose name appears in the register of members within 3 days from the date of receipt of requisition. That's it, guys. So point number 1, EGM section 100, either it can be called by the board on its own, or it can be called by the board upon the requisition of members. Upon the requisition of how many members? Members put together who are holding at least 1/10 of the paid up share capital. Then, if the members are making this request, then in that case, the board has to call the meeting within 21 days from the date of receipt of requisition, and they actually have to hold the meeting within 45 days from the date of receipt of requisition. If they don't call the meeting within 21 days from the receipt of requisition, then the members themselves can go ahead and call and hold the meeting within 3 months from the date of requisition. If the members themselves are calling the meeting like this because the board did not call within 21 days, in that case, the notice has to be signed either by all the requisitionists, or it can be signed by a requisitionist who is authorized in writing by the other requisitionist. Then the notice has to be sent to all the members by speed post, registered post, or email. Explanatory statement is not required in such cases, and it has to be sent to which members? Those persons who are members of the company within 3 days from the date of receipt of requisition. Okay. Now come on, have a look at the question. Easily we will be able to handle now with all this knowledge. The question says Autumn and Spring Limited is a public limited company engaged in the business of manufacturing traditional designer garments for men and women for various festivities and occasions. The company was incorporated in 2023, has a paid up capital, be careful, it has a paid up capital of 200.56 crores and it has revaluation reserve of 75.45 crores for the financial year 23-24. So as of now, what is the only thing relevant for me? It's a public company. It has paid up capital of 200.56 crores and it has revaluation reserve of 75.45 crores. Okay, then what happened? Members holding share capital worth 36.52 crores have jointly applied for calling an EGM for transacting some urgent matters of special business. So members are applying for an EGM. How many members are applying? Members put together who are holding a capital worth 36.52 crores. Now let us check, guys, are these members holding at least 1/10 of the paid up share capital or not? See, the paid up share capital of the company is 200.56 crores. So 200.56 crores into 1/10, that would be 20.056 crores. So members put together should be holding at least 20.056 crores of the paid up share capital. Is that condition fulfilled? Yes, it is fulfilled because members who are making the requisition, they are holding 36.52 crores of capital, which is more than 20.056 crores. So therefore, yes, the requisition is made by members put together who are holding at least 1/10 of the capital. Great. Then what happened? In this connection, a requisition by the above members was validly presented to the board of directors on 1st July 2024. This is the date of requisition. Directors did not pay heed to the above request till 24th July. See, what did we just now learn? We learned that once a board receives a requisition, within 21 days you have to call the meeting. So, 1st July 2024 plus 21 days would be 22nd July 2024. By this date, the board should have called the EGM, guys. But the question says till 24th July also, the board has not done anything. So if the board does not call within 21 days, then the requisitionists themselves can call and hold the meeting within 3 months from the date of requisition. So the question says the directors did not pay heed to the above request till 24th July. Hence, the requisitionists decided to go ahead with calling the meeting by themselves. So you understood what direction the question is taking? Yes, guys. First, requisition has been made by members holding at least 1/10 of the capital. Now, the board should have called the meeting within 21 days, but the board did not call the meeting, and therefore the members are going to themselves call and hold the meeting within 3 months. So when the members are themselves going to go ahead and call the meeting within 3 months, then all these extra points will apply. Okay, guys, then look at this. What happened? The requisitionists provided a notice. The notice was signed by only one of them, duly authorized by the others of the said meeting through an email. Tell me, is this okay? The notice has, in such cases, if the members themselves are calling the meeting, because the board did not call within 21 days, notice has to be signed by either all the requisitionists or by a requisitionist who is authorized by the others. Here, if you see, the notice is not signed by all requisitionists. Instead, it is signed by one of them who is authorized by the others, which means the second situation over here, guys. Yes, so this is also perfectly valid. This is allowed. Then the notice was sent by email. Is email okay? Yes, it can be sent by speed post, registered post, or by electronically, that is by email. So even email is fine. It did not attach any explanatory statement. Even this is okay. No doubt, generally for special businesses, explanatory statement has to be attached. But however, when the requisitionists themselves are calling the meeting, the notice for that meeting does not require an explanatory statement. So even this is perfectly fine. Then, so which means there are 3 points that this para is talking about. Point number 1, the notice was signed by only one of the requisitionists. This is okay because it can be signed by a requisitionist who is authorized by the others. Then second point, the notice was sent by email. The mode of sending the notice by email is also fine because there are 3 modes which are allowed by the law. And lastly, it does not attach an explanatory statement. Even that is fine. That is a special exception given in such cases when the requisitionists themselves are conducting the meeting. So there is no violation at all over here. Then what happened? Sohan Lal, one of the shareholders who became a member of the company on 10th July 24, raised issue regarding the legality of the meeting as its notice was not mailed to him. See, first of all, does he have the right to receive the notice or not? He became a member when? He became a member on 10th July 24. We learned that notice will be sent only to those persons who have become members of the company within 3 days from the receipt of requisition. The requisition date is what? 1st July 2024. 3 days would be what? 4th July 2024. But Mr. Sohan Lal, he became a member only on 10th July 24. Is his name already there in the register of members by 4th July 24? No. So he anyways does not have the right to receive the notice of this meeting. So therefore he is contending that the notice was not mailed to him and therefore the meeting is illegal. Mr. Sohan Lal, what you're saying is not right. It's going to be definitely incorrect. Now come on, let's have a look at the questions. Referring to the relevant rules and provisions of the Companies Act, decide on the following. Whether the above requisition by the members was adequate towards calling an EGM by the requisitionists themselves. First, was a requisition made by the correct number of members, guys? Yes, it was made by members put together who are holding at least 1/10 of the paid up share capital. That condition was fulfilled. And yes, we waited for the board to call the meeting within 21 days because the board did not call within 21 days from the date of receipt of requisition. That is why the members themselves went ahead and called the EGM on their own. So yes, whether the above requisition was adequate or not, yes, it was adequate. Yes, a requisition was made by the correct number of members. And yes, they did wait for 21 days only because the board did not call the meeting within 21 days. Only after that, only the requisitionists themselves went ahead and called the meeting. Then, whether signing on the notice by only one of the requisitionists and non-attachment of explanatory statement as mandated under section 1 or 2 of the Act, will it have any effect on the validity of the above said notice? No. See, only one requisitionist signed the notice. That was perfectly fine, guys, because we learned either it can be signed by all the requisitionists or by anyone who's authorized by the others. So only one of them signed. That one person was authorized by the other requisitionists. Hence, there's no violation of law. Then, explanatory statement was not attached. Even this was not a violation of law because this specific exception given when the requisitionists themselves call the EGM, explanatory statement need not be attached to the notice. So therefore, is there any violation? There is no violation, and because there is no violation, will there be any effect on the validity of the notice? There will be no impact. The notice will be perfectly valid only. Further, whether the contention of Sohan Lal not receiving the notice, is it correct or not? Sohan Lal's contention is incorrect because the notice has to be sent only to those members whose name is there in the register of members within 3 days from the date of requisition. Here the date of requisition was 1st July 24. So 3 days would be 4th July 24. But Mr. Sohanlal became a member only on 10th July 24, which is after the 3 days period. So therefore he anyways does not have the right to receive the notice of the meeting. So his contention is definitely not right. Alright, so that is it with this question, guys. Question number 12. Moving on to question number 13 now. Question number 13 tests us on two sections, section 108 and section 110. Section 108 talks about e-voting. Now, section 108 e-voting is mandatory for two companies. Number one, it is mandatory for all listed companies which have listed their equity shares on a recognized stock exchange. And number two, it is also applicable to all those companies which have at least 1,000 members. Now, we don't have the word "and" in between. No. So, which means if a company fits under bucket 1 or if it fits under bucket 2 and if it fits under any of these two buckets, then e-voting will be mandatory for the company. Okay. So either the company should be a listed company or the company should be having at least 1,000 members, then e-voting will be mandatory. Now see, moving on, when it comes to e-voting, there are two situations or there are two events. First of all, the voting is going to happen from home, remote e-voting. You're going to be voting through the internet from home itself. That's going to be your first event, your e-voting event. But in e-voting cases, there will also be a general meeting. It's always followed by general meeting. So in case a member was not able to vote electronically from home, then he can vote at the general meeting. So see, listen, there are two possibilities. Possibility number one, if you have already voted electronically, then you can't vote again at the meeting. But if you were not able to vote electronically earlier, then at the meeting you can vote. That provision will also be provided at the meeting. Okay. So this is your first point, that point number one, when it comes to 108 e-voting, it is mandatory for two companies. Number one, it is mandatory for all listed companies, and number two, it is mandatory for all those companies which have at least 1,000 members. Then point number two, whenever you have section 108 e-voting, there are two events. Number one, remote e-voting, which is from home, and then that is always event number two, it is always followed by general meeting. So all those members who were not able to do electronic e-voting from home, they can vote at the general meeting. Okay, but if you have already put your vote, if you have already voted electronically, then in that case you can attend the general meeting, but you can't vote again at the meeting. Okay. Then after this, we have section 110, which talks about postal ballot. See, there's something very different, something very unique between e-voting and postal ballot that you should be aware of. Very interesting point. See, when it comes to section 108 e-voting, first of all, there is remote e-voting from home, guys, which means you from home itself, using the internet, the members will vote, and then it is always followed by general meeting. But when you look at section 110, there is only postal ballot, which means members are going to vote from home, either using the internet or using the postal services. They're going to vote from home. That's it. But there is going to be no general meeting in postal ballot cases. Alright. Now there are 10 businesses or 10 matters where the voting will happen only by way of postal ballot. One of those 10 matters where postal ballot is mandatory is electing small shareholders director under section 151. Okay. So for all these 10 matters, it is mandatory that the voting will happen by postal ballot only. But however, there is one very important provision given in section 110 which says that there might be a situation where to the same matter or for the same company, both section 108 is applicable and section 110 is applicable. Both are applicable. Like for example, let's say the company is a listed company. So because it's a listed company, e-voting is applicable. And let us say the matter in front of us is electing a small shareholders director, which means postal ballot is also applicable. So the situation in front of us is that both 108 and 110 both are applicable. If both are applicable, in that case, the voting can happen either by 108 or by 110. Both will be fine. Any of the two we can follow. Like for example, if it's a listed company, section 108 is applicable. E-voting is applicable, e-voting is mandatory. So to elect small shareholders directors, postal ballot is mandatory. So either this voting can happen by postal ballot or it can happen by e-voting. Both will be fine because it becomes a situation where both the sections are applicable. If both the sections are applicable, in that case, whether you do the voting by postal ballot or whether it is e-voting, both will be allowed. So in simple words, either of the two the company can do. The company can either follow section 108 or the company can follow section 110. There will be no violation in that case. Alright, so this is the only concept that is relevant for this question. Now come on, let's have a look at the question. The question says, Fabulous Fabricators and Mechanics Limited It's a listed public company. It is incorporated in the year 2023 with the object to manufacture and engaged in the construction of iron ore based infrastructure. Company is having a paid up share capital of 200.30 crore divided into 865 members. So it's a listed company. It is having 865 members. So see, for this company, first of all, will e-voting be mandatory? It's a listed company, but if you see the number of members, it's not more than 1000. It is 865 only. But however, I just told you, we don't have to fulfill both these conditions. We have the word or in between, which means either it should be a listed company or it should be having at least 1000 members. Here the company is not having at least 1000 members, but it is a listed company, and therefore for this company, section 108 e-voting will be mandatory. Okay. Then the question says, the AGM of the company was due to be held on 12th December at the registered office of the company. Yes, AGM can be held at the RO. The board of directors decided to provide the facility of e-voting to members. Correct only, e-voting is mandatory for this company. In addition to other modes, despite of the disagreement shown by Mrs. Riddhi, one of the directors who was of the view that in case of the above company, it was not mandatory to provide the facility of e-voting. No, Miss Nidhi, what you are saying is wrong. What you are saying is incorrect. No doubt this company has less than 1000 members, but it is a listed company. So because it's a listed company, 108 is mandatory. E-voting is mandatory. So what Ms. Riddhi is saying, she is saying that it was not mandatory to provide e-voting facility. That is incorrect. Then what happened? On the day of the meeting, Mr. Mohan, one of the members who had opted for e-voting, could not exercise his option. Hence, he was physically present at the meeting to vote. Tell me guys, can he do this? He opted for e-voting, but he could not exercise his option, which means he could not vote electronically. So if a member is not able to vote electronically, he does have the option to vote at the general meeting, guys. And that's exactly what Mr. Mohan is trying to do. He could not exercise the option to vote electronically. So he is physically present at the meeting and is going to vote at the meeting. Will you allow this, guys? Yes, even this will be allowed. See, had he voted electronically, then we will still let him attend the meeting, but he can't vote again at the meeting, right guys? But he was not able to vote electronically earlier, so he can attend and vote at the meeting, perfectly allowed. The chairman of the meeting did not allow him to physically cast his vote on the pretext that he had opted for e-voting and now he cannot change his option and thus had to vote through e-voting only despite being present. So what the chairman is saying over here is incorrect, as Mr. Mohan did not vote electronically earlier. He can come to the meeting and he can vote at the meeting. This is allowed. We can't stop Mr. Mohan from doing this. We can stop Mr. Mohan only if he has exercised e-voting already, only if he has already voted electronically already. Then in that case, we can't let him vote again at the meeting. But because he did not cast his vote electronically, we will let him to cast his vote in the meeting. Then what happened? Further, a matter regarding appointment of Mr. Keshav as small shareholders director was also to be discussed in the meeting therein, to which the legal team suggested that the same can only be undertaken by voting through postal ballot and not otherwise. See, no doubt appointing a small shareholders director is a section 110 matter, guys. It does come under section 110 and therefore postal ballot is mandatory. But this is a listed company. So section 108 is also applicable for the company. So when both the sections are applicable for the company, in those cases, the company can adopt either of the two sections. Either the company can do the voting for this matter through postal ballot, or the company can follow section 108 and do an e-voting. Both are going to be allowed. Company can do any of the two. The legal team is suggesting that it can be undertaken only by postal ballot and not otherwise. This is not really perfectly correct. This is definitely incorrect because the company does have an option that either the company can do this voting electronically, section 108, or through postal ballot. Both the sections are applicable. So either of the two the company can follow. But beware, in the suggested answers, something else is written. In suggested answers, it is written that yes, this particular matter can be taken by postal ballot only, and hence what the legal team is suggesting is correct. That is most probably wrong, guys, because the section 110 very clearly says, even if you look at the Bare Act, it very clearly says that if for the same matter, both the sections are applicable, then the company can follow either of these two sections. It is okay. Alright, so now come on, let's have a look at the three questions under this. Whether the contention of Ms. Riddhi was correct as to the provision of e-voting facility being optional in case of the company. No, Riddhi is not right. Yes, no doubt the company has less than 1000 members, but however, it is a listed company. Therefore, e-voting is mandatory in these companies. Then, can the chairman stop Mr. Mohan to physically vote at the meeting? No, chairman cannot stop Mr. Mohan. Had Mr. Mohan already voted electronically, then we could have stopped Mr. Mohan from voting again at the meeting. But because he was not able to cast his vote electronically, we should let him physically vote at the meeting. We cannot stop him. So, what the chairman is trying to do is not right. And lastly, is a suggestion of the legal team regarding the appointment of Mr. Keshav by voting through postal ballot valid at law? Here you'll have to play a little safe. You'll have to say that yes, no doubt, appointing a small shareholders director does come under section 110. So therefore the matter has to be taken up by postal ballot only. But however, because it's a listed company, section 108 e-voting is also applicable. So because both the sections are applicable, the company can get this voting done by following either of these two sections. Any of these two sections can be followed by the company. Either it can be done through postal ballot or it can be done through e-voting. Any of the two the company can follow, it will be perfectly fine. Alright, so this was your question number 13. So your question number 12 was everything relating to EGM, and now your question number 13 was about two sections, section 108 and section 110. Now let's come to your question number 14, which tests us on two aspects of section 90, which deals with SBO, that is significant beneficial owner. Now significant beneficial owner is an individual who has at least 10% shares in the company, either just indirectly or indirectly plus directly. So two things I want you to remember over here. Thing number one, there should be at least 10% shareholding in the company, and thing number two, this 10% shareholding indirect is mandatory, either just indirectly or it can be indirectly plus directly. Just directly alone is not going to be eligible. Alright, so SBO is an individual who has at least 10% shares of the company, either indirectly or indirectly plus directly. Now what is the meaning of indirectly? I'm not going into that you must be aware of already. I'm just discussing with you that part of the section which is relevant for us in this question. Okay, so now if you look at this question, Arc Support Limited is a public limited company incorporated in 2018, having registered office in Nasik, Maharashtra, and engaged in the manufacture of sports shoes and related accessories. It has a following breakup of equity and preference shares. If you see, it has 1,20,000 equity shares of 100 rupees each. So the total equity share capital of the company will be 1,20,000 equity shares of 100 rupees each. Total 120 lakhs will be the equity share capital of the company, guys. Then the company is having preference shares also. Now Miss Martha, one of the members from Jaipur, she holds in her name, so direct holding, she is having 6,50,000 worth of direct holding, and she also has beneficial interest of 3 lakhs. So directly plus indirectly put together, she is holding share capital worth 9,50,000 rupees, guys. Tell me, is she having at least 10% shares of the company? Total capital is 120 lakhs. 10% of 120 lakhs will be 12 lakh rupees. Is Martha having 12 lakh rupees worth of capital, worth of shares directly and indirectly put together? No, she's having only 9,50,000 worth of shares. So tell me now, can I call her an SBO? No. See, only if you're an SBO, only then within 30 days you have to submit declaration to the company, form Ben 1, all those formalities will apply. But here she is directly plus indirectly put together. She is having shares worth 9,50,000 only, which is within 12 lakh rupees, and hence for her SBO concept itself will not apply. So now what's happening, look at this. She's concerned about declaration to be made by her as mandated by SBO rules. No, she does not have to make any SBO declaration because she is not an SBO. Only if she was holding indirectly plus directly put together, only if she was holding at least 12 lakh rupees worth of equity share capital, only then we would have called her an SBO. But she is holding less than 12 lakh, only 9,50,000. She is not holding at least 10% shares in either just indirectly or indirectly plus directly. Therefore, she is not an SBO. She is not an SBO. Okay. Then what are they asking us? She consulted CA Miss Marina, her friend, on the above issue, who advised her that since she has a significant beneficial ownership directly and indirectly in the company, she is required to file the declaration as mandated by by the above rules. Terrible advice. This is incorrect. You can say that she has significant beneficial ownership only if she has at least 10% stake in the company, either just indirectly or indirectly plus directly. Here she owns less than 10% of the company's shares. Therefore, it is not going to be Section 90 case. SBO concept will not apply. Referring to the provisions of the Companies Act and SBO rules decide whether the advice given by Miss Marina, her friend, is it in line? Is the advice correct? No. The advice is not right. She is not an SBO. She does not have to file any declaration with the company. Okay. Then SBO rules are applicable in every case. Comment and mention the instances, if any, where these rules are not applicable. See, generally what happens is, if you are an SBO, you have to give a declaration to the company telling the company the details about your ownership and all in form number Ben 1 within 30 days of becoming an SBO. Okay. But however, this requirement of submitting a declaration, the whole SBO provision itself is not applicable if the shares are held by IEPF, Investor Education Protection Fund, holding company, government or local authority, investment vehicles like mutual funds, alternate investment funds, real estate investment trusts, infrastructure investment trusts, and investment vehicles regulated by RBI, IRDA, Pension Fund Regulatory and Development Authority, and so on. So basically, yes, if you are an SBO, then the SBO rules, the SBO formalities will apply on you. But however, there are exceptions if the shares are held by, if the shareholder happens to be IEPF or the holding company or government or local authority or mutual fund, alternate investment funds, real estate investment trust, infrastructure investment trusts, or investment vehicles regulated by RBI, IRDA and all, to these entities, SBO rules will not apply. They don't have to make declarations to the company. Alright, so this was your question number 14, giving you a nice insight on the SBO point. So point number 1, Martha, she was holding shares directly, indirectly put together 9,50,000 only, which is within 10%. So she is not an SBO. So no need of submitting declarations and all to the company. Formalities are not applicable. And then they asked us to in which situations the SBO rules itself will not apply. Okay, now come on, let's move on to question number 15. Question number 15 is again a question relating to section 100, guys. It relating to AGM, something very similar to what we've already discussed just a few questions back. So the question says Mr. A and Mr. B are joint holders of 5,000 equity shares. They are joint holders. Okay, the company has total share capital of 40,000 equity shares. Out of this 40,000 equity shares, 5,000 is being jointly held by A and B. A requisition for convening an AGM was submitted to the company and it was signed by A and B. So who is the requisitionist over here? How many members are submitting the requisition? 2 members, A and B, guys. They are joint shareholders of the company. Put together, they are holding 5,000 shares in the company. Total, there are 40,000 shares in the company. So we had learned just some time back only, under section 100, the requisition has to be submitted by members put together holding at least 1/10 of the paid up share capital. So 1/10 would be 4,000 shares. Here, if you see, A and B are holding 5,000 shares, which is at least 1/10. It is more than 4,000. So the requisition is perfectly fine, guys. It is being submitted by members who are holding at least 1/10 of the capital. Then what happened? The board of directors refused to call the AGM, citing that the requisition is invalid since it does not meet the criteria prescribed under law. No, the board of directors' refusal is not correct. It does meet the criteria given in law. Law says 1/10 of paid up share capital the requisitionist should be holding, and A and B, the requisitionists, they are holding 1/10 of the paid up share capital over here. So board of directors refusal is not valid. Examine the validity of the board of directors refusal with reference to the relevant provisions. Their refusal is definitely invalid. Here the requisitionists are holding at least 1/10 of the paid up share capital. Therefore, the requisition is perfectly valid. So board of directors, their refusal is invalid. Okay, now coming to question number 16, one more question from your same management and administration chapter. This is relating to minutes book, guys. See, every page in the minutes book has to be initialed or signed, and the last page has to be dated and signed. But by whom? By whom? Who should be signing the minutes book depends upon that the minutes relate to what? Do the minutes relate to board meeting or committee meeting? Do the minutes relate to general meeting, or do the minutes relate to postal ballot? Now our entire focus is on just this part of the discussion where the minutes are relating to the general meeting. Now once the general meeting is over, okay, within 30 days the minutes book has to be prepared. Now it has to be signed by the chairperson of that particular general meeting. In case the chairperson has died before signing, or in case he is unable to do the signing, then in that case the minutes book has to be signed by any director who is authorized for this purpose. Simple, guys. So every page of the minutes book has to be initialed or signed, and the last page has to be dated and signed by whom? If it's minutes book relating to general meeting, it has to be done by the chairperson of the meeting, and in case he is not able to do it, or in case he dies before signing, then in that case another director will be authorized for this purpose, and he will do the signing on behalf of the chairperson. Okay, now have a look at the question. The question says Sunrise Agro Limited held its AGM on 10th August 25. Meeting was chaired by Miss Priya Sharma. So she's a chairperson of the general meeting. She's a chairperson of the board also. See, it is not necessary the chairperson of the board and the chairperson of the meeting are always the same. It is not necessary. Here they happen to be the same person. Then what happened? On 12th August 25, Ms. Sharma, without signing the minutes of the meeting, she left India for Toronto to care for her ailing mother. Referring to the relevant provisions of Companies Act, examine the manner in which the minutes of the above meeting are to be signed in the absence of Ms. Sharma and identify the appropriate person who should sign them. So these are minutes of the AGM. These are minutes of the general meeting. They have to be signed by the chairperson, that is, they have to be signed by Priya Sharma. But because she is not there, because she's not available in the country, because she's left India, because she's out of India as of now, because she's unable to do the signing, therefore, in her place, any director of the board will be authorized for the purpose of signing. That authorized director will sign the minutes book in place of Ms. Priya Sharma. Simple. So ideally, the chairperson Priya Sharma is supposed to do the signing because she's unable to sign. Therefore, in her place, the board of directors will authorize some director for this purpose. The director who is so authorized, he will do the signing on behalf of Priya Sharma. Alright, this was your question number 16. Now comes question number 17. So 17 and 18 and 19. I think we have three questions. No, we have two questions, 17 and 18. Both of these are case-based MCQ from your management and administration chapter. Okay. Now the first case-based MCQ is from your September 25 question paper. Now let me discuss a concept with you first. See, the first AGM of the company, what's the time limit for that? The first AGM of the company has to be held within 9 months from the end of the first financial year. Generally what happens is, if the company is not able to hold the AGM within the time limit, the company can apply to ROC and can request for extension. Okay. But for the first AGM, there is no concept of extension and all. The AGM has to be held within 9 months from the end of the first financial year. Like in this question, if you see, the company was incorporated on 1st November 2022. So the date of incorporation is 1st November 2022. So the first financial year of the company will end when? It will end on 31st March 2023, guys. From this date, within 9 months, the first AGM has to be held, which means the first AGM has to be held on or before 31st December 2023. In case the company is unable to hold the AGM within this much time, there is no option of going to the ROC and asking for extension. No extension possibilities for the first AGM. And here if you see the first AGM, the company held on 1st May 23, which means the company has held the first AGM well within the time limit. Okay. Now talking about the subsequent AGMs. For subsequent AGMs, we have 3 time limits, guys. We have to calculate the time limit on the basis of all the 3. Then we have to pick the earliest. That will become the last day by which AGM has to be held, all subsequent AGMs. For subsequent AGM, however, if the company is unable to hold subsequent AGM within the time limit, then we can go to the ROC and we can request for extension. See, if we go to the ROC and if we request for extension, it is not mandatory that ROC has to give us extension. It is not mandatory. Only if ROC thinks it is justified, only then he will give us extension. How much extension we can expect from the ROC? Maximum 3 months extension we can expect from him. Okay. Now see, what are the 3 time limits? Time limit number 1. The maximum time gap between 2 AGMs has to be 15 months. Like in this question, if you see, the first AGM was held when? On 1st May 23. Now the second AGM, if you see, the gap can be maximum 15 months. So 1st May 23 plus 15 months would be 1st August 23. So this would be the last day by which the 1st August 24, sorry. This would be the last day by which the second AGM has to be held as per the first time limit. Then your second time limit is that AGM should be held within 6 months from the end of the financial year. So my second financial year right now is financial year 23-24. So when I talk about financial year 23-24, the end of this financial year would be 31st March 24. This plus 6 months would be 30th September 24. So the company has to hold the AGM by 30th September 24 as per the second time limit. And the third time limit is that there must be at least one AGM in each calendar year. See, the last AGM happened when? The first AGM happened on 1st May 23. This was in calendar year 2023, guys. So my next calendar year is 2024. So on the last day, that is by 31st December 2024, the AGM should be conducted. This is the time limit as per the third point. So there are 3 points. On the basis of each of the 3 points, you will find the time limit. Now out of the 3, which is the earliest, 1st August 24, this will become the time limit for conducting the second AGM, the subsequent AGM. Okay, now what happened in this question? Boro Tough Glasses Limited is a public company engaged in manufacturing doors and panels made from toughened glass. Company was incorporated on 1st November 2022 with the required members in capital. First AGM was held on 1st May 23. We just did the checking. First AGM has to be held within 9 months from the end of the financial year. That is, it has to be held by 31st December 23, and your company has held it on 1st May 23 itself, which means it is definitely within the time limit, guys, the first AGM. Then what happened? Mr. F, the company secretary, decided to call the next AGM for financial year 23-24. For the second year, that is, he decided to call it on 1st August 24. 1st August 24 will be proper, guys. It is exactly as per the time limit. See how 1st August 24? For subsequent AGMs, we have 3 time limits. Gap between 2 AGMs should not be more than 15 months. The last AGM was held on 1st May 23. So within 15 months, that is latest by 1st August 24, the second AGM should be held. Then in each financial year, within 6 months from the end of the financial year, the AGM should be held. So financial year is 23-24. Within 6 months from the end would be 30th September 24. And in each calendar year, there must be one AGM. So calendar year 2024, last day is 31st December 24. So I have 3 time limits, out of which the earliest is 1st August 24, which is exactly what even the company has decided, that they will hold the AGM on 1st August 24. Then what happened? On 31st July 24, company applied to ROC for an extension of 4 days. See, had this request for extension been for the first AGM, we would have said extension is not possible. But this is for the subsequent AGM, guys, for the second AGM. So yes, 3 months extension is possible, but only if ROC permits. But however, what happened? The plea was rejected by ROC. ROC did not allow. The company went on to conduct the aforesaid meeting on 5th August 24. So see, guys, the due date, the last date by which the AGM should have been held is 1st August 24. Okay, ROC did not give extension. So the actual date when the AGM was actually held was 5th August 24. So here if you see, there's a delay of how many days? There's a delay of totally 4 days, guys. So because there's a 4 days delay, there will be a penalty. The penalty will be 1 lakh rupees plus 500 rupees per day of delay. So 500 rupees into 4 days. So 1,20,000 will be the punishment that will have to be paid by the company and the officers in default because of not holding the AGM on time. Understanding? See, if the ROC had given extension, then there would be no penalty. But ROC has not given extension, which means my due date to hold the AGM is still 1st August 24 only. Company held it on 5th August 24. There's a delay of 4 days. So 4 days into 500 rupees per day, that is 20,000 plus 1 lakh, total 1,20,000 punishment has to be paid. So now what the question is asking us, what is the effect of convening the meeting on the above date? Company and every officer in default will be liable to a penalty of 1,30,000. 1,30,000 is wrong. 1 lakh is also wrong. It is going to be 1,20,000. That is nothing but 1 lakh plus 500 rupees per day of delay. Here there is a delay of 4 days. So 500 rupees into 4 days of delay. So 20,000. So 1 lakh plus 20,000. 1,20,000 will become the punishment. Okay, so this was your question testing you on the time limits as well as on the punishment section 99. This punishment is mentioned in section 99 of your Companies Act. All right. Then there's one more question, guys. One last question from your management and administration chapter. This is relating to special resolution. See, special resolution means a resolution where the number of votes cast in favor have to be at least 3 times the number of votes cast against. Okay. In simple words, whenever they ask you what is special resolution, 75%, 3/4, all these are not wrong answers, but it is not the perfect answer. A professional answer would be the number of votes in favor is at least 3 times the number of votes against. Okay, now look at this question. This company wants to pass a special resolution. It wants to shift the registered office from Delhi to Maharashtra. It wants to pass an SR. Now, votes in favor, 3,000 votes in favor, votes against 1,200 votes, and we have invalid or abstained votes 300. See, the whole trick in this question is knowing that I don't care about the invalid votes, I don't care about the abstained votes. I will only see the votes in favor and the votes against. I will not bother about the members who did not even come to the meeting. I will not bother about the members who came to the meeting but did not vote. I will not bother about them. I will not bother about invalid votes. I will only bother about how many votes are in favor, 3,000. How many votes are against, 1,200. So the number of votes in favor should be at least 3 times the number of votes against, guys. So 3 times the number of votes against will be 3,600. So tell me, is 3,000 at least 3,600? No. So is SR passed over here? SR is not passed over here. It's as simple as that. We'll see how many votes in favor, how many votes against. We'll see 3 times the number of votes against. The number of votes in favor should be at least 3 times the number of votes against. Here 3,000 is not at least 3,600. It is less than 3,600. So therefore your SR is not passed. So which of the following correctly states a legal requirement for SR? Votes in favor must be twice the votes against. No. Votes in favor must be 3 times the votes against. Yes, the votes in favor must be at least 3 times the votes against. Votes in favor must not be less than 3/4. No. 2/3. No. So option B would be your correct answer over here. All right, so this was it about your entire discussion on management and administration chapter. So if you see, we discussed the descriptive questions first, wherein we spoke about section 100, your EGM point. Then we discussed about SBO. We had a small point about SBO. Then section 108 and 110, your e-voting and postal ballot also we spoke about. And now we had one small question relating to special resolutions. Now moving on to a dividend chapter. Now in your dividends chapter, you have 2 descriptive questions and you have one nice huge case based MCQ as well. Alright, so we'll discuss this now. We'll take up the descriptive questions first. 1 minute here. See, so this question number 19, this is relating to interim dividend. Okay, see, when the company is declaring interim dividend, first of all, you know that the shareholders don't have a role to play over here, guys. Interim dividend is declared straight away by the board of directors itself. Now, whenever they declare dividend, whether it is interim dividend, whether it is final dividend, doesn't matter. Whenever dividend is being declared, before declaring the dividend, the previous losses and the depreciation which is remaining unadjusted has to be adjusted in the current year. So company shall set off carried over previous losses and depreciation not provided in the previous years against profit of the company of the current year. Only then the company will declare dividend. Okay, so point number 1, whenever the company is declaring interim dividend, the shareholders have no role to play. The board of directors itself decide how much to declare, when to declare, the directors itself decide. Point number 2, whether it is interim dividend, whether it is final dividend, doesn't matter. If you have any unadjusted losses or any unadjusted depreciation of the earlier years, it should first be adjusted against the current year profit. Only then the company can declare dividend. Okay. Now comes point number 3. Whenever interim dividend is being declared, it can be declared out of 3 things. Either it can be declared out of surplus in P&L account, which means earlier year's profits, or it can be declared out of the profits of the current financial year, or in case interim dividend is being declared in between the year, then it can be declared out of the profits of the financial year till the preceding quarter. See guys, interim dividend is declared outside the AGM. Right guys, if the dividend is being declared in the AGM, it becomes final dividend. But if it is declared outside the AGM, it becomes interim dividend. So like for example, let us say right now we are in financial year 24-25. For 24-25, let us say the AGM is going to be held on 30th September 25. Okay. Now, in case the company declares interim dividend after the year is over, that is after 31st March 25, but before 30th September 25. Are you understanding? If the company is declaring interim dividend after the year got over, but before AGM, it will still be interim dividend only. Why? Like for example, if the company is declaring dividend on 1st May 2025, this will be interim dividend only because it is not in the AGM, right? It is outside the AGM, so it will be interim dividend only. But this date is after the year got over. So in this case, we can say that the company is taking profits of the financial year. So the financial year is over. Whatever profit the company has made in the financial year, using that profit, the company can declare interim dividend. Okay. So this second point over here generally comes into the picture when the company is declaring interim dividend after the year got over. But however, if the company is declaring interim dividend in between the year itself, like for example, let us say financial year 24-25 guys, each year will have 4 quarters, April to June, July to September, October to December, and Jan to March. Let's say the company is declaring interim dividend on 31st October 2025, 31st October 2024. That is, interim dividend is being declared in the third quarter. Now, in this case, how many quarters do we have before this? We have 2 preceding quarters. Now, in these 2 preceding quarters, we will see how much profit the company has made. Using that profit, the company can declare interim dividend. Understanding? So, you got the third point over here, profits of the company up to the preceding quarter. So company is declaring interim dividend on 31st October 24. So the preceding quarter will be till September. So till September, whatever profit the company has made, using that profit, interim dividend can be declared. Alright. But however, remember there's a small catch. In case up to this preceding quarter, if the company has incurred losses till this preceding quarter, like for example in our situation, 31st October the company is declaring interim dividend. So preceding quarter is September till September. Till September, in case company has incurred losses, that is till the preceding quarter, if the company has incurred losses, then there's a limit on the interim dividend. The maximum limit would be the average dividend declared by the company in 3 preceding financial years. But understand, don't forget that when will this limit apply? This maximum limit will apply only if the company has incurred loss in the current financial year up to the end of the preceding quarter. Only then the maximum limit will apply. Understanding? Only if the company has incurred a loss till the preceding quarter, only then this maximum limit will apply. Otherwise, this maximum limit will not apply. Alright, that's it guys. Simple points. Keep these points in your mind and come to the question. So the question says, Zeta Polymers Private Limited has earned profits for the first 2 quarters of the financial year 24-25. So first quarter the company has made a profit. Second quarter also the company has made a profit. Company calculated, declared and paid interim dividend based on profits earned in the first 2 quarters after providing for full year depreciation. Let's talk about this. This is the star statement of this entire question, guys. We have to interpret this statement properly and we have to check whether the company has done any violation or not. See, first of all, tell me, company has declared the interim dividend over here in between the year or after the year is over. Company has declared in between the year, guys. As soon as 2 quarters are over, company has declared interim dividend. Is that allowed? Yes. We can declare interim dividend during the year also, after the year also, just that we have to declare it outside the AGM. So that part is perfectly fine. Then the dividend is being declared out of the profits earned in the first 2 quarters. Is that okay? Yes, like if the company is declaring dividend on 31st October, we discussed that the company can declare interim dividend out of the profits of the preceding 2 quarters. So yes, even this is fine. In simple words, company is doing the third point over here wherein the company is declaring interim dividend out of the profits of the financial year till the preceding quarter. Now comes an interesting point. After providing for full year depreciation, is that okay guys? Company is declaring interim dividend, let's say in the third quarter, using the profits of the preceding 2 quarters. Now yes, no doubt the company has to provide depreciation first, but should the company provide depreciation for the full year or should the company have provided only proportionate depreciation till September? No, you're supposed to provide full year's depreciation. So even this the company has done perfect. This might be a new point point for some of you. This point is not even being tested in this question, but this can be a subject matter of some other question. Are you understanding? Whenever the company is declaring interim dividend during the year, the interim dividend can be declared only after adjusting the full year's depreciation against the current year profit. You cannot adjust just proportionate depreciation till the first 2 quarters. No, you should be adjusting the full year depreciation for the entire year against your profits up to the preceding quarter, and only then we can declare interim dividend. So company has not done any violation over here, guys. Company is declaring interim dividend during the year. Company is using the money out of the company is taking the money out of the profits earned by the company up to the preceding quarter, and the company has correctly provided full year's depreciation and not proportionate depreciation. So properly company has done. Then what happened? Company incurred losses in the next 2 quarters. The company has incurred overall losses for the financial year. So first 2 quarters company made profit, company declared dividend. The next 2 quarters company has suffered loss and loss. Net number, if you see the net profit or loss, if you see the net number is a loss for the entire year, leaving no surplus in the P&L account. Company has not carried over losses and unabsorbed depreciation. Applying the provisions of the Companies Act 2013, decide whether the company has contravened the provisions of Companies Act 2013 by declaring interim dividend despite incurring overall losses for the financial year. Has the company contravened, guys? Overall, the company has suffered a loss. Still, the company has declared interim dividend. There is absolutely no violation in this question. Company has not contravened any provision, guys. See, the company had made profit up to the preceding quarter. Using that profit only, the company has declared interim dividend. Company has correctly provided depreciation for the full year. There is no carried forward losses, no carried forward depreciation also. Just because overall the company has made a loss does not change my answer. Right, guys? As long as the company has declared interim dividend out of surplus in the P&L or profits of the financial year or profits up to the preceding quarter, everything is fine. Company over here has declared interim dividend out of the profits earned by the company till the preceding quarter. So there is absolutely no violation over here. Hence, the company has not done any contravention. It is entirely as per the provisions of the law. Now tell me, in this question, will you put the maximum interim dividend rate? Will you put that limit? No, you will not. You will put that limit only if till this preceding quarter, for the first 2 quarters, if the company had incurred a loss, only then you would have put the maximum limit, right, guys? But here company has made a profit, so therefore the company has not suffered a loss up to the preceding quarter, so you will not even put this maximum rate limit in this question. So company has not done any contravention, perfectly fine. Alright, now come on, have a look at the next question over here. Simple question. See, whenever the company declares dividend, it is good practice that before declaring dividend, the company should transfer some amount of profits to the reserves. But it is not mandatory. If whether the company wants to transfer money to the reserves before declaring dividend or not, and if they want to transfer, how much should they transfer, all that is left at the discretion of the company, which means it is not mandatory for the company to put money into the reserves. It is not mandatory for the company to first transfer profits to the reserves, only then declare dividend. There is no such mandatory rule. The company can straight away declare dividend even without transferring to the reserves, even that is perfectly fine. A small concept is being tested in this question. Harmony Biotech Limited, a manufacturing company, proposed a dividend of 7.5% for the financial year 24-25 to be paid out of the profits earned during the same year. Company has earned a profit of 735 crore for the period and does not intend to transfer any amount to general reserves. Yes, it is perfectly fine. Earlier in 1956 Act, there was a rule that you have to transfer to reserves, only then declare dividend, but no such provision anymore. So even if the company decides not to transfer to reserves and straight away declare dividend, it is perfectly fine. Examine as per the provisions of Companies Act whether Harmony Biotech Limited can proceed with the proposed dividend without making any transfer to reserves. Yes, they can. Transfer to reserves is not mandatory. That's it, guys. So 2 questions we have discussed in our dividends chapter. The first one was very interesting question. Now I have a nice, big, huge case-based MCQ, guys, from your Jan 26 RTP. This entire question, if you see, first we have a nice big story, and under this story we have 6 MCQ questions, okay? Your entire dividend chapter, the time limits, the IEPF point, multiple concepts will get revised for you through this MCQ question. It's like a master question, it's like a master case-based MCQ for your dividends chapter, touching upon a lot of concepts, a lot of provisions. Let me quickly give you a reminder of the relevant provisions first, and then we will enter into the question. So the question says Netawal Heavy Industries Limited, so it's a public company, incorporated in April 2015, is a listed entity engaged in the business of manufacturing electric vehicles of the latest design and technology. It is registered with an authorized capital of 100 crores divided into 10 crore equity shares of 10 rupees each. Paid up share capital is 50 crores, 5 crore shares of 10 rupees each. Then on 15th May 24, after closing the financial year 23-24, but before the AGM, the board declared interim dividend of 10%. Come on, this is your first relevant sentence in this question. On 15th May 2024, after closing the financial year. So what is a relevant financial year for us in this question? In this question, a relevant financial year is 23-24, guys. So after this year got over, on 15th May 24, the board has declared interim dividend 10%. Any violation over here? Question number 1. Can the interim dividend be declared after the year is over? Yes, why not? Can the board itself declare interim dividend without taking shareholder approval? Yes, why not? In interim dividend, shareholders have no role to play. So is there any violation in this interim dividend? No violation, guys. Alright. Then what happened? On 5th July 24, the board of directors of the company approved the financials and recommended a final dividend of 15%. So the board of directors, they have recommended a final dividend of 15%, including the interim dividend. Later on, the general meeting of the shareholders was convened on 31st August 24. In the meeting, a hot discussion upheld and the shareholders argued and demanded 10% more dividend other than 10% interim dividend declared earlier. Now listen to me. In the first para over here, what was relevant? On 15th May 24, the board of directors have declared interim dividend of 10%. They themselves have declared it. After the year got over, they have declared interim dividend. There was no problem over there. Then after this, what happened? On 5th July 2024, this is the date on which the board of directors, they have recommended the final dividend. See, when it comes to final dividend, the board of directors itself cannot approve. See, look at the terminology. When it comes to interim dividend, it is directly declared by the board. But when it comes to final dividend, there are two stages, guys. It will first be recommended by the board, then only it will be approved by the shareholders at the AGM. So 5th July 24 cannot become the date of dividend, guys. It cannot become the date of final dividend. It is just the date on which the board has recommended the final dividend. Just recommending is not enough. It also has to be approved by the shareholders in the AGM. And when is that AGM being held? The AGM is being held on 31st August 2024. So this 31st August 2024, on this date in the AGM, if the final dividend is approved by the shareholders, then this date will become the date of declaration of dividend, provided it is approved by the shareholders. And by the way, how will they approve it? They will approve it simply by passing one ordinary resolution. Okay, so coming back now, on 5th July 24, the board of the company approved the financials. They recommended final dividend of 15%, which is including the 10% interim dividend. But then, however, the members, they demanded 10% more dividend. Tell me, can the members bargain like that? No, we have learned this already, that the shareholders cannot insist on declaration of dividend or increase the rate recommended by the board. See, they can lower the rate recommended by the board. They cannot insist on declaration of dividend. They also cannot demand increasing the rate. Like for example, if the board has said that this year we don't have profits, so let's not have any dividend. Can the members of the company, can they insist that no, we want dividend? They can't insist like that. Then if the board of directors have declared 5% final dividend, can the shareholders say no, we want 15%? No, they cannot increase like that. So here if you see, the members are demanding 10% more dividend. They cannot do that. They cannot increase, they cannot demand increasing the dividend. They cannot insist on dividend. They cannot demand to increase the dividend. That is not allowed, not right. Okay. Then what happened? The company secretary asserted that the final dividend cannot exceed what the board has recommended in their board meeting. Yes, what the company secretary is saying is perfectly right. The shareholders cannot bargain, they cannot try to increase the dividend. Some dissenting shareholders left the meeting hall in protest of the decision of the company regarding interim dividend. Okay, so till here question is clear. Yes, so first the company has, first the board has declared interim dividend, and then the relevant financial year is 23-24. Then the board has recommended final dividend on 5th July 24, and in the AGM now we are asking the shareholders for approval. But the shareholders are insisting on a higher rate of dividend, and some of them walked out of the meeting. Then what happened? resolution pertaining to the declaration of dividend was passed and approved unanimously by the rest of the shareholders, completing the required quorum according to Companies Act 2013. So, guys, tell me, is final dividend properly recommended and declared now? Yes, it was recommended by the board of directors and it is also approved by the shareholders at the AGM. They have passed a resolution approving it unanimously, which means 100% of the members who are present at the meeting, they have approved. No doubt some members walked out, but the members who are present in the meeting, they are constituting quorum. So which means we can put the resolution to vote and the shareholders have unanimously approved it, which means it has been recommended by the board and it has been approved by the shareholders. So properly the final dividend procedures have been followed. So what's the date of declaration of dividend now? When was the AGM held? 31st August 24. This becomes the date of declaration of the dividend. Okay. Then, as per the required procedure stated under the Companies Act 2013, dividend was paid to the shareholders, but some of them could not be paid within the prescribed time. We're supposed to pay dividend within how much time, guys? Within 30 days. From the date of declaration of dividend, within 30 days, the company is supposed to pay the dividend or post the dividend warrant. Here, if you see, the date of declaration is 31st August 2024. So 31st August 2024 plus 30 days would be 30th September 24. So by 30th September 24, the company should have paid the dividend or the company should have posted the dividend warrant. But the question says some of them could not be paid within the prescribed time. So if you're not able to make the payment of dividend within 30 days, then within next 7 days, that is 30th September plus 7 days, that is 7th of October 2024. By 7th October 2024, the unpaid dividend has to be transferred into unpaid dividend account. And the question says, company transferred the unpaid dividend account to a separate bank account on 7th October 24. Perfect, guys. Company has followed the timeline. Dividend was not paid to some of the shareholders in the preceding financial year 16-17 to 22-23. This is old information. Then Ashwin, an old shareholder holding 5,000 shares, later visited the company's website and discovered that company had declared dividend for each financial year from 16-17 to 23-24, but the amounts were not paid to him since 2016-17. Now see, right now we are in the financial year 23-24, guys. Now right, in case money is remaining in the unpaid dividend account, that money can stay there only for 7 years. Even within the 7 years, if the shareholder does not come to claim the dividend money, then the unpaid dividend will be transferred into IEPF after 7 years. So right now we are in 23-24. Now in the current year, we can have unpaid dividend in the unpaid dividend account since which year? Like 23-24 minus 7 years if I see, 2016-17 is what I get, guys. So whatever dividend belongs to 2016-17, for that dividend, 7 years has expired in which year? 7 years has expired in my current year 23-24. So whatever dividend, whatever unpaid dividend relating to 16-17 was there in the unpaid dividend account, that unpaid dividend of 16-17 in my current year, the company would have transferred off to IEPF. Okay, so 16-17's unpaid dividend money would have been transferred by the company into IEPF in my current year 23-24, because for 16-17's unpaid dividend, 7 years are expiring in the current year 23-24. Coming back to the question now, Ashwin, an old shareholder, he is having 5,000 shares. He did not get any dividend from 16-17 to 23-24. Amount had not been paid to him since 2016-17 because company did not possess his updated address and his bank account details. Upon approaching the company and submitting the necessary evidence, his claim was verified. Company thereafter paid him the dividend belonging to 17-18 to 23-24. Are you noticing? 17-18 onwards, company is giving him the money. But however, what about 16-17's dividend? 16-17's dividend, company would have already transferred into IEPF because 7 years have lapsed during the year. So therefore, for 16-17's unpaid dividend, Mr. Ashwin cannot claim from the company. Only option for Ashwin is he can claim from IEPF. See, listen, the shareholder can claim unpaid dividend from the company also, but in case it is transferred to IEPF, then he can claim it from IEPF only. So here 16-17's unpaid dividend would have been transferred to IEPF. So 16-17's unpaid dividend he can claim from IEPF only, cannot claim from the company. Company informed him that the dividend pertaining to 16-17 had already been transferred to IEPF. Consequently, the said amount was no longer recoverable from the company. Aggrieved by this, Ashwin threatened to initiate legal action against the company. No, Ashwin, company has not done anything wrong. Company waited for you for 7 years. You did not come to claim the dividend within 7 years. Once dividend is transferred into unpaid dividend account, it will stay over there only for 7 years. After 7 years, it will get transferred into IEPF. That's what has happened over here. Now they're asking us 6 questions under the story. The first question: since the board of the company has already declared interim dividend before the approval of the final books of accounts and closure of the financial year, whether the board can declare final dividend without approval of shareholders? See guys, when it comes to final dividend, I told you there are 2 steps. Step number 1, it has to be recommended by the board, and step number 2, it has to be approved by the shareholders. But in the question they're asking, can the company declare final dividend without approval from shareholders? No, this is not allowed. Final dividend requires approval of the shareholders. So come on, let's see the options. When the interim dividend has been declared by board later on, final dividend cannot be declared by the board. No, there is no such concept. Interim dividend, final dividend, both we can have for the same year, not a problem. Then, board can recommend final dividend, but approval of shareholders is mandatory. Yes guys, it has to be recommended by the board and approved by the shareholders. Shareholder approval is mandatory. Then option C, board can declare interim and recommend final dividend before holding AGM, for which approval of shareholders is not required. Wrong. For final dividend, shareholder approval is required. And lastly, once books have been approved by the board, final dividend may be declared, but final decision will be of shareholders in the AGM, where they can increase the dividend. No. We just spoke about this also. Shareholders cannot increase the dividend. They can decrease it, but they cannot insist on dividend. They cannot increase the rate of dividend. So my correct answer will be option B guys, that getting the shareholder approval is mandatory. Then comes the second question over here. Once a rate of dividend has been recommended by the board, it cannot be increased. Some of the shareholders walked out on this ground. Which procedure is correct among the following statements in this regard? Which statement is correct, they are asking. Disregarding the boycott of some shareholders, if quorum is present during the course of the meeting and majority of them have approved it, then the rate of dividend recommended by the board shall be treated as approved. Correct guys? In this question, this is what happened, isn't it? Some shareholders left the meeting. Some shareholders boycotted the fact that the board was not ready to increase the rate of dividend, and they left the meeting. But still the remaining members who were still at the meeting, they constituted quorum. And as they constituted quorum, the final dividend resolution was put to vote, and it was approved by all the shareholders who were present in the meeting. So yes, even if I disregard the boycott, even if I ignore the fact that some members left, quorum was still present and majority of them have approved it. So which means ordinary resolution has been passed, and hence the board has recommended the dividend. Shareholders have approved the dividend, and hence the final dividend has been declared. Second option says, shareholders who attended the meeting but do not confirm the quorum may also approve the rate of dividend recommended by the board. No, shareholders who attended but do not confirm the quorum, which means shareholders who left the meeting, we're talking about them. We don't care about the shareholders who left the meeting, because the remaining shareholders who are still at the meeting are anyways constituting quorum. So they itself voted and approved the resolution. Then, if the final dividend is declared by the board, it need not be approved by shareholders. Wrong. Shareholder approval is mandatory. Recommendation of board of the company relating to the rate of dividend stands withdrawn. No. So your correct answer will be option A. Even if I ignore the fact that some of the shareholders left the meeting, quorum was still there. And how many of the members were still there at the meeting? They passed an ordinary resolution and they approved the dividend. Hence, the dividend has been properly declared. Alright. Now coming to the third question. When should the unpaid dividend not claimed by the shareholders be transferred to the separate bank account as per the above case study? We have already done that thinking also. Money has to be transferred into unpaid dividend account latest by 7th October. So option D guys, latest by 7th October it has to be transferred into unpaid dividend account. Then, the fourth question says, the amount of unpaid dividend was transferred to a separate bank account on 10th Jan 2025, which is beyond the prescribed period, while the latest date to deposit in a separate bank account was 7th Jan 25. What will be the interest liability which is to be paid for this delay? If you transfer money into unpaid dividend account late, then how much interest do you have to pay? 12% interest has to be paid. So option C, interest at the rate of 12% per annum. Then, when the company will transfer the remaining unpaid or unclaimed dividend to IEPF, this we've already discussed. Our current financial year is 23-24. 7 years of 16-17 will get expired in the current year. So 16-17's unpaid dividend money, which is lying in the unpaid dividend account, will be transferred into IEPF in the current year 23-24. So 16-17's unpaid dividend will be transferred into IEPF. Then Ashwin, a shareholder holding 5,000 shares, discovered that dividend for 16-17 had been transferred to IEPF. Now, can he claim this money from the company, guys? No, he can only claim it from IEPF. So, Ashwin can claim all the unpaid dividend from the company, including 16-17? No. Ashwin cannot claim 16-17 from the company because it has been transferred to IEPF, but he can claim the remaining dividends from the company. Yes. Ashwin can file a suit to recover for 16-17. No, guys, company has not done anything wrong. 7 years lapsed, then that after that only company has transferred to IEPF. So company has not done anything wrong. No question of filing a suit and all. Ashwin cannot claim any dividend from the company until the next AGM approves a new resolution. Nothing like that. So 16-17's dividend, Ashwin cannot claim from the company, can only claim from IEPF. Option B. Okay, so this was your question number 21, an in-depth case-based MCQ relating to your dividends chapter, guys. Learning number 1, the shareholders cannot insist on dividend. They cannot increase the final dividend. They have to accept it as it is, or they can reduce it, but they cannot insist, they cannot increase. Point number 2, interim dividend is straight away declared by the board, but final dividend is first recommended by the board and then approved by the shareholders in the AGM. Only then it is said to be declared. Then once a company declares dividend, within 30 days, the company has to make the payment or the company has to post a dividend warrant. If the company was not able to pay within 30 days, then in that case, within the next 7 days, the unpaid money has to be transferred into unpaid dividend account. If there's a delay, then 12% interest will apply. And lastly, once money is transferred into unpaid dividend account, it will stay there for maximum 7 years only. During these 7 years, yes, you can claim the money from the company from the unpaid dividend account. But once 7 years lapse, the unpaid dividend money will then be transferred into IEPF. Once the unpaid dividend money is transferred into IEPF, after that, shareholder can claim it only from IEPF, but not from the company. Alright guys, yes, so this was our entire discussion with respect to the dividends chapter, and now we're going to move on into our accounts of companies chapter. See, the very first question over here is about CSR. If for the company CSR provisions are applicable, then that company will have to constitute a CSR committee. But CSR committee is not required for every company. CSR committee is required for those companies which are fulfilling any one out of these 3 criteria. That is why I have the word or in between, because it is not necessary for all the 3 criteria to be fulfilled. Any one criteria is fulfilled, then CSR committee will become mandatory. The 3 criteria are nothing but net worth should be at least 500 crores in the preceding financial year, or the turnover should be at least 1000 crore in the preceding financial year, or the net profit should be at least 5 crore. Okay, and this concept is applicable for every company. Even if you're a Section 8 company, even if you're a foreign company, to every company this concept is applicable. What is the concept? The concept is that if the company in the preceding financial year is fulfilling any of these 3 criteria, then for that company CSR committee is mandatory. So my first discussion was about CSR committee. Okay, then a little later the same section says that the concept of CSR is not applicable for every company. CSR as a concept itself is applicable only to those companies which fulfill the same 3 criteria, any one of the same 3 criteria. So the same 3 criteria are applicable for both, for CSR committee also, for applicability of CSR also. Okay, the law says board of directors of every company which fulfills any of the 3 criteria for constituting CSR committee shall ensure that the company spends every year at least 2% of the average net profits of the 3 preceding financial years. So my conclusion is that the same 3 criteria are applicable for both, for constituting the CSR committee also and for applicability of CSR also. So this results in some conclusions. Conclusion number 1, CSR is not applicable for every company. CSR is applicable only and only to that company which fulfills any one of these 3 conditions. Conclusion number 2, if the company fulfills any of these 3 conditions in that company, the board of directors will ensure that the company spends at least 2% of the average net profits of the 3 preceding financial years on CSR. Conclusion number 3, same 3 criteria, any one of these 3 criteria are fulfilled, that company will have to constitute a CSR committee However, there's a unique point that you should be aware of. In case the amount to be spent on CSR happens to be within 50 lakhs, then in that case, CSR committee is not required. Instead, all the functions of the CSR committee will be executed by the board of directors itself. Okay, so come on, everybody, let us summarize what are our criteria. What is the entire provision over here? Point number one: the net worth of the company has to be at least 500 crores. The turnover of the company has to be at least 1000 crores. The net profit of the company has to be at least 5 crores. Should I write the word and in between, or should I write the word or in between? I will write the word or in between because any of these three criteria have to be fulfilled. Now, all these numbers are current year numbers or preceding financial year numbers. All of these are preceding financial year numbers. Listen to my second point. So, out of these three criteria, if any one criteria is fulfilled, then the board of directors of that particular company will ensure that the company spends on CSR. How much is the minimum spent on CSR? What's the minimum amount to be spent on CSR? The minimum amount is 2%. 2% of what? 2% of the average net profit of 3 preceding financial years. Okay, everybody. Then, and by the way, can I call this minimum number as point A? I'll just call it as A for now. Then comes your third concept. The third concept is that if any one of the three conditions is fulfilled, then in that case, a CSR committee has to be constituted in that particular company. And then comes my last point, my fourth point. In case any one of the three conditions is fulfilled, but however, if the amount to be spent on CSR, that is this point number A, if this point number A happens to be within 50 lakhs, then in that case, even though one of the criteria is fulfilled, still in that case, CSR committee is not required. So if CSR committee is not required, then all the functions of the CSR committee will be executed by whom? All the functions of the CSR committee will be executed by the board of directors itself. Okay, this is the provision. Now come on, everybody, have a look at the question. The question says Chicago Bricks Inc. is a company incorporated in Chicago, USA in the year 1985, engaged in the manufacture of cement and related products. So the company is incorporated outside India, it is incorporated in the US. On 10th April 2022, it commenced manufacture in India through its branch engaged in the manufacture of fly ash bricks used in construction of buildings and other infrastructural projects throughout the country. So guys, can I say that this company is a foreign company? It is definitely not an Indian company because it's incorporated in the US, guys. But it does have a place of business in India. It does have a branch in India. It is doing some business in India. So my company, Chicago Bricks Inc., becomes a foreign company. Then what happened? Turnover of the branch as on 31st March 25, since its commencement is given to us. So this was a year of commencement. This is year 1, 22-23, turnover is 75 crores, 24 turnover 65 crores, and 24-25 the turnover is 85 crores. As per the data available, the branch works based on 20% net profit margin. So whatever is given to us over here is a turnover of the branch, guys. And they are saying that the net profit margin is 20%. So with this, I can find the net profit of each year. So 75 crore into 20%, 15 crores will be the net profit of 22-23. Then 65 into 20%, 13 crores will be the net profit of 23-24. And finally, 85 crore into 20%, 17 crore will become the net profit of 24-25. Okay. Then what happened? Mr. Ramesh, one of the directors of Chicago Bricks Inc., has advised the branch to comply with the requirements of CSR and to form a CSR committee as well for monitoring the aforesaid activities for the financial year 25-26. This sentence very clearly tells us that what is a financial year relevant for us in this question. The financial year relevant for us in this question is financial year 25-26. So Mr. Ramesh, one of the directors, he is saying that CSR committee is required. Now come on, let us check whether what he's saying is correct or not. CSR committee is required if any one of these three criteria is fulfilled, guys. Net worth has to be at least 500 crores, or turnover has to be at least 1000 crores, or net profit has to be at least 5 crore in the preceding financial year. Now in this question, my current financial year is 25-26. So what is my preceding financial year? 24-25 will become my preceding financial year. Now preceding financial year, if you see, turnover is only 85 crore, guys. So my turnover limit is not fulfilled. But my net profit is 17 crores, my net profit is at least 5 crore, my net profit criteria is fulfilled. Any one of these three criteria fulfilled, that's it. Now CSR provisions also will apply to the company. CSR committee also will be required for the company. Right, guys? But however, we also have to check what is the amount to be spent on CSR. If that happens to be within 50 lakhs, then we will conclude CSR committee is not required. So if I have to continue to do my discussion over here, my first point, the net profit of the company in the preceding financial year, that is 24-25, the net profit of my company is 17 crores, which is at least 5 crores. Hence, I can conclude that CSR committee is definitely required because one of the three conditions are fulfilled. But then, however, I will check the amount to be spent on CSR. If that amount to be spent on CSR happens to be within 50 lakhs, then my answer of CSR committee will change. So come on, tell me, what is the amount to be spent on CSR? What is the minimum amount to be spent on CSR? 2% of the average net profits of 3 preceding financial years. Right, guys? So right now what I need is the average net profit of 3 preceding financial years. These are my 3 preceding financial years. Find the average net profits. 15 plus 13 plus 17 by 3. My average will be 15 crores. This is your average, guys. So 2% of this 15 crore will be 30 lakh rupees. So now if you see, the amount to be spent on CSR is only 30 lakh rupees, which is within 50 lakh rupees. Hence, even though one of the three criteria was fulfilled, because the amount to be spent on CSR does not exceed 50 lakh rupees, CSR committee is not required. Instead, all the functions of the CSR committee will be executed by the board of directors itself. Alright, everybody, now come on, let's continue reading. Let's see what else happened in the question. The branch is opposing the above view. Which view? Mr. Ramesh, one of the directors, had said, right, that CSR committee is required. So, Mr. Ramesh, what you're saying is incorrect. Actually, CSR committee is not required. The branch is opposing the above view and has submitted that although the CSR provisions are applicable in the present case, but there was no requirement to constitute a CSR committee, and the above CSR functions can be discharged by the board themselves. What the branch is saying is perfectly correct over here. See, the branch is saying three things. Number one, the branch is saying that CSR provisions are applicable. Yes, CSR provisions are applicable. One of the three conditions are fulfilled. CSR provisions are applicable. But however, there is no requirement to constitute CSR committee. Yes, there is no requirement because the amount to be spent on CSR is not exceeding 50 lakh rupees. And the third thing that the branch is saying is that the CSR functions will be discharged by the board itself. Yes, correct. If CSR committee is not required, then the functions of the CSR committee will be executed by the board itself. So what the branch is saying over here, three sentences, all the three sentences are perfectly right. Now, considering the provisions of the Companies Act 2013, whether Chicago Bricks Inc. is correct in the view as to non-applicability of formation of CSR committee, what will your answer be? Is CSR committee applicable over here? No, CSR committee is not applicable over here. Why? Even though the three conditions, one of the three conditions is fulfilled, because of the 50 lakh number, CSR committee will be not applicable over here. Alright, so this was your first question from accounts of companies focusing on CSR committee and your conditions. Now come on, let's come to the next question. Question number 23. This question is also from a September 25 question paper, and this is about NAFRA, the National Financial Reporting Authority. Now NAFRA has various functions. In this question they are asking us any three functions of NAFRA. I have brought the four easiest ones. NAFRA shall maintain details of the auditors appointed in the companies governed by NAFRA. See, NAFRA does not have a jurisdiction over every company. It has jurisdiction only over those companies which fulfill certain conditions. So NAFRA will have to maintain a proper list or a proper record of the auditors who are auditing the companies which are being governed by NAFRA. Point number one. Point number two, NAFRA will recommend accounting and auditing standards for approval by the central government. So basically what will happen is ICAI prepares the accounting standards and the auditing standards, and then ICAI forwards them to NAFRA. Then NAFRA will recommend them to the government. That's a whole cycle. Then the third function of NAFRA is it will monitor and enforce the compliance of accounting standards, which means it will ensure that companies are following accounting standards. Similarly, it will ensure that the auditors are following the auditing standards. These are the four most important duties of NAFRA. Number one, maintaining a record of the details of auditors who are appointed in the companies which are governed by NAFRA. Then number two, recommending accounting and auditing standards to the central government for approval. Then number three, monitoring and enforcing compliance with the auditing standards, and number four, monitoring and enforcing compliance with accounting standards. Okay. Now come on, have a look at the question. The question says SMTN Limited is a listed company that operates in the pharmaceutical sector. The company's annual accounts for the year 23-24 were audited by a prominent audit firm, JJ and Company. So JJ and Company is the auditor of this company, SMTN Limited. Okay. Following an investigation by MCA, it was discovered that the audit report issued by JJ and Company contained several discrepancies, including failure to disclose material information regarding the company's liabilities and misstatement in its revenue recognition practices. So therefore, what's my conclusion now? My company is a listed company. JJ and Company is the auditor of this company, and this auditor has not given the audit report properly. Their audit report has a lot of discrepancies. The audit has not been done properly. Okay. The issue was raised by a group of minority shareholders who alleged that the audit firm had not complied with auditing standards and had failed to conduct a proper audit. MCA referred the matter to NAFRA, a body established under Section 132 of the Companies Act, to investigate whether the audit of SMTN Limited's financial statements was conducted in compliance with accounting and auditing standards or not. So the company is a listed company. JJ and Company is the auditor. In the audit report, there were a lot of discrepancies. MCA has asked NAFRA to check whether the auditor has followed accounting and auditing standards or not. Okay. In light of the provisions of the Companies Act 2013, explain any three functions and duties of NAFRA. That is what I've written over here. And what action can NAFRA take against the audit firm based on its findings, upholding the allegations raised by a group of minority shareholders? See, if NAFRA is able to prove that the audit did not happen properly, if NAFRA is able to prove that the accounting and auditing standards were not followed by the audit firm properly, then what action can NAFRA take? Look at this. If professional or other misconduct is proved, then NAFRA has the power to impose a penalty and debar also. Impose how much penalty? If the concerned auditor is an individual, then minimum 1 lakh and maximum 5 times of the fee. If the auditor happens to be a firm, then minimum 5 lakhs and maximum 10 times of the fee. In addition to the penalty, NAFRA can also debar that particular auditor from being appointed as auditor, or from being appointed as internal auditor, or from doing valuation under Section 247 for minimum 6 months and maximum 10 years. So this is the power of NAFRA, that in case any professional or other misconduct is proven by NAFRA, then NAFRA has the power to impose penalty. Huge penalty, guys. Minimum 1 lakh for individual, minimum 5 lakh for firms. Maximum 5 times of the fee for individuals and maximum 10 times of the fee for the firm. And not just imposing penalty, we're also debarring that auditor from doing audit work, internal audit work or valuation work for 6 months to 10 years. So this is the kind of punishment that NAFRA can impose on the defaulting auditor. Okay, so this question I would say was more or less a direct theory question. Yes, they did try to make it like a case, but it was more or less a direct theory question. They just asked us for the 3 functions and duties of NAFRA and what actions NAFRA can take against the audit firm. Okay, now come on, let's go to the next question now. Now this is relating to internal audit. So see, first of all, for which companies is internal audit mandatory? Internal audit is not mandatory for every company, guys. It is mandatory only for those companies which fit under any of these 3 buckets. Bucket number 1, it should be a listed company. If it's a listed company, I won't even check anything else. For every listed company, internal audit is mandatory. Then number 2, if the company is an unlisted public company, I will put 4 criteria on this company. Any of these 4 criteria fulfilled, internal audit will be mandatory. Number 1, paid up share capital should be at least 50 crores in the preceding financial year, or turnover at least 200 crores in the preceding financial year, or the outstanding loans or borrowings from banks or financial institutions should be more than 100 crores at any point of time in the preceding financial year, or the outstanding deposits should be at least 25 crores at any point of time in the preceding financial year. So unlisted public company, 4 criteria: paid up share capital at least 50 crores, or turnover at least 200 crores, or outstanding loans and borrowings from banks and public financial institutions more than 100 crore at any point of time in the preceding financial year, or outstanding deposits at least 25 crores. And then in my third bucket, I have private companies, those private companies which are fulfilling this point 2 and the point 3, that is the turnover point and the loans point. Okay, so if my company fits under any of these 3 buckets, then for that company, internal audit will be be mandatory. Now, if internal audit is mandatory, who will be appointed as the internal auditor? The internal auditor may be a chartered accountant, a cost accountant, or any professional who will decide, the board will decide, not the members of the company, guys. See, the statutory auditor of the company is appointed by the members, right? But internal auditor is not appointed by the members. The internal auditor is appointed by the board itself. So it is the board that decides who the internal auditor should be. And the internal auditor may or may not be practicing, doesn't matter. May or may not be the company's employee, doesn't matter, which means even a company's employee can be internal auditor. The internal auditor need not necessarily be an independent person, not necessary. And you tell me, what do you think? Can the statutory auditor of the company, can he itself be appointed as internal auditor also of the company? No, guys, not allowed. So therefore, internal auditor can be any professional. Board will decide, may or may not be practicing, may or may not be company's employee. That's all, guys. Now come on, have a look at the question. The question says SDF Limited, it is an unlisted company. So here itself tell me, can I say that the bucket 1 will not apply over here and bucket 3 also will not apply, guys, because it's clearly a public company. So it's an unlisted public company. It has shared the following data. The equity paid up capital is 48 crores. So tell me, is a paid up share capital at least 50 crores? No, the paid up share capital is only 48 crores, guys. Turnover is 195 crore. Is turnover at least 200 crores? No, it's only 195 crores. So even my second condition is not fulfilled. Deposits are 20 crores. Is deposit at least 25 crores? No, it is only 20 crores. So the only condition which I'm left with now is my loans condition. Loans outstanding on 30th September. Loans outstanding on 1st February. Loans outstanding on 31st March. They have given us loans outstanding on 3 dates. Any day, at any point of time, have the outstanding loans crossed 100 crores in the preceding financial year? Yes, guys, 100.59 crore on 30th September 24. At any point of time in the preceding financial year, is the outstanding loan more than 100 crore? Yes. So my third condition is fulfilled, and hence for this company, internal audit will be mandatory. Now, what are they asking you? Company has invited your expert advice on the following issues. Whether it would be mandatory to appoint an internal auditor? Yes, it will be mandatory because of your third condition over here. In case answer is an affirmative, which means if the answer is yes, then can Mr. G, who is a professional but neither a CA nor an employee of the concern, can he be appointed as internal auditor? He is neither a CA nor he is an employee. Tell me, to be internal auditor, is it mandatory you have to be CA? No, guys, you can be any professional. So even though you're not a CA, it's okay. Then he is not an employee of the company. Is that okay? Yes, the internal auditor may or may not be the company's employee. So there's absolutely no problem over here. Can Mr. G be appointed as internal auditor? Yes, he can be appointed. Alright, so be really careful about the conditions. Now come on, let's take up one more very similar question on the same internal audit discussion only. Rayson Limited is an unlisted public company. Unlisted public company, guys, which means again I can say that I'm neither falling in the first bucket nor am I falling in the last bucket. It's an unlisted public company, so which means I'm going to be talking about my second bucket. As per audited financials for financial year 23-24, company had paid up share capital of 40 crores. 40 crores, guys. So is a paid up share capital at least 50 crores in the preceding financial year? No, it's only 40 crores. Turnover is 210 crore. Is the turnover at least 200 crores in the preceding financial year? Yes, the turnover is 210 crore. I don't even have to check the other two conditions. Even one condition is fulfilled, I will conclude over here that yes, for this company, internal audit will be mandatory. Any one condition fulfilled, guys. See, if you continue to read the question, the loans are 90 crore, which means loans are not crossing 100 crore, but the deposits are 28 crores. So deposit is at least 25 crores. So two conditions are getting fulfilled over here. Doesn't matter. Even one condition is fulfilled, you will conclude that internal audit will be mandatory. Alright, so these were some questions on internal audit. Now come on, let's have a look at our next question, question number 26. See, question number 26 is about section 137, which talks about filing financials with the ROC. See, there's a whole life cycle of financial statements, right? First, the financial statements are prepared by the company. Then they are approved by the board of directors. Then the financial statements are signed by certain specified persons. Then they are audited by the auditors. Then the financial statements are adopted by before adoption they are circulated. Basically, the company sends a copy of the audited financials to all the members of the company. Then they are adopted adopted by the members at the AGM, and finally they are filed with the ROC. So when we are filing with the ROC, they are supposed to be adopted financials, audited financials. That is what we filed with the ROC. Okay, and we're supposed to file them with the ROC within 30 days from the date of the AGM. But however, what if in the AGM we were not able to get the financials adopted? Then in that case, it's okay. We're supposed to file the unadopted financials itself. We should file with the ROC within 30 days of the AGM, and the ROC will accept it on provisional basis, which means temporary basis. Later, in the adjourned AGM, once a company's members, once they adopt the financials, then once again the adopted financials have to be filed with ROC within 30 days from the adjourned AGM along with fees. So this is the only concept that is relevant for us over here. What is the concept? 2 points, guys. Point number 1 is that every year, every company is supposed to file financial statements with the ROC from the date of the AGM. Within 30 days itself, a copy of the audited and adopted financials have to be filed with the ROC. But point number 2 is, in case in the AGM the financials were not adopted, it's okay. In that case, within the same 30 days, that is from the AGM within 30 days, within the same 30 days time limit, we are supposed to file the unadopted financial statements with ROC. ROC will accept them on provisional basis. Okay. Later, in the adjourned AGM, the financials will be adopted by the members of the company, guys. So once the financials are adopted in the adjourned AGM, from the date of the adjourned AGM, within 30 days, the adopted financials once again have to be filed with the ROC. So in such cases, 2 times we will file with the ROC. First, we will file unadopted financials with the ROC, and then later in the adjourned AGM, once the financials are adopted, once again we will file the adopted financials with the ROC. Okay, that's all. Keep this concept in your mind and come and look at the question. The question says, Brem Limited, a public company, held its AGM on 31st August 24. So this is the date of AGM, 31st August 24. Now, during this AGM, the financial statements for 23-24 were presented to the shareholders for adoption. However, due to certain queries raised by the shareholders regarding specific accounting treatments, the financial statements could not be adopted. It's okay, company. 31st August 24 is when you held the AGM. Within 30 days, that is, by 30th September 24, you should file the unadopted financials with the ROC. Right, guys? Consequently, the company decided to adjourn the AGM to address the shareholders' concern and make necessary clarifications. Adjourned AGM was subsequently held on 15 September 24. So the adjourned AGM was held on 15 September 24, where after detailed discussions and satisfactory explanations provided by the management, the financial statements were finally adopted. So great. First, the financials were not adopted. So unadopted financials itself, you should have filed with the ROC by 30th September. Then in the adjourned AGM, 15 September 24, finally the financials are adopted. From 15 September, within 30 days, that is by 15th October 2024, once again you will have to file the adopted financials with the ROC. This is how the provision would be. Following the adoption of the financial statements in the adjourned AGM, Brem Limited filed the adopted financials with ROC on 5th October, which means, yes guys, they have filed the adopted financials on time. 5th October itself they have filed. Within 15th October they have filed with ROC. However, the company did not file the unadopted financials with the ROC within the stipulated time period after the original AGM held on 31st August 24. Just now we learned, right, the unadopted financials by 30th September should have been filed by the company with ROC. That the company did not do. Straight away the adopted financials only the company has filed, which means this step the company has done, but filing unadopted with the ROC on a provisional basis the company has not done. Analyze whether Brem Limited has complied with the requirements of Companies Act with respect to filing adopted and unadopted financials. See, filing adopted financials, yes, they have complied, but filing unadopted financials, no, they have not complied. They should have filed unadopted financials with the ROC by 30th September. They should have filed. They did not file. Hence, clearly there is a discrepancy over here. There is a non-compliance over here. Okay, so simple question, guys, just testing us on whether we know that both adopted and unadopted financials both have to be filed with ROC. Alright, now come to the next question, question number 27. This is about section 131, which talks about voluntary revision of financial statements or board report. See, there are 2 sections, section 130 and section 131. In section 130, the Income Tax Department, SEBI, external person like this is requesting NCLT to pass an order asking the company to reopen the books of accounts and recast the financial statements. So in section 130, the company is not, voluntarily doing the reopening of books of accounts. But in section 131, the company voluntarily has realized a mistake. The company by itself has realized a mistake in its financial statements, or the company has by itself realized a mistake in the board report, and the company by itself wants to make a revision. So this is more like a voluntary revision. That is why the heading also over here. Okay. If you have any doubt in section 130 or in section 131, please make sure you watch my YouTube video wherein I have very nicely explained both these sections in depth, guys, in just 20 minutes. Okay. You will find this discussion under the thumbnail of Accounts of Companies chapter, Untested Areas. In that video, I have discussed these two sections in a very in-depth manner, guys. Ensure if you have even slight doubt in these two sections, ensure you watch that video. Okay, coming back to my discussion. So section 131 talks about voluntary revision, which means nobody is forcing the company on its own wants to revise the financial statements, or it wants to revise the board report. Okay, so for this, what will happen is the company will have to make an application to the NCLT, but before that a board resolution has to be passed. So your first step is a board resolution has to be passed. Second step, once a board resolution is passed, within 14 days itself, this form NCLT1 has to be filed by the company with the NCLT. Okay, so then the company will get approval from NCLT, only then the company can do the voluntary revision. But see, in section 130, the earlier section in section 130, where the others like SEBI or Income Tax Department, where these external people are requesting NCLT to ask the company to reopen the books, they can ask the company to reopen the books for last 8 years, guys. But in section 131, when we're talking about voluntary revision, this is allowed only for the last 3 years. Like for example, right now if we are in year 9, in year 9 we can do voluntary revision of year 6, year 7 or year 8, last 3 years financials and board report only. Okay, keep the small concept in your mind and come to this question. The question says, in August 25, Mr. Raj, a financial consultant to Bright Retail Limited, advised the board of directors of the company to revise the financial statements for the year 22-23 after discovering that they did not comply with certain provisions of Companies Act relating to financial reporting. Examine with reference to the applicable provisions of the Companies Act whether Bright Retail Limited can do so. So Bright Retail Limited, here the company itself wants to do the revision of financial statements, guys. Right now we are in financial year 25-26. So right now we are in 25-26. So in 25-26 we can revise the financials of the last 3 years, which means either 24-25 or 23-24 or 22-23. Now in this question we want to revise the financials of 22-23, which is in this list. Hence tell me, can the company do so? Can the company do the voluntary revision of the financials of 22-23? Yes, the company can do it because it is falling in the list of the last 3 years. Only last 3 years allowed in section 131. Okay, so this was another small question. Now coming to one final question in your Accounts of Companies chapter, question number 28. See, listen to me. This question is relating to financial year. We know very well that financial year is generally April to March, guys. But however, sometimes in some exceptional cases, if the company happens to be a holding company or a subsidiary company or an associate company of a company incorporated outside India, like for example, let us say there's a company A Limited and let's say there's another company XYZ Inc. Now XYZ Inc. is, let us say, an American company, a US company, and A Limited is an Indian company. Okay, and let us say A Limited happens to be the subsidiary company and this XYZ Inc. in US happens to be the holding company. Now in US, your financial year can be any 12 months, not necessarily April to March, not necessarily Jan to December. The company can decide. Let us say that this company's financial year is Jan to December. Okay, so you imagine, first of all, it's a holding company, and this holding company will have to prepare consolidated financial statements. Preparing consolidated financial statements itself is difficult. On top of that, imagine the subsidiary company is following April to March financial year. The holding company is following Jan to December financial year. Can you imagine the kind of complication that is possible in such cases, guys? So in such cases, the law allows this Indian company, which is either a subsidiary company or a holding company or an associate company of a foreign company, and that foreign company is following a different financial year. In that case, this Indian company can make an application to the central government and they can request the central government that please let me also follow Jan to December financial year. Generally, financial year for Indian companies is April to March. But however, if the company is a holding company, subsidiary company, or an associate company of a company which is incorporated outside India, then for the purpose of consolidation, if a different financial year is being followed, like for example, Jan to December in my case, and in that case, this Indian company A Limited can make an application to whom? To the central government, and they can request the central government that please let me also follow this different financial year. If central government is satisfied, they may allow any period as financial year, whether or not that period is a year. So now look at the question. Lotus Global Corporation is a company incorporated in Singapore. So this is a company which is incorporated outside India, guys. It's wholly owned Indian subsidiary Meadow Limited. So Meadow Limited is the Indian company. It intends to adopt a financial year different from the one prescribed in India to align with the consolidated accounts of its parent company prepared overseas. Explain the procedure that Meadow Limited must follow to implement the change. So even over here something very similar has happened. This company Meadow Limited is an Indian company. It is a subsidiary company of a company incorporated outside India. Now this company incorporated outside India is following a different financial year than April to March. So to prepare consolidated financial statements, this Indian company Meadow Limited, they can make an application to central government and request central government that please allow us also to follow a different financial year for the purpose of making consolidation preparation easier. If central government is satisfied, then central government will allow this Indian company to follow a different financial year. Okay guys, so this was your question number 28. So in your accounts of companies chapter, we first spoke about CSR, then we discussed about the NAFRA concept, then we discussed about internal audit, 2 questions we saw relating to internal audit, then we discussed about filing unadopted financials with the ROC, and then now we spoke about section 131 voluntary revision, and finally we spoke about following a different financial year different from April to March. Okay, remember, application has to be made to central government and not to NCLT. Alright guys, now come on, let's move on to our next discussion, our auditors chapter. Now in the auditors chapter guys, I have 3 descriptive questions for you and 1 case-based MCQ for you. Let's have a look at the first descriptive question, question number 29. This is relating to section 143 subsection 12, which talks about fraud to be reported by auditors. See, I'm not talking about fraud committed by auditors, I'm talking about the fraud which has happened in the company and now the auditors have to report about it. Okay, see, now the whole procedure will depend upon whether the fraud is a small fraud or whether it is a big fraud. That is, we have to see what is the monetary amount of the fraud. Is it less than 1 crore or is it at least 1 crore? If the value of the fraud is less than 1 crore, then very simple guys, the auditor will prepare a fraud report. In that fraud report, he will write about 3 things. Number 1, he will write about the nature of the fraud. Then number 2, what is the amount involved in the fraud. And number 3, the parties involved in the fraud. So he will prepare this fraud report and he will give this fraud report to the audit committee or to the board of directors as a case may be. Within 2 days, he will give this fraud report to them, and whatever remedial action the company has taken with respect to this fraud, they have to disclose about it in the board report. That's all, very simple. No need to go to the central government, nothing. This is if the value of the fraud is less than 1 crore. What are the steps? The auditor will go to the audit committee or to the board of directors with a fraud report within 2 days. The fraud report will mention 3 things: the nature of the fraud, the amount involved, and the parties involved. And then now, after getting to know about the fraud, what remedial action did the company take to set right the fraud, that has to be mentioned in the board report. That's all. But in case the fraud happens to be at least 1 crore rupees, then the procedure is a little more elaborate. Alright. Be careful, especially if you're watching this and if you're a May 26 student, then be careful, because for May 26 examination onwards, this provision has undergone a change. Okay, so I'm going to discuss this with you from Jan 26 examination point of view. Alright, now in case the value of the fraud is at least 1 crore, then even over here, first of all, the fraud report has to be prepared, and even over here the fraud report will be given by the auditor to the board of directors or to the audit committee as the case may be. But the story does not stop over here. Once the auditor gives a fraud report to the board or the audit committee as a case may be, the auditor will ask them to give response within 45 days. Are you understanding? If the value of the fraud was less than 1 crore, then within 2 days of coming to know about the fraud, the auditor prepared the fraud report and gave it to the board of directors or to the audit committee. That's all. He did not ask for any response and all. But if the value of the fraud is at least 1 crore, even over here, within 2 days, he will prepare the fraud report. Even over here, he will give this fraud report to the board or to the audit committee as a case maybe, but he will also ask them for a response within 45 days. Then the fraud report which he has prepared plus the response which he got within 45 days from the board or the audit committee plus his comments on that response, all the three has to be sent to the central government within the next 15 days. Now it has to be printed on his letterhead, then an email confirmation also has to be sent to the MCA. All these extra formalities are also there. So there are two things that you have to remember over here. If the value of the fraud is less than 1 crore and what if the value of the fraud is at least 1 crore. If it is less than 1 crore, then very simple. The auditor will simply prepare a fraud report. The fraud report will be prepared within 2 days and the fraud report will be given by the auditor to the board of directors or to the audit committee as a case maybe. Then in the board report of the board of directors, they will disclose what remedial action did they take to set right the fraud. Story is over. Fraud report will contain 3 things: nature of the fraud, amount of the fraud and the parties involved. Now if the value of the fraud is at least 1 crore, even over here the same fraud report has to be prepared within the same 2 days containing the same 3 information. Okay. But however, after giving the fraud report to the board of directors or to the audit committee, here we will also ask them to give their response within 45 days. Then after this, 3 things the auditor will send to the central government. The auditor will send to the central government, that is to MCA. The auditor will send 3 things. Number 1, the fraud report that he prepared, plus the reply that he got from the audit committee or the board of directors, plus his comments on that reply. These 3 things he will send to MCA. All this has to be sent within the next 15 days. Okay. Now come on, have a look at the question. The question says Sharp Surgical Limited is a public company engaged in the manufacture of surgical instruments with a nationwide chain of dealers and retailers to facilitate the trade. So basically, Sharp Surgical Limited is a public company. Okay. It was incorporated in the year 2020. It has a paid up capital of 350 crores with free reserves of 156.7 crores and it has a secured business loan of 56 crores from GHL Bank Private Limited. Now, Lamp, Bell and Associates, a chartered accountant, were appointed to conduct the statutory audit for 24-25. So, Lamp, Bell and Associates is the auditor of this company. During the audit of accounts, Mr. Lamp Bell, the senior partner of the firm, shared the following observations with Mr. Sharp, one of the promoter directors of the aforesaid company. So, be careful. It's a public company. It is having a loan of 56 crores, a secured loan, and the auditor of this company is Lamp, Bell and Associates. In the course of the audit, Lamp Bell, the senior partner, he found 2 things and he's telling about these 2 things to Mr. Sharp, the one of the directors. Thing number 1, out of the above term loan, 3.15 crore was suspected to be used for the purposes other than business in providing unsecured loan to private individuals. So there's a fraud over here. Company borrowed a secured loan from a bank. Now, the company, instead of using this loan for its business, the company is giving this loan further as unsecured loan to private individuals. This is clearly a fraud and the value of the fraud is more than 1 crore, more than or equal to 1 crore. Therefore, the whole process will apply over here. Fraud report has to be prepared. It has to be submitted to the board or to the audit committee as a case may be. We have to ask them for the reply within 45 days. Then their reply, auditor's comments on the reply, everything has to be sent to MCA. So proper reporting has to be made to the central government over here. Then one more observation, Mr. Reith, one of the officers of the company, he was suspected to have siphoned an amount of 0.15 crore. There is one more fraud, but this fraud is only for 15 lakh rupees, which means it is for less than 1 crore. So here no need of reporting to the central government and all. Simply the report will be prepared and given to the board or the audit committee, that's all. Then, Mr. Lamp Bell, having reasons to believe for the above frauds, within 2 days of such detection, informed the audit committee and asked it for its reply so that the central government can be informed of the suspected fraud of 3.15 crores. Correctly, Mr. Lamp Bell has taken action, guys. He prepared the fraud report within 2 days. He informed the audit committee. He asked them for the reply. All of it he did. And then he's saying that the remaining fraud of 0.15 crore, the second fraud, that he's only informing to the audit committee. he is not going to inform to the government and all. Correct. The second fraud is only 15 lakhs. It is less than 1 crore. No need to inform to the government and all. Then Mr. Sharp. Who is Mr. Sharp, guys? Remember, he is one of the directors of the company. Mr. Sharp requested the auditors not to report any matter to the central government. No, Mr. Sharp is wrong over here. The big fraud of 3.15 crores is more than 1 crore. It has to be reported to the central government. So, Mr. Sharp, what you're saying is wrong. Rather, they can mention both the above matters in the director's report. Above request of Mr. Sharp was based on the reasoning that it was only a case of suspected fraud and the same is a matter of investigation on part of the company. Considering the applicable provisions under the Companies Act, decide upon the following: whether Lamp, Bell and Associate Chartered Accountants should restrict the reporting of the above fraud of 3.15 crore as requested by Mr. Sharp. What is the correct procedure to be followed by the auditor? Tell me, guys, whether Lamp, Bell and Associates should restrict the reporting of the above fraud as requested by Mr. Sharp. No, the 3.15 crore fraud, that fraud has to be reported to the MCA. It has to be reported to the central government. So therefore, the whole procedure has to be followed over here. So your answer will be pretty simple. You will say that the value of the fraud is 3.15 crore. It is at least 1 crore. Then you will start writing the entire steps. Fraud report has to be prepared within 2 days. Submit to the board of directors or to the audit committee as a case may be. Ask for reply within 45 days. Then submit 3 things to the central government. Thing number 1, the fraud report. Thing number 2, the reply. And thing number 3, the auditor's comments to the reply. All this has to be submitted within the next 15 days on the letter pad, email confirmation, all that, the whole process you will write. Then what would be the correct procedure for the suspected siphoning of 15 lakh by the auditor of the company? For this 15 lakh fraud, here you will write the value is less than 1 crore. So therefore, no need of reporting to the central government and all. Simply the fraud report will be prepared and given to the board of directors or the audit committee as a case may be within 2 days. And then in the board report, we also have to disclose what remedial action was taken by the company. That's it, guys. So remember, whenever it comes to reporting of frauds, your whole answer will start from checking the value of the fraud. On that basis, your entire answer will change. Okay. And over here, Mr. Sharp, what he's saying is definitely incorrect. He is saying, please don't report about it to the central government. It is wrong. When the value of the fraud is at least 1 crore, it definitely has to be reported to the central government. So what Mr. Sharp is saying is incorrect over here. Okay. This was your first question from your auditors chapter. Now coming to question number 30. See, this question talks about one small thing. The remuneration of auditors. See, the remuneration of auditors is generally fixed by the company in the general meeting. That is the shareholders. Very simple, okay. Who appoints the auditor? The shareholders, right? So it is the shareholders only who will decide what the remuneration should be for the auditor. So either the shareholders in the general meeting itself, either they will fix the amount or they will at least decide what is the manner in which the remuneration will be decided. So either they will fix the amount itself in the general meeting or they will fix the manner in which the remuneration amount will be decided. Alright, with this much knowledge alone, enter into the question. The question says Messrs. AT and Company is a proprietary firm and Messrs. VK Associates is a partnership firm. They were appointed as joint statutory auditors of PQR Limited. So joint auditors are appointed. AT and Company is a proprietary firm. VK and Associates is a partnership firm. Okay. The company is PQR Limited. They were appointed for 5 years. The shareholders delegated the responsibility. Important sentence. Shareholders delegated the responsibility to fix the auditor's remuneration to the managing director, Mr. D. Is this okay, guys? See, listen. They are the statutory auditors. They are appointed by the members. Either the members will fix the amount or they will decide the manner in which the amount will be fixed. In this question, if you see, the shareholders have not fixed the amount. Instead, they have decided the manner in which the remuneration will be fixed. They have decided that the remuneration will be fixed by the managing director, Mr. D. This is perfectly allowed. Either they can themselves fix the amount or they can decide the manner in which the remuneration will be fixed. Here, they have not fixed the amount. They are delegating the responsibility to the MD. They're telling the MD, you decide how much should the remuneration be. So they are not deciding the amount, but they're deciding the manner in which the remuneration will be fixed. Okay. Then what happened? On 29th March 2023, there was a change in the constitution of Messrs. AT and Company from proprietorship to partnership. Okay. In light of the above facts and referring to the provisions of Companies Act, answer each of the following questions. Question number 1. Does the company have the authority to delegate the power to the MD to fix the remuneration? The answer is yes. Either the members themselves can fix the amount or they can decide the manner. Here they have decided the manner. They delegated it to MD. That is allowed. Then, whether annual ratification is necessary since the auditor is appointed for 5 years. No, there is no requirement of ratification every year. That requirement was there earlier, but it is not there anymore. The auditor is appointed for a term of 5 years. In these 5 years, every year ratification is not required. Then, whether a revised ADT1 form is required to be filed with the details of the new firm, Messrs. AT & Co., after the change in constitution. See, this might be a new point for many of you. See, Messrs. AT & Company was one of the joint auditors, guys, and this was a proprietary firm. Now, this proprietary firm has changed its nature from proprietorship to partnership. Okay, which means, in simple words, there is a change in the constitution of the auditor firm. So, whenever there's a change in the constitution of the auditor firm, we will treat it as if a new auditor has been appointed. So whenever a new auditor has been appointed, then ADT1 has to be filed, guys. So yes, in reality, if you see, there is no new auditor, same AT & Company only. But there's a change in the constitution of the firm. It was earlier a proprietorship and now it is getting converted into a partnership. There's a change in constitution. When there's a change in the constitution of the audit firm, it will be considered as if it's a new auditor altogether. And whenever a new auditor is appointed, ADT1 has to be filed. So yes, ADT1 has to be filed over here. Okay, so point number 1, remuneration, either the members themselves can fix or they can decide the manner. Then point number 2, ratification and all is not required. We straight away appoint the auditor for 5 years. Point number 3, if there's any change in the constitution of the audit firm, it will be as if a new auditor is appointed and ADT1 has to be filed. Okay, simple question. Now come to question number 31. Question number 31 is also a very easy question. Last descriptive question of your auditors chapter. See, when it comes to financial statements, if you remember, just some time back only, I had discussed with you the whole life cycle of the financial statements, guys. First, they are prepared by the company. Then they have to be approved by the board of directors. Then they have to be signed by some people. And only then they will be sent for audit. So now in this question, these two parts will get discussed for you. Listen to me. See, the financial statements of the company have to be approved by the board of directors. And this approval, the board of directors cannot delegate to another committee. The board itself has to do the approval of the financial statements of the company. Okay. Once the financials are approved by the board of directors, after that, they have to be signed. Now, they will be signed by whom? The approved financials will be signed by whom? They have to be signed by two categories of people. In the first category, we have the chairperson of the company, if he is authorized by the board, or by two directors, one of whom will be managing director of the company. Then in the second category, we have three people, the CEO of the company, the CFO of the company, and the company secretary of the company. So either the chairperson of the company or two directors, either of these two will sign. And in addition to them, CEO, CFO and CS will sign. But you tell me, can we directly ask for their signature? No. First the financials have to be approved, only then they can be signed. Okay. Then one more concept is involved in this question, and that is, see, we know very well that the auditor can either be a firm or the auditor can be an individual, guys. Now, if the auditor happens to be a firm, okay, then in that case, only those partners of that firm who are chartered accountants, only they will be authorized to act and sign on behalf of the firm. So, three concepts involved in this question. Concept number 1, the financials have to be approved first, only then they have to be signed, and they have to be approved by the board of directors. Board cannot delegate it to any committee. Concept number 2, who has to sign the financials? Two categories of people. In category number 1, chairperson of the company, if he is authorized by the board, or two directors, one of them should be managing director. Category number 2, CEO, CFO, CS. Okay. Then third concept is that the auditor can either be an individual or it can be a firm, a partnership firm or LLP. If the auditor happens to be a firm, then in that case, only those partners who are chartered accountants, only they can sign and act on behalf of the firm. Okay. Now keep these 3 points in mind and come and have a look at the question. The question says, Mr. Rock and Aman are partners in the chartered accountant firm. So they are the partners, Rock and Aman. Their firm has been appointed as statutory auditor of the company. The accounts manager of the accounts manager of the company obtained the signatures. Be careful. The accounts manager of the company obtained the signature from the director, CFO, and CEO on the board report, financials, and other documents and submitted them to the statutory auditor for audit. Wrong, guys. He directly got the signature. What about the approval of the financials? Even without getting the financials approved by the board of directors, he straight away got them signed. This is definitely going to be incorrect over here, not allowed. Then, audit was conducted by a team led by Mr. Rock. In the firm, there were two partners, right? Rock and Aman. So the audit was done by a team led by Mr. Rock, while Mr. Aman, he signed the audit report on behalf of the firm. That is okay, guys. Any partner, if you are a chartered accountant, you can act and sign on behalf of the firm. So even though the team led by Mr. Rock conducted the audit, it's okay if Aman is signing the audit report, that is fine. Referring to the above provisions, answer each of the following. Has the board complied with the relevant provisions? Clearly no. Why no? Because the financials were not even approved. Without even getting approved, they straight away got it signed. So therefore, there's definitely a violation over here. And secondly, can Mr. Aman sign the audit report? Yes. If he's a chartered accountant, then he can sign. Any partner who's chartered accountant can act and sign on behalf of the firm. So if Mr. Aman is a chartered accountant, then yes, he can sign on behalf of the firm. Okay, this was one small question, and then comes one last descriptive question, guys. One more question from your auditor's chapter. This is regarding casual vacancy. It's a straightforward theory question only. The question is saying, Mr. Ram is the auditor of XYZ Limited, which is a government company. He has resigned on 31st December 25. So death, removal, disqualification, resignation, all this will result into casual vacancy. So if there's casual vacancy, how will this casual vacancy be filled? It all depends upon, is the company a government company or is it a non-government company? If it happens to be a non-government company, then in that case, the casual vacancy will be filled by the board of directors. Within 30 days, the board of directors will appoint another auditor in the place of the auditor who has just vacated the office. Okay, but in case casual vacancy is because of resignation, then there's an extra responsibility, and that is same thing. Within 30 days, the board will fill the casual vacancy. But however, there's extra formality, and that is we need ratification, we need approval from the company within 3 months by passing an ordinary resolution in the general meeting. Alright, now what if the company happens to be a government company or a company which is owned or controlled by the government? In that case, the casual vacancy will be filled by the C&AG within 30 days. Only if the C&AG does not fill the casual vacancy within 30 days, only then in the next 30 days, the board will fill the casual vacancy. In government companies, no special treatment for resignation and all, same process only. And what will be the term of the casual vacancy auditor? The casual vacancy auditor, his term will be till the conclusion of the next AGM, that's all. Okay, so when there's a casual vacancy in the office of the auditor, either because of death or disqualification or resignation or removal, you will check is it a government company or a non-government company. In government company, it is very simple. Government company, the casual vacancy will be filled by the C&AG within 30 days. Only if the C&AG does not fill within 30 days, only then the board will step in and they will fill the vacancy in the next 30 days. Okay, no special treatment for resignation. If it's a non-government company, then the board will fill the vacancy within 30 days. If the vacancy was because of resignation, then extra formality we have, and that is we also need the approval of the shareholders. We also need the ratification of the shareholders within 3 months by passing an OR in the general meeting. And whether government company, whether non-government company, doesn't matter what is the reason for the casual vacancy. Whenever a casual vacancy auditor is appointed, his term will be only till the conclusion of the next AGM. Okay, so straightforward theory question this was. And then coming to one final question in your auditor's chapter. It's a case-based MCQ, guys, small question only, relating to one simple point, and that is a body corporate cannot be appointed as an auditor. A company cannot be appointed as an auditor. But however, LLP, yes, it is a body corporate, but it is an exception. It can be appointed as an auditor. Okay. Now have a look at the question. The question says, Devika Constructions Limited is due to appoint a statutory auditor. Board shortlists 3 options. Mr. Arjun Malhotra, a practicing CA in individual capacity. Yes, he can be appointed as an auditor, guys. A chartered accountant, a practicing chartered accountant can be appointed as an auditor. Then, Case and Associates LLP with 3 partners, all chartered accountants. See, it's an LLP. It's a body corporate. But even generally, a body corporate can't be appointed as an auditor. But LLP is an exception. Even though it's a body corporate, it can be appointed as auditor. Then, Fin Plus Advisory Private Limited. It's a company. See, I don't care who are the members in the company, who are the employees in the company. I don't care. A company is a body corporate, and body corporate cannot be appointed as auditor. So only Arjun Malhotra, KS and Associates can be appointed. So who is eligible to be appointed as statutory auditor? Option C, both Mr. Arjun Malhotra and KS and Associates LLP. Option C. Alright guys, so this was your discussion on the auditors chapter, and next comes a very important question from a September 25 question paper relating to companies incorporated outside India. From this chapter, only one question I'm discussing with you, and that is this big huge case-based MCQ. Without any tension, without any worry, patiently, we will first do a quick discussion of the concepts and then we will take up this question. So come on, let's begin with section 382. Now section 382 talks about two things. Thing number one, let's say we have a foreign company. Foreign company may or may not have a physical place of business in India. Let's say this foreign company has a physical place of business in India. Outside that place of business in India, one name board has to be put. On that name board, 3 things we have to write. Number 1, the company's name. Number 2, the country of incorporation. And number 3, whether the liability of the members is limited or not. And all this has to be written both in English language also in the language of that particular locality, the local language basically. Okay? Point number 1, easy. Then point number 2, this company will have all these business letters, bill heads, letter paper, official publications and all. On that also, the same 3 things have to be mentioned, guys. Company's name, country of incorporation, whether the liability is limited or not, same thing has to be mentioned, but this has to be mentioned only in English language. Easy? Yes. So in the name board, the outside every place of business, that has to be in English also, in local language also. But bill head, the letter pad, the official publications, notices, same 3 information will be put in both the places, but in the business letters, bill heads and all, only English language is sufficient. This is my first concept. Then coming to my second concept, section 389. Section 389 says, a company which is incorporated outside India, yes, you can come to India and you can issue a prospectus. Multiple conditions are there. The prospectus has to be filed with ROC New Delhi. Then to that prospectus, multiple documents have to be attached, like the expert's consent, the contract for appointment of MD or manager, other material contracts, underwriting agreement, power of attorney. All this has to be attached to the prospectus. Alright, so yes, a company incorporated outside India can issue a prospectus in India, but however, it has to be filed with ROC New Delhi. Multiple conditions have to be fulfilled. One of those conditions is that multiple documents have to be attached to the prospectus. Okay. Then listen to the next point. If the company happens to be a foreign company, then provisions of chapter 22 will apply on this company. That is section 380 to section 393 will apply on this company. But however, if in this foreign company, at least 50% of the paid up share capital, whether equity, whether preference or both, whatever, if at least 50% of the capital is held by Indian citizen or Indian company or both, either singly or in aggregate, then in that case, this section 380 to section 393 will anyways apply. In addition to that, the whole of the Companies Act 2013 will apply on its Indian business as if it were a company incorporated in India. So generally, foreign company section 380 to 393 will apply. But in this foreign company, if at least 50% of the capital is held by Indian citizen or Indian companies and all, either singly or in aggregate, then these sections will anyways apply. In addition to that, with respect to its Indian business, even the entire Companies Act will apply as if it's a company incorporated in India, as if it's an Indian company, but only with respect to its Indian business. Okay, now come on, let's begin reading the question. The question says, Mr. Lepang is an Indian having knowledge of tea farming. He went to China in the year 2006 and he established his tea manufacturing business by the name of Sweet Leaf Limited. So the Sweet Leaf Limited is a Chinese company, guys. He has set up this business in China. It's a Chinese company. Business has grown since then and he has been persistently trying to connect to his original roots in India. Then comes another company, Kadak Chai Limited. It's an Indian public limited company established in Darjeeling, owning 2 tea estates and engaged in the manufacture and sale of Darjeeling tea throughout the country. So, Sweet Leaf Limited is a Chinese company and Kadak Chai Limited, this happens to be an Indian company. Okay, then what happened? On 20th June 24, Kadak Chai Limited was bought by Sweet Leaf Limited for redesigning the existing production facility and expand the cultivation and processing of flavored tea by Mr. Lepang. So, Sweet Leaf Limited has now become the holding company, and this Indian company, Kadak Chai Limited, has become the subsidiary company. How? Because the question clearly says Kadak Chai Limited was bought by Sweet Leaf Limited. So, the Indian company, Kadak Chai Limited, has now become a subsidiary company of a Chinese company. Then what happened? The above production facility, earlier owned by Kadak Chai Limited, gained the status of foreign company. Now we have to understand this properly. You tell me, just because my company, just because my Indian company has become a subsidiary of a Chinese company, because of that reason alone, can I say that this Indian company is not existing anymore and this Chinese company becomes a foreign company? Can I say like that, guys? No, I'll help you understand. Listen to me. No tension, slowly we will see. So let's say we have a Chinese company over here, and this is a holding company. And then we have another Indian company, let us say, which is a subsidiary company. Now, just because my Indian company is a subsidiary of a Chinese company, does it mean that my Indian company will cease to exist? No, right? It is still a company. It will still continue to exist, just that it is a subsidiary of the Chinese company. Then tell me, just because a Chinese company has subsidiary in India, because of this reason, can you say that this Chinese company is a foreign company? No, right? Foreign company means, number one, you should be incorporated outside India, and number two, you must have a place of business in India. Now, just because you are a holding company with an Indian subsidiary, I cannot say that the Indian subsidiary has become the place of business of the Chinese company in India. So, just because you are a holding company of an Indian subsidiary company, you will not become a foreign company. But however, the question says the production facility earlier owned by Kadak Chai Limited gained the status of foreign company. Now we have to somehow interpret this question so that we are able to understand it in the right manner. The only interpretation that is possible over here now is that here they had mentioned, right, that the company, Indian company, had 2 tea estates. It had a production facility in India. Now that production facility is maybe taken over by the Chinese company, because of which now this Chinese company, yes, it is a company incorporated outside India, and now yes, it has a place of business in India. I am not saying that Kadak Chai Limited is a place of business in India. No, Kadak Chai Limited had some production facilities. Those production facilities have gone to the Chinese company, and because of that, those production facilities have become the place of business of the Chinese company in India. And now this Chinese company has attained the status of a foreign company. How? It's a company incorporated outside India, and it has some production facilities in India. The question says production facilities were earlier owned by Kadak Chai Limited, which means now they are owned by Chinese company, by Sweet Leaf Limited. So therefore, the Chinese company is a company incorporated outside India. It has some place of business in India in the form of production facility, which it has purchased from Kadak Chai Limited, and therefore Chinese company Sweet Leaf Limited now becomes a foreign company, and it has filed Form FC1 declaring the details of incorporation with ROC New Delhi. Actually, it should have been filed with Central Registration Center, New Delhi, and not with ROC New Delhi. Then the question says, as a result of the acquisition, details of the company, including the new name and address of the head office, were updated outside the office of the acquired company at Darjeeling. Details were mentioned in English, Mandarin, and in local language Assamese. Is it correct, guys? Yes, outside the place of business, we have to put the company's name, in country of incorporation, and the liability of members, both in English language, this part, both in English language and also in the local language. They have done that, guys. They've put it in English language and also in the local language Assamese. So perfect compliance of provisions. Then what happened? The Indian subsidiary updated the above details in other documents, including business letters, bill heads, and letter paper, in English language only. This is also perfect. In the letterhead and all, it has to be in English language only anyways. Then what happened? The legal team made an objection on such non-usage of local language and Mandarin. It further suggested that other than the provisions of Chapter 22 of the Companies Act, no other provision in the aforesaid Act would be applicable to such newly registered foreign company situated at Darjeeling. Let's talk about this now. The legal team is saying two things. Legal team is saying, number one, that on the letterhead and all also, the local language should have been used. This is not required, guys. What the legal team is saying is wrong. On the letterhead and all, only English language alone is enough. Then one more thing they're saying that on this foreign company, only Chapter 22 will apply, nothing else will apply. See, listen. Yes, if it's a foreign company, no doubt, Chapter 22 will apply. But see, this foreign company, this Chinese company, it is owned by whom? It was established by whom? By Mr. Lepang, who is an Indian. So, which means in this foreign company, at least 50% of the shares are held by an Indian. Let's say Indian citizen, guys. So therefore, this company, this foreign company, Sweet Leaf Limited, becomes a company fitting under Section 379 subsection 2. So not only will Chapter 22 apply to this company, also the whole of Companies Act will apply with respect to its Indian operations as if it were an Indian company. So even this sentence, even this statement of the legal team is wrong. So till here, are you understanding? Yes, so point number one, we have a Chinese company, Sweet Leaf Limited. This Chinese company has purchased shares in an Indian company, Kadak Chai Limited. So the Chinese company has become holding company and Kadak Chai Limited, the Indian company, has become subsidiary company. Then the Chinese company has purchased some production facilities of the Indian subsidiary in India. So now the Chinese company has a place of business in India. So now it becomes a foreign company. It has filed FC1 and all. Then outside the place of business in India, it has correctly put the name board in English language also, in local language also. In the letterhead and all, correctly it has put all the information only in English language. And because it is a company, because Sweet Leaf Limited is a foreign company with at least 50% of the capital held by an Indian citizen, not only will Chapter 22 apply to this company Sweet Leaf Limited, but also the whole of Companies Act will apply, but only to the extent of its Indian operations. Okay, then continue reading, look at what has happened. The foreign company has recently entered into a contract with Speed Robotics Limited, engaged in the manufacture of robotic machinery and other facilities to be installed in tea processing plant to enhance the pace of production. The foreign company has planned to raise money in India through the issue of Indian depository receipts. The Indian depository receipts are thus planned to be issued by DDL Bank to act as depository bank to such instrument. As the IDR is a new issue, the same must be accompanied with a prospectus. So prospectus related provisions are coming into the picture now. The prospectus contains details of the company, its board of directors and other annexures, including the comments of Mr. Jack, an expert in the field of finance. Yes, see, first of all, it's a foreign company. First of all, can a foreign company issue a prospectus in India? Yes, if it's a company incorporated outside India, it can issue a prospectus in India, just that some conditions have to be fulfilled. Can it contain expert statement also? Yes, it can contain an expert statement also. Then look at this. Mr. Renzo, one of the members in the legal team at the Darjeeling production facility, has suggested that the prospectus for issue of such IDR should also contain details of the contract entered in with Speed Robotics Limited and the copy of power of attorney, as the above prospectus has been signed by Mr. Rick on behalf of the directors. So the legal team is saying that the prospectus should also contain details of the contract signed with Speed Robotics Limited and power of attorney. Is this contention, is this suggestion right? It is definitely right. Just now we learned over here that to the prospectus we have to attach other material contracts. We also have to attach the copy of power of attorney. So yes, what Mr. Renzo is saying is perfectly right. Then what happened? The officials of the head office have opposed inclusion of the details as above on the pretext that the same is not required as per law. Prospectus thus drafted has been sent to ROC New Delhi. Correct, guys? Prospectus has to be filed with ROC New Delhi only, not CRC. See, only FC1. Only this has to be sent to CRC New Delhi. Everything else has to be sent to ROC New Delhi only. Okay. Now come on, let's have a look at the questions one by one. The first one, whether the legal team was correct in suggesting that only Chapter 22 will apply. No, this we discussed, right? Only Chapter 22 will not apply. Instead, In this question, in Sweet Leaf Limited, at least 50% of the capital is held by Mr. Lepang, an Indian. Therefore, not only will Chapter 22 apply, but also the whole of Companies Act will apply to the extent of its Indian operations as if it's an Indian company. So, only Chapter 22 will apply is wrong. So, look at the correct option now. Legal team is correct? No. Legal team is incorrect as Chapter 22 will not apply to foreign company? No. Legal team is incorrect as provisions of Chapter 22 shall apply to the Chinese company with no applicability of the foreign company in India. Wrong. Then finally, legal team is incorrect as Chapter 22 will apply to the foreign company along with other provisions as may be prescribed regarding the business carried on by it as if it were an Indian company. Option D. Chapter 22 will anyways apply. In addition to that, the other Companies Act provisions will also apply on its Indian operations as if it were an Indian company. Okay, then look at the second subdivision over here. Whether the act of mentioning the name of the newly formed foreign company and other details outside the office in English, local and Mandarin, as well as on the other documents including business letters, only in English, is it in compliance? This we concluded that yes, it is in compliance. In letterheads and all, only English is required. Local language and all is not required. So, name of the company has been correctly written in English, but even other documents should mention in all three languages. Wrong. Name of the company has been correctly written in English, local, and Mandarin. Other documents can mention the details in English only, and there is no requirement to use other languages. Option B. Only on the name board we have to use English and the local language. But however, on documents, only English language is enough. Then comes the third question. Choose the correct option from the following on the validity and adequacy of the details mentioned in the prospectus prior to the issue of IDR. So in the prospectus, we concluded that the material contract and the power of attorney also has to be attached. So details mentioned in the prospectus about the company and other credentials including non-filing of power of attorney are correct and sufficient. No, they are not correct. We should be attaching the other documents like the contract and the power of attorney. So option A is not correct. Option B. Details of the contract with Speed Robotics Limited as well as the copy of power of attorney should be mandatorily annexed along with other documents without which the above prospectus shall be rejected by ROC New Delhi. Correct, guys? To the prospectus, we have to attach all these documents which will include the material contract. It will also include the power of attorney. So option B is correct. Alright, so this was your nice big huge question with respect to your companies incorporated outside India, touching upon multiple points. All these small points. Point number 1, what has to be exhibited outside the place of business in India, in how many languages? Then on the letterhead, what has to be printed in how many languages? Then when the company incorporated outside India issues a prospectus in India, to that prospectus, what has to be attached? And finally, which sections will be applicable to foreign companies? Alright guys, nice learning experience. Now come on, let's move on. Now what we will be doing next is some 4 to 5 case-based MCQs I have, okay? They are mixed questions, which means they will be relating to Companies Act, but they will involve concepts and questions from various chapters in Companies Act. So those kind of questions I've combined together under this heading mixed. We'll see them one by one over here. Okay. This first question is from a September 25 question paper. It touches upon share capital chapter also, accounts of companies chapter also. Very interesting question, but nothing to worry. Easy question only. I'll quickly explain the concepts involved and then we will start reading the question. So in this question, guys, there are 3 concepts involved. The first concept is about your holding subsidiary company. The second concept is from your prospectus chapter and third is from share capital chapter. Okay, simple concepts only. Point number 1, can a subsidiary company hold shares in the holding company? No. Section 19 prohibits it. In case holding company, any shares of the holding company, if they are allotted to the subsidiary company, it will become void straight away. Alright. But however, there are 3 exceptional cases where a subsidiary company can hold shares in the holding company. Number 1, as a legal representative of a deceased member. Number 2, as a trustee. And number 3, even before the holding subsidiary relationship was formed, even before that, if the subsidiary already had some shares of the holding company, it can continue to hold these shares. So in these 3 situations situations alone, the subsidiary company can hold shares of the holding company. Okay, out of these three situations, in the first two situations, that is, whether a subsidiary company is holding shares in the holding company, either as a legal representative of a deceased member or as a trustee. In these two cases, the subsidiary company will also enjoy voting right in the holding company. But in the third situation, where we're talking about the old shares which were held by the subsidiary company in the holding company, even before the holding subsidiary relationship was formed, for those shares, the subsidiary company cannot exercise any voting rights in the holding company. This is the first concept, simple concept. Then information memorandum, you already know about this, guys. Shelf prospectus, we had spoken about this. We know that shelf prospectus has a validity period of 1 year. In this 1 year, company can make any number of issues. Again and again, prospectus is not required. The same prospectus will be applicable, just that the company has to prepare an information memorandum containing the details of all the changes that have happened since the last prospectus was issued. Now, in the information memorandum, we have to put details about the new charges created, any changes in the financial position, and other changes. Basically, whatever has already been written in the shelf prospectus need not be written here again, guys, in the information memorandum. Only changes which have happened since the time the last prospectus was issued, only those changes have to be mentioned over here. Okay. Then there's one more concept with respect to section 48, which deals with variation of rights of shareholders. See, the company can vary the rights of a particular class of shareholders. For that, the company has to fulfill one prerequisite. Company has two options. Either option number one, either the company will call a separate meeting of just those shareholders whose rights the company wants to vary and ask them to pass a special resolution, or option number two, no need to call a meeting. Ask the shareholders to stay where they are. Just ask those shareholders to send written consent. In that case, the company has to get written consent of shareholders put together who are holding at least 3/4 of the shares of that particular class. Alright. Understanding? Like, for example, let's say company wants to vary the rights of just preference shareholders. So either the company will call a separate meeting of just the preference shareholders and ask them to pass a special resolution, or the company will ask the preference shareholders to stay at home, just on written consent. In that case, we need written consent of preference shareholders put together who are holding at least 3/4 of the preference shares. Okay. Now, sometimes what happens is, let's say there's one particular class of shares. Company wants to vary their rights, but because of varying their rights, maybe another class is also indirectly getting affected. Like, for example, when the company is changing the rights of preference shares, because of that variation, the equity shares also may indirectly get affected. In that case, if some other class is also getting indirectly affected like this, then the company shall get consent of 3/4 of the shareholders of that other class also. Okay, that's all, guys. These are the three concepts involved in this question. Now, come on, let's have a look at the question. Easy question only. The question says, Adolescent Limited, a public company, is an Indian multinational retail company focused on infant, maternity and childcare products. Company was founded in 2009. Headquarter is in Valsad, Gujarat. It sells products through its website, mobile app and 256 stores, yeah, which operate under Busy Baby and Brainy Baby brands. It has a paid up capital of 126 crores in equity shares issued at a premium of 6 rupees per share. It has 112 crores in preference shares redeemable after 7 years. So all this information is about Adolescent Limited. The only thing that is relevant for me is it's a public company. It has paid up share capital of 126 crores and 112 crores of preference shares. That's it. Then the question says, after this, Toddler Limited, another Gujarat-based company, was founded by Mr. Toddler, an Anglo-Indian gentleman with no legal heir. Toddler Limited was engaged in the manufacture of medicine specifically focused to children under the age of 3 months. Adolescent Limited acquired 100% equity in Toddler Limited in 2011, thereby becoming holding company. So what has happened now? Adolescent Limited has become the holding company and Toddler Limited has become the subsidiary company, guys. Then what happened? In 2024, Mr. Toddler purchased 5% stake in equity shares of Adolescent Limited. Nothing wrong, guys. Toddler Limited is not buying shares in Adolescent Limited. If that had happened, you would say it is void, void, void. But here, Mr. Toddler, one of the shareholders of Toddler Limited, he is purchasing shares in the holding company. That is fine. He is purchasing shares in his individual capacity. That is fine. Now, this Mr. Toddler, he purchased 5% stake in Adolescent Limited and he decided to assign trustee rights to Toddler Limited, which would take care of his stake after his death, as he did not have any legal heir. In July 24, Mr. Toddler died, leaving behind the company as well as 5% stake in Adolescent Limited. So tell me guys, what has happened now? Mr. Toddler was a shareholder of Adolescent Limited and he did not have a legal heir. So, because he did not have a legal heir, he gave trustee rights to Toddler Limited. So, now after his death, Toddler Limited will become a shareholder of Adolescent Limited, guys. Those 5% shares which Mr. Toddler had purchased in Adolescent Limited, those shares will come to Toddler Limited now. Now, Toddler Limited is holding these shares in the holding company as a legal representative of deceased Mr. Toddler, as a trustee. So, therefore, yes, Toddler Limited can hold these shares in Adolescent Limited. The subsidiary company can hold these shares in the holding company. It's coming under the exceptions, and even voting rights also Toddler Limited can enjoy in Adolescent Limited with respect to this 5% stake. Okay, then what happened? Toddler Limited, being the trustee of the 5% stake of Mr. Toddler, claimed its stake in the shares earlier held by late Mr. Toddler. Mr. Quick, one of the directors of Adolescent Limited, opposed the transmission of shares to Adolescent Limited held by Mr. Toddler to its subsidiary company on the plea that subsidiary company cannot purchase shares of the holding company with voting rights. This contention of Mr. Quick is definitely wrong. No doubt, subsidiary company cannot purchase shares in holding company. But as a trustee, subsidiary company can hold shares in the holding company. It is allowed, and they will also be able to enjoy voting rights also. So there's nothing wrong over here. So what Mr. Quick is saying that subsidiary company cannot hold shares in the holding company as a trustee. His contention is not right. All right, then continue reading what has happened. The question says Adolescent Limited is planning to enhance its production capacity by installing plants in various parts of the country, including Jamnagar, Pune, Hisar, and other industrial cities. The banks have refused to fund the projects, and hence the company is planning to raise money from the public by issuing fully paid equity shares. Shelf prospectus was issued to raise 76 crores from the public for the Jamnagar plant in December 24. The prospectus has mentioned the contracts entered by Adolescent Limited for development of the plant in Jamnagar. So Adolescent Limited is issuing a shelf prospectus. It wants to raise 76 crores, and in the shelf prospectus it has put all the details about the Jamnagar plant. Then what happened? Meanwhile, Adolescent Limited is also planning to commence the development of Hisar plant in Jan 25, thereby raising 95 crores through the same shelf prospectus. So it needs some more money. See, listen, when was the shelf prospectus issued for the first time? In December 2024 it was issued. Okay, now this shelf prospectus will have a validity period of 1 year. In Jan 25, company again needs money. Company again needs 95 crore rupees. This is for the Hisar plant. Again, prospectus is not required. The same shelf prospectus itself will be applicable, just that information memorandum has to be prepared. Information memorandum was thus issued containing details of the contract for the development of the Hisar plant with no mention of the earlier contract for Jamnagar plant. The registrar rejected the information memorandum as incomplete. What do you think, guys? See, in December month, the company issued the shelf prospectus because the company wanted to raise money for the Jamnagar plant. So in the shelf prospectus, already all the details are mentioned about the Jamnagar plant, guys. Now in the month of Jan 2025, the company again wants to raise money for its Hisar plant. And about the Hisar plant, it has mentioned in the information memorandum. But in this information memorandum, tell me, do they also have to put information about the Jamnagar plant? No, right. In the information memorandum, we only have to put the details about the changes. Since the last prospectus, what are the new developments? Only that has to be mentioned over here. The same thing which is mentioned in the shelf prospectus need not be mentioned again. Then don't you think if I force the company to do that, then the whole objective, the whole benefit of shelf prospectus vanishes, guys. So that is why the registrar has rejected the information memorandum This is wrong. The information memorandum is perfectly valid only over here. There's nothing wrong with the information memorandum. It will contain new changes only, new details only. Why should it mention about the old details of Jamnagar plant? Okay, then the question says Board of Directors of Adolescent Limited has called a meeting of preference shareholders of the company to resolve upon changing the conversion ratio of preference shares into equity shares, which means Adolescent Limited wants to vary the rights of the preference shareholders, guys. Meeting was called. Consent in writing favoring such variation has been obtained from preference shareholders worth 84 crores, although a special resolution could not be passed. So, special resolution could not be passed, but however, we got written consent from preference shareholders worth 84 crores. See, guys, either we have to get a special resolution or we need written consent of at least 3/4 of the shares. Now, in this question, if you see how many preference shares does the company have? 112 crore rupees. So, 112 crore rupees into 3/4 will be how much? This is going to be exactly 84 crores, okay? And we got written consent of preference shareholders holding 84 crore rupees of shares. So, therefore, yes, the condition is fulfilled. Either SR has to be passed or we have to get written consent. Question says we were not able to pass SR, but we were able to get written consent of shareholders holding at least 3/4 of the shares. Yes. So, therefore, the resolution has, therefore, this prerequisite has been fulfilled. Then what happened? No separate consent of equity shareholders was obtained, despite that they argued such conversion will cast an effect on their rights as well. So what is happening, guys? Company actually wants to change the rights of the preference shares, but indirectly because of this variation, my equity shareholders are also getting affected. So in such case, company has to get consent of the 3/4 of the shareholders of this other class also, but the company has not obtained this consent. Okay, then the equity shareholders on the other hand argued that changing the conversion ratio would affect the number of equity shares that preference shareholders would receive after conversion, and hence have shown their dissent towards the above decision and are planning to apply to the NCLT for redressal of their grievance. Of course, they can apply. If because of this variation, some other class, equity shareholders in our example, if they are also getting impacted, then company needs their consent also. If company is not getting their consent, they can go to the NCLT and they can submit their dissent to the NCLT. Now, come on, have a look at the MCQs one by one. The first question says whether in the current scenario, Toddler Limited can become the assignee to the shares of Adolescent Limited in transmission from Toddler after his death, as well as get voting rights. We've already concluded this, guys. No doubt, subsidiary company cannot become a shareholder of holding company, but as a trustee, it can become a shareholder and it will also enjoy voting rights. So, come on, let's see the option. Toddler Limited can enjoy the rights of an assignee or legal representative, but would not get voting right. Wrong. He will get voting. The company will get voting right also. Second option. Toddler Limited can enjoy the rights of assignee or legal representative, but and would also get voting right. Yes. Option B. As a trustee, subsidiary company can become a shareholder in the holding company and will also get voting rights. Okay. Then comes the second question. Whether registrar is justified in rejecting the information memorandum. No, guys, he was not right. Remember, we discussed about it. Information memorandum should only contain new details. Why should it contain details about the Jamnagar plant, which is already mentioned in the shelf prospectus? So, information memorandum was correct only. Registrar, he wrongly rejected the information memorandum. So, registrar is incorrect. So, which option is correct now? Registrar is correct, is wrong. He is incorrect. Registrar cannot reject the information memorandum as the same has been correctly filed with details of the latest contract. Sounds right, but let's see the other options also. Registrar is correct is definitely wrong. Registrar is incorrect. He is not justified in rejecting the information memorandum. Registrar is incorrect as there is no requirement for issue of shelf prospectus for any money raised within a period of 1 year. Wrong. So option B. The registrar cannot reject the information memorandum as it has been correctly filed with the details of the latest contract. It should only contain the new changes. It need not contain the old information which is already there in the shelf prospectus. Okay. Then comes the third question, whether Adolescent Limited be allowed towards variation of class rights of preference shareholders, considering the fact that SR could not be passed. See, even though SR could not be passed, we did get written consent from at least 3/4 of the preference shares. So this condition was fulfilled. However, another class, equity shareholders, were also getting affected because of the variation, and we were not able to get their consent. So because of that reason, the variation will not be right. So let's see the options. ROC shall not order variation as SR has not been passed. SR is not the reason. ROC shall not order the variation as, although the requisite number of preference shareholders have agreed, but consent of dissenting equity shareholders has not been obtained, whose rights are affected by such variation. Option B. So even though we did get the written consent of the preference shareholders, we did not get the consent of the equity shareholders, and for that reason, the ROC will not allow variation. Understanding. So this is going to be your third question, option number B. Right? Nice question, guys, covering three concepts, your section 19, information memorandum, and section 48. Alright, so can I take you forward now? Can we go to the next question, question number 36? Now see, question number 36 is a very easy question. It just tests us upon three very simple concepts. Let me discuss them with you. The first concept is from your management and administration chapter, section 88. See, what are the places or where can the company keep the register of members? Three options company has. Either the company can keep the register of members at the registered office itself, or the company can keep the register at any other place but in the same city, town or village where the registered office is situated, or the company can keep the register of members in some other city where more than 1/10 of the members reside, provided it is in India. Right, guys? So company has three options, either in the RO itself or any other place but in the same city where RO is situated, or any other city in India where more than 1/10 of the members are living. Okay. Now, in case the company wants to keep the register of members in option 2 or option 3, then for that SR has to be passed. This is my first concept. Then comes the second concept, term of auditors. See, if the company is appointing an individual auditor, the individual auditor can be appointed only for one term of 5 years. If the company is appointed a firm, a partnership firm or an LLP firm as auditor, that can be appointed only for 2 terms of 5 years each. After that, we have a mandatory cooling period of 5 years, guys. In that cooling period of 5 years, we can't appoint the same firm. We also cannot appoint some other firm with a common partner and all. And this concept of cooling period is not applicable for every company. It's only in listed companies and other specified companies. Okay, so individual 1 term of 5 years and firm 2 terms of 5 years each. After that, mandatory cooling period of 5 years. Alright. Then comes to the next point, any company, whether it's a public company, whether it's a private company, whether eligible company, whether ineligible company, any company, every company can accept deposits from members. Okay, but however, when you are accepting deposits from the members, the company has to get a certificate from the statutory auditor. That certificate will either say that company has never defaulted with respect to repayment of deposits, or by chance in the past the company has committed a default, then the auditor should mention in the certificate that yes, the company did commit a default, but the default was rectified, and since then 5 years have lapsed. So in simple words, if the company wants to accept deposits from members, either the company should have never committed any violation with respect to deposits, or if the company did commit a violation in the past, then the company should have rectified the default and the company should wait for 5 years. Only after that only the company can accept deposit from the members, and for this a certificate from the statutory auditor is required. So three concepts, guys. One from your management and administration chapter regarding the place where the register is kept, then another concept from your auditors chapter about the cooling period, and another concept from your deposits chapter that either the company should have never defaulted with respect to deposits, or if the company has defaulted, then company wait. First rectify the default, then wait for 5 years. After that only you can again start accepting deposit from members. Okay. Now come on, let's read the question. And also this question does have one small adjustment with respect to private placement also that I've already discussed with you. Let's see if you are able to remember or not. Okay, so the question says Neo Technologies Limited, a listed company, was incorporated in the year 2010. It has a share capital of 100 crores and turnover 200 crores. Company plans to raise capital through private placement. So company wants to do a private placement. Board identifies 180 individual investors and passes a special resolution in the meeting. Correct. Whenever the company wants to make a private placement, the company can make the offer to maximum 200 persons per financial year per security. When you're counting 200 persons, you will not count qualified institutional buyers and employees who are being given shares under ESOPs. Okay. And if the company wants to do a private placement, yes, of course, prior SR is required. In the same financial year, company also offers shares to 25 mutual funds, qualified institutional buyers, and grants stock options to 30 employees. So, 180 individual investors plus 25 qualified institutional buyers plus 30 employees, guys. Company has made private placement offer to so many people, but I will not count the qualified institutional buyers. I will not count the employees. I will only consider the balance, which is 180 only, which is within 200 only. So therefore, it is definitely within the limit. Okay, the manager of the company objected to the allotment of shares as total number exceeds the permissible limit. No manager, you are incorrect. The private placement is perfect only, it is within 200. Then what happened after this? Let's continue reading. The company has registered office in Mumbai, Maharashtra. So this is where the registered office is. The company maintains its registers at the RO by default. Last year, the company opened a branch office in Hyderabad. So company's registered office is in Mumbai, but the company has a branch office in Hyderabad. The total shareholders on record of the company are 21,000. Total number of shareholders in the company 21,000. Out of this, 2,160 shareholders are living in Hyderabad. Management believes that maintaining the register of members at Hyderabad office is not a good idea, as in order to maintain the register, at least 1/4 of the shareholders should be living in Hyderabad. Wrong. Just now we learned section 88. Either the register has to be kept in the registered office in Mumbai itself, or it can be kept in any other place but in Mumbai itself, or it can be kept in any other place in India, for example Hyderabad, where more than 1/10 of the members live, guys. Company has 21,000 members. 1/10 would be 2,100 members. 2,160 members, more than 1/10 are living in Hyderabad. So company can keep the register in Hyderabad also, guys, provided of course a special resolution is passed. So the management is saying that no, we can't keep in Hyderabad because 1/4 is not living in Hyderabad. 1/4 number is not correct, management. 1/10 number is correct. Okay, then what happened? Company appointed Arun and Co., a chartered accountancy firm, as the auditor for 2 terms of 5 years each. So they appointed a firm. Company is a listed company. So because it's a listed company, this whole drama of cooling period and all will apply. They appointed a firm. Firm can be appointed for 2 terms of 5 years each, total 10 years. After that, mandatory 5 years cooling period. So they appointed Arun and Company, a firm, as auditor for 2 terms of 5 years. Correct only. Firm has 2 main partners, CA Rajan Mehta and CA Nupur Jain. Then for 24-25 to 29-30, company wanted to appoint Jain and Associates. So first the company has appointed Arun and Company for 2 terms. Now cooling period. In cooling period they want to appoint Jain and Associates. However, it was later noted that CA Nupur Jain is a sleeping partner in Jain and Associates. So now tell me, guys, can we appoint Jain and Associates in the cooling period? We can't appoint, right? Because in the cooling period, the incoming auditor should not have any common partner with the outgoing auditor. Whether sleeping partner or active partner doesn't matter. We are having a common partner, and hence Jain and Associates is ineligible to be appointed as auditor in the cooling period. Board is of the view that since CA Nupur Jain is a sleeping partner, there should be no issues in continuing the service. This is definitely wrong. In Jan 25, company decided to accept fresh deposit from members. Company in the past has defaulted on the repayment of deposit to its members in 2019. The company faced many financial difficulties. It successfully repaid all outstanding deposits and interest by March 21. So company committed a default in 2019. The default was rectified when? The default was rectified in March 2021. After it is rectified, company wait for 5 years. So March 21, after this company you have to wait for 5 years. Wait till March 2026. After that only you can accept more deposit from members. But guys, company is not waiting. Jan 25 itself company wants to accept deposit from members. Not allowed. Right? Company, if there's a default, you rectify the default, wait for 5 years, get statutory auditor certificate that 5 years you have waited, then only you can again start accepting deposit from members. So here again that's a violation. Okay guys, now come on, let's have a look at the questions one by one. The first question: considering the applicable provisions relating to private placement, which of the following statements is correct? For private placement, we had concluded that the offer was made to only 180 persons. Mutual funds, qualified institutional buyers, and employees and all we will not count, so it is proper only. So company has breached the 200% limit, wrong. Company has exceeded the limit, wrong. Company has not exceeded the 200% limit because QIB and ESOPs are excluded from the calculation of the threshold limit, correct. Option C. Then comes the second question: company defaulted on repayment of deposit but wishes to accept deposit from members again. What is a mandatory requirement before doing so? Rectify the default, wait for 5 years, get statutory auditor certificate, then only you can do it. So company must wait for 3 years, wrong, 5 years. Company must obtain statutory auditor certificate confirming that default has been rectified and 5 years has lapsed since then. Option B. Rectify the default, wait for 5 years, get auditor certificate, only then you can go ahead. So option B. Then third question: company completed 2 audit terms with Arun and Company, now wants to appoint Jain and Associates. CN Nupur Jain is a common partner. Which of the following best explains why Jain and Associates qualifies or disqualifies? It disqualifies, but what's the reason? Appointment of Jain and Associates would violate the provisions of Companies Act as a firm has a common partner with a retiring audit firm. So yes, it has a common partner, because of which Jain and Associates becomes ineligible. Even though it's a sleeping partner, doesn't matter. There's a common partner and hence Jain and Associates is ineligible. Then comes the fourth question, the last question. The board of directors are of the view that they should maintain a register at Hyderabad only if 1/4 of the members are residing there. Do you agree with the board's view, guys? No, not 1/4. It should be 1/10. So, yes, can't be the option. So, either A, C, or D. A says no, company can maintain the register at Hyderabad office without passing any resolution. Wrong. If you're keeping in place 2 or in place 3, SR is required. So option A is wrong. Then no, only after passing SR in the general meeting, register can be maintained in Hyderabad because more than 10%, that is more than 1/10 of the members are living over there. Option C. Okay guys, yes, so this was your question number 36, touching upon Prospectus chapter, private placement, management and administration chapter, section 88, auditors chapter, section 139 subsection 2, and finally even your deposits chapter. Alright, come on guys, come on, no slowing down, no slouching, it's fine. Just a few more questions, we will do it after reaching this stage. Don't give up guys, it will be stupidity, right? Come on, come to question number 37 now. Now, question number 37, guys, tests us on two concepts from 2 chapters. From your management and administration chapter, your e-voting concept, and from your accounts of companies chapter, a little bit about CSR. Okay, but one very unique way of solving this question is that, see, especially in law paper, this might work out sometimes wherein even if I ignore the whole story, okay, and if I straight away come to the questions, reading the questions itself, I will be able to give the answer even without reading the story. Same thing happened in if you ignore the September 25 question paper of law. In all the other question papers of law, if you see in the examination, the students did not really have to read the whole story in every question. Some questions maybe yes, but not in every question. So that is how even this question is, question number 37 that we're doing now. Even if I don't read the whole story, just by reading the questions one by one, I will be able to give the answer. Okay, I'll show you how. So first let me tell you the concepts involved. 2 concepts. One is section 108, e-voting. We already know some points about e-voting, guys. We know that if the company is a listed company or if the company has at least 1,000 members, then it has to mandatorily give e-voting facility to the members. And we also know that if the members are not able to vote electronically from home, then they can vote at the meeting. Even that option will be there. But if they have already voted electronically, they can still attend the meeting, but they can't vote again at the meeting. Okay, this is what you already know. Now, a few more points. The e-voting facility always has to to be closed on the preceding day 5 p.m. Like for example, in this question, let's say the meeting is being held on 14th August at 11:30 am. This is the date of the meeting. So preceding day, that is 13th August at 5 p.m, we will have to close the e-voting facility. Okay. And it has to remain open for minimum 3 days. So this is one point. The e-voting facility has to be closed on the preceding day at 5 p.m. and it should have stayed open for minimum 3 days. This is a minimum requirement. Okay. Then listen, in e-voting, right, there are going to be two events. First of all, there will be remote e-voting from home, and e-voting is always followed by general meeting also. So now don't you think there will be two kinds of votes, guys? Some votes which the members would have cast using remote e-voting, and some votes which the members were not able to cast by remote e-voting, so they came at the meeting and they voted at the meeting. So there will be two kinds of votes, no? Votes which were cast through remote e-voting and votes which were cast at the meeting. So how will all these votes get counted? For counting purposes and all, the chairperson will appoint a scrutinizer. Okay. Now this scrutinizer will first count the votes which were cast at the meeting. Then only he will count the remote e-voting votes. Okay. So first he will count the votes which were cast at the meeting. Then to count the votes which were cast through remote e-voting, we have to unblock the facility, guys, because preceding day at 5 p.m. the remote e-voting facility was blocked. So therefore the chairperson will now unblock the e-voting facility in the presence of at least two witnesses who are not the company's employees. So the point over here is 2 points. Point number 1. Whenever the company does remote e-voting, then in that case, it has to be closed on the preceding day 5 p.m. It has to stay open for minimum 3 days. Then point number 2, when once the whole voting is done, we will now have two kinds of votes. We will have number 1, votes which were cast by the members through remote e-voting, and number 2, we will have votes which were cast at the meeting. So the scrutinizer will first count the votes which were cast at the meeting. Then in the presence of at least two witnesses, he will unblock the remote e-voting facility and he will count the remote e-voting votes. Okay. Now when he's the witnesses over here should not be the company's employees. Understanding? So the remote e-voting will be unblocked in the presence of at least two witnesses who are not the company's employees. Alright. Then whenever section 108 e-voting is applicable, there's going to be general meeting also. So because it's going to be a general meeting also, there will be a notice of the meeting. Now that notice we also have to give as an advertisement in two newspapers, one vernacular newspaper and one English newspaper. So therefore a public notice also is applicable in e-voting cases. So no doubt we not only have to send notice to all the members of the company, just like how we generally send under section 101, that will anyways apply. In addition to that, a public notice also has to be given as an advertisement in two newspapers, one vernacular newspaper having wide circulation in the district where RO is situated, and one English newspaper having country-wide circulation. Okay, this public notice has to be given in the newspapers as advertisement when? After dispatch of notice to the members, but at least 21 days before the date of the meeting. So the sequence will be like this. First, the company will dispatch the section 101 notice to all the members of the company, guys. Then the company will publish this public notice as an advertisement in two newspapers, and only then the meeting is going to be held, the meeting of the shareholders. Okay, but this public notice has to be given in the newspapers at least 21 days before the meeting. Okay, 3 points with respect to section 108. Alright. Then about CSR, there's one small concept that is involved in this question. When you count, for CSR, in section 135, you have to calculate the net profit, right? In 2-3 places we need, like for example, we need the net profit, we need average net profit of the 3 preceding financial years. Then also in the 3 criteria, in the 3 limits, you have net worth, turnover, and net profit. Net profit should be at least 5 crores in the preceding financial year. So whenever you're calculating net profit for the purpose of CSR, we will always take net profit before tax. Before tax, net profit before tax, net profit before setting off losses and all. Also in the net profit, we will exclude profits from overseas branches, which means if the company has made any profit from foreign branches, we will exclude that profit. We will only consider the profit which the company has earned from India. Then also if in the profit any dividend is included which the company has received from Indian companies which are complying with CSR provisions, that dividend also has to be excluded. So when we are calculating net profit for the purpose of CSR, the net profit has to be before tax, before setting off of losses. Also from the net profit, we have to exclude 2 things. We have to exclude the profits of foreign branches. We also have to exclude dividend income from those Indian companies which have properly complied with CSR provisions. Balanced net profit only we should take. And lastly, in CSR, guys, you must have learned about this concept of ongoing project. You must have learned that if the company is unable to spend 2% of the average net profits in the current year, you will check why. Why? What is the reason? Why wasn't the company able to spend the 2% number? If it is because of an ongoing project, then in that case, company is supposed to transfer the money into unspent CSR account. All that you would have learned. Now, what is an ongoing project? Ongoing project means it's a multi-year project. Multi-year project means how many years? Maximum 3 years. If you ignore the year of commencement, maximum 3 more years. So total will become 4 years, guys. If I exclude the year of commencement, 3 more years. So total it will be for 4 years only, max to max. Alright. So these are the concepts involved in this question. Giving you one quick revision once again, giving you a revision of the revision because these were all those hidden areas which many of you might not be aware of. So giving you a revision of the revision, I hope it benefits you. Listen to me. Point number 1, e-voting facility always has to remain open for minimum 3 days and it has to be closed on the preceding day at 5 p.m. And then point number 2, where to count the votes in e-voting cases, the chairperson appoints a scrutinizer. There will be 2 categories of votes. Votes which were cast through remote e-voting and votes which were cast at the meeting. The scrutinizer will first count the votes at the meeting, then only he will count the remote e-voting votes. To count the votes cast by remote e-voting, first the remote e-voting facility has to be unblocked. It will be unblocked in the presence of at least 2 witnesses who are not the employees of the company. Then point number 3, in e-voting cases, it is followed by a general meeting. So a notice will anyways be sent to all the members under section 101, no doubt. In addition to that, after dispatching the notice to the members, the company also has to give a public notice in two newspapers, one English newspaper and one vernacular newspaper. This public notice has to be given after dispatching the 101 notice to the members. It has to be given as an advertisement in such a way that it is given at least 21 days before the meeting. Okay. Then after this we learned in CSR, whenever we calculate net profit, we always calculate net profit before tax and before losses. Also in this net profit calculation, we should ignore the profit of my foreign branches. I will also ignore the dividend income from those Indian companies which have properly complied with CSR. Okay. And finally, what is an ongoing project for CSR? A multi-year project, maximum 3 years. If I ignore the year of commencement, 3 more years it will take to complete the project. That is called as an ongoing project. Okay. Now come on, have a look at the question. This is a big, huge question, guys. The story is running into 2.5 pages. But however, I will not even read the story over here. The unique point, the best part about the question is, I will try reading the questions, the MCQs straight away, and that itself gives me all the information. So no point wasting my time in the examination reading the whole story. This is not possible in DT, but okay, don't do all these adventures in DT. You can do this in law, provided the question looks very detailed to you. If the MCQs look very detailed, then you can try solving the MCQs directly from the questions in case you feel you are a little short on time. Alright, look at the question. Superior Textiles Limited had clearly provided the time for opening and closing the remote e-voting for the ensuing AGM to be convened on Thursday, 14th August at 11:30 am. So this is the date and time of the AGM. At the RO, offering remote e-voting to remain open for 6 days. What would have been the timing for opening and closing the remote e-voting if the company had provided only the minimum required statutory period? As per the minimum required statutory period, the remote e-voting facility has to be open for minimum 3 days, guys. And it has to close on the preceding day 5 p.m. So if this is the date of the meeting, preceding day 5 p.m. would be what? 13th August 25, 5 p.m. it should close. And it has to remain open for minimum 3 days. So 13th August 25 will be one day, then 12th August 2025 will be another day, and 11th August 2025 would be another day. So the minimum statutory limit would be it should remain open for 3 days and it should close on 13th August at 5 p.m. So which option? Look at this now. The first option says opening would be 12th August. No, 12th August will be wrong. It has to open on 11th August. Then timing for opening would be 11th August 10 am and it will close on 13th August at 5 pm. Option B, guys. Option B, perfectly right. It has to remain open for minimum 3 days, 11th, 12th and 13th, and preceding day 5 pm it has to close. So 13th August 5 pm it will close. So option A. Option B. Then look at the second question. The case scenario given above states that for the year 24-25, net profit of Superior Textiles Industries Limited includes dividend amounting to 40,53,200 received from different companies. You are required to choose the best option out of the four given below as to how much amount of dividend shall be included in the net profit for applying specified percentage to work out the amount which is required to be spent on CSR. To compute the amount to be spent on CSR, I need the net profit number. In the net profit number, how much dividend will be excluded? Dividend from those Indian companies which have complied with CSR will be excluded. So come on, let's have a look at the options. Dividend amount exceeding 5%. There is no percentage in all. Dividend amount exceeding 7.5%. There is no percentage. No amount of dividend is excluded from net profit for applying specified percentage. Wrong. Dividend amount which was received from companies that are complying with CSR provisions is not needed to be included, which means should be excluded in the net profit for applying specified percentage. Option D. Dividend income which we have received from those Indian companies which are complying with CSR should not be included in the net profit, which means it should be excluded from the net profit. So option D. Then comes the third question. As per the case scenario given above, Swati started her function as scrutinizer immediately after the voting at EGM was concluded. She first counted the votes cast at the meeting. Correct, guys? First you should count the votes at the meeting, and thereafter she unblocked the votes cast through remote e-voting. Since the counting of votes was to be undertaken in the presence of minimum witness, you are required to choose the correct option. So minimum 2 witness, and they should not be the company's employees. So Swati was required to undertake counting of votes in the presence of minimum 2 witnesses who were not in employment. Correct. 1 witness is wrong. 4 witness is wrong. 3 witness is also wrong. Option A is correct. Minimum 2 witness, and they should not be employees of the company. Then comes the fourth question. It is observed that the above case scenario that Superior Textile Industries Limited in May 25 also set up an employable vocational training center in different semi-urban and rural areas of Maharashtra under the banner of Trust Smile, which is an ongoing project. You are required to choose a correct option from those given below. Ongoing project means what? Multi-year project, but maximum how many years? Maximum 3 years. If you ignore the year of commencement, 3 more years. Okay, so 3 more years would be what? 2 years? Wrong. 5 years? Wrong. 4 years? Wrong. 3 years. Option D. Ongoing project means a multi-year project undertaken by the company to fulfill CSR obligation having timeline not exceeding 3 years, excluding the financial year of commencement. So if I ignore the financial year of commencement, 3 more years maximum. So option D. And then comes your fifth question. According to the case scenario, Superior Textiles Limited caused a public notice to be published containing required particulars relating to the meeting. We know that they're doing e-voting, right? So public notice has to be given. It was given as an advertisement in 2 newspapers, one vernacular and one English. Correct only, one vernacular and one English. You are required to choose the appropriate option from those given below as to minimum how many days before the EGM the public notice should be published. The public notice must be published after dispatching the notice, but at least 21 days before the EGM. So 14 days? No. 21 days? Yes. 10 days? No. 7 days? No. Minimum 21 days before the EGM. Okay. And then comes your last question here. From the above case scenario, it is observed that Superior Textile Industries Limited appointed Swati, an independent CA in practice, to be the scrutinizer for the remote e-voting process. Take as regards taking assistance by Swati of a person who is well versed with electronic voting system, which option is correct? I'll tell you. See, listen to me. The scrutinizer has to be an independent person first of all. Okay, can be a practicing CA, CS, CMA, should not be the company's employee, should be a reputed person, but should be some person of repute. Alright, now this scrutinizer can take the assistance of one person. That person should be well versed in the whole e-voting process and should not be employee of the company. So that's what they're asking, whose assistance can the scrutinizer take. Since the process of scrutinizing votes is a secret affair, Swati is prohibited from taking assistance. Wrong, she can take assistance. For discharging her function as scrutinizer, Swati is permitted to take assistance of a person who is well versed with electronic voting system. Correct. Only if he is in the employment. Wrong. The assistant should not be an employee of the company. Then, for discharging her functions as scrutinizer, Swati is permitted to take assistance of a person who is well versed with electronic voting system only if he is not in the employment of Superior Textiles Limited. Correct, guys. So the learning is that the assistant of the scrutinizer should be a person, condition number 1 should be a person who is well versed with the electronic voting system, and condition number 2, he should not be an employee. So simple, guys. See, to eliminate confusion, listen to me. The scrutinizer, the witness in the presence of whom the scrutinizer unblocks the e-voting facility, and the assistant, all of these persons, guys, should not be employees of the company. Easy, you will not forget now. Scrutinizer also, the witness also, the assistant also. None of them should be employee of the company. Okay, so this was your question number 37. Now coming to question number 38. Question number 38 also, if you see, straight away, just by looking at the questions itself, we can straight away give the answers. We don't even have to read the whole MCQ. So the first question over here, Neil, a sales executive at Nova Crest Pharma Limited, working directly under Mr. Dinesh, Vice President Marketing, wants to take a loan from the company to purchase its equity shares. Do you remember, guys, long back we had discussed about Section 67, financial assistance. There we had learned a public company generally cannot give financial assistance to any person for purchase of its own shares or to purchase the shares of holding company. But 3 exceptions we had learned. Number 1, a banking company can give financial assistance in ordinary course of business. Then number 2, the company can give financial assistance to a trustee to purchase fully paid shares of the company or of the holding company for the benefit of the employees of the company. But for that, a prior special resolution is required. And then we have the limit also, how much maximum financial assistance can be given. Then the third exception, the company can give financial assistance to its employees other than directors and KMP, maximum 6 months of the salary of the employee, to purchase fully paid shares of the company or holding company. So now tell me, Neil is a sales executive. He's neither KMP nor is he an director of the company, guys. So we can give him loan. Maximum, how much loan can we give him? Maximum 6 months, up to 6 months salary. And with that loan, he can buy only fully paid shares of the company or of the holding company. So option C, right? This was nothing but a Section 67 reminder that the public company can give financial assistance to its employee other than directors, other than KMP, maximum 6 months salary. Okay. Then comes the second question. See, there's a concept in relation to one-person company. Okay, every one-person company's name should have the word OPC at the end. So from the case scenario, it is evident that with a view to start own film production company, Rishabh, earlier named Rishabh, incorporated a one-person company by the name Rishabh Framecraft Private Limited. As regards the manner in which the company's name outside his RO shall be displayed, indicate the correct option. See, should it be Rishabh Framecraft Limited one-person company? No. Every OPC should have the word private limited in its name, and at the end of the name it should have the word OPC in the name. So Rishabh Framecraft Limited one-person company will be wrong because it does not have the word private limited. Then Rishabh Framecraft Private Limited, and at the end of the name we have one-person company, option B. So the right way of mentioning the name of a one-person company would be, first of all, it should have the word private limited in its name because by nature it's a private company, and then at the end of the name it should have the words OPC or one-person company. So option B. Then listen to the next point. You know very well, in a one-person company, a nominee has to be appointed, guys, by the member, so that in case a member dies or in case a member becomes incapable, the nominee will then become a member. Now this nominee has to give a written consent saying that yes, the nominee is willing to act as nominee of the one-person company. But later, if required, if the need arises, the nominee can also withdraw his written consent and decide that I don't want to be a nominee anymore. In that case, guys, within the next 15 days itself, the member has to appoint another nominee. That is the third question. Assuming that Mrs. Meera withdraws her consent to act as nominee and gave notice on 8th July, within what maximum time must Rishabh nominate another person as a nominee? If the nominee withdraws her consent, then the member has to appoint a new nominee within 15 days. So within 5 days is wrong. Within 15 days, option B. 20 days is wrong. 30 days is also wrong. Option B would be the correct answer. If the nominee withdraws consent, then the member has to appoint a new nominee within 15 days. Okay. Then one more question over here. See, once the company appoints the new nominee, okay, once a new nominee is appointed, we have to inform ROC about it within 30 days. So suppose Rishabh nominates Mr. Karan as a new nominee on 20th July 24, by which date company should file notice with the ROC of such change. So once a new nominee is appointed, we have to inform ROC within 30 days. So 20th July 24 is when the new nominee was appointed. From this date plus 30 days, guys, be careful. July has 31 days, so be careful. 30 days would be 19th August 2024, right? So by 19th August 24, by option C, by 19th August 24, we have to inform the ROC about the new nominee, okay? So this was more or less a one-person company question, but I put it under the mixed category because we had a question relating to prospectus section, sorry, not prospectus, share capital. Section 67 also we had over here. That's why I put it under the mixed category. So what were your learnings from this question? Learning number one, that yes, a public company can give financial assistance to employees to purchase its own shares or to purchase the shares of holding company, but conditions. Condition number one, those employees should not be directors or KMP of the company. Condition number two, the loan can be maximum 6 months salary. And condition number three, they must be fully paid up shares. Then second learning, every one-person company's name should have the word private limited in the name, and OPC should be written at the end. Then the third learning, that in case the nominee wants to withdraw the consent, he can. In that case, the member has to appoint a new nominee within 15 days. And the last learning, once we appoint a new nominee, we have to inform about it to the ROC within 30 days. Now come on, moving on to question number 39. Even this question, guys, without even reading this big lengthy story, I will straight away come to the questions. But before that, let me give you some reminders. See, when it comes to sweat equity shares, section 54, a special resolution has to be passed. And that special resolution will have validity period of only 12 months. Which means within 12 months, the company must allot the sweat equity shares. Point number one. Point number two, these sweat equity shares will have a lock-in period of 3 years. Which means within these 3 years, you cannot transfer the sweat equity shares. Now don't get confused. In ESOPs also you have a time limit. 1 year time limit. That is vesting period. Vesting period has to be minimum 1 year. In sweat equity shares, lock-in period has to be 3 years. That means within these 3 years, the employee cannot transfer the shares. Then, even though they are sweat equity shares, still the employees to whom the sweat equity shares are given, those employees will now become shareholders of the company, guys. And no special treatment. Those shareholders, the sweat equity shareholders, they will have the same rights, limitations, restrictions as the other equity shareholders in the company. In simple words, the employees to whom ESOPs are given, the employees to whom sweat equity shares are given, those employees will be pari passu. They will be equal to the other equity shareholders. From the date of allotment itself, they will be treated just like they are any other equity shareholder in the company. Okay. So this was my first discussion with you with respect to sweat equity shares. That point number one, when the company is issuing sweat equity shares, before that SR is required. That SR will have validity period of 12 months. Within 12 months, company must finish the allotment of sweat equity shares. Then sweat equity shares will have a lock-in period of 3 years, which means within these 3 years, the employee cannot sell away the shares. And lastly, the sweat equity shares, even though they are sweat equity shares, so what? The shareholders, the employees will still rank pari passu just like all the other equity shareholders in the company. Okay, this was our first discussion. Then the second concept which is involved in this question is from your auditors chapter, guys, relating to branch audit. Now, branch audit will be done by whom? It fully depends upon where is a branch situated. If the branch is situated in India, then the branch audit can be done either by the company's auditor itself or it can be done by any other person who is qualified to be appointed as an auditor of the company. But in case a branch happens to be outside India, then in that case, the branch audit can be done by 3 people, guys. Either it can be done by the company's auditor itself, or it can be done by an accountant, or it can be done by any other person who is qualified to be the auditor as per the laws of that foreign country. So branch audit can be done by whom depends upon where is the branch situated. If the branch is in India, the branch auditor can be 2 people, either the company's auditor itself or any other person but who is eligible to be appointed as auditor of the company. But if the branch is outside India, then the branch auditor can be 3 people, either the company's auditor itself or the accountant or any other person who is authorized to be the auditor as per the laws of that foreign country. Okay. Then comes the third point, the last concept which is relevant in this question relating to private placement. See, when it comes to private placement, we do know the 200 limit and all. But there are some time limits also that you should be aware of over here. Once the company receives the application money, within 60 days, the company must allot the securities. If the company allots within 60 days, then within the next 15 days, company must file the return of allotment with the ROC. Only then the company can utilize the money. In case company is not able to allot within 60 days, then the company must refund the money within the next 15 days. So there are totally three time limits. Time limit number one, once a company receives the application money, within 60 days, company must allot. Time limit number two, once a company allots like this, within the next 15 days, the company must file return of allotment with the ROC. After that only the company can start utilizing the money. Time limit number three, if by chance, for some reason, company is unable to allot within 60 days, then in that case, within the next 15 days, company must refund the money. Okay guys, that's all. These three concepts. Now come on, have a look at the question. The first question. Directors of Green Wave Beverages Private Limited decided to reward and motivate the top 10 employees of the product development team and marketing team who contributed significantly to the success of the company and made available rights in the nature of intellectual property rights by issuing 5 lakh equity shares for consideration other than cash. Guys, this is entirely a sweat equity shares definition, right? You are required to choose the correct option from those stated below as to whether the said sweat equity shares shall be subject to a lock-in period. We just spoke about it. Lock-in period will be how many years, guys? Lock-in period will be 3 years. So lock-in period, come on, look at the correct option. Shall not be subject to lock-in period is wrong. Then 3 years lock-in period is correct. Then 4 years lock-in period is wrong. 5 years lock-in period is also wrong. Lock-in period is always 3 years only for sweat equity shares. Then, the above case scenario states that Green Wave Beverages Private Limited needed a fresh dose of additional capital for production and marketing of newly developed health drinks, and for that purpose, it issued 50 lakh equity shares of 10 rupees each through private placement to the existing shareholders which were duly allotted. So, company made a private placement. Select appropriate option from those given below as to what is the maximum permissible time period within which the equity shares must be allotted. Private placement cases, guys, the equity shares should be allotted within 60 days of receiving the application money. So let's see. First option, 60 days. Yes, guys. Then 15 days, definitely wrong. Then 90 days, again this is wrong. Then 30 days, this is also wrong. So your correct option will be option A, 60 days. The allotment has to be made within 60 days of receiving the application money. Then, according to the case scenario, Green Wave Beverages Private Limited issued 5 lakh sweat equity shares to top 10 employees of the product development team and marketing team for consideration other than cash after passing a specified resolution. Which resolution? SR. You are required to choose the correct option from those mentioned below as to within a period of how many months the allotment of sweat equity shares must be made from the date of passing the resolution. We spoke about it. SR has to be passed, that SR will have 12 months validity. So come on, let's read the options. Within a period of not more than 3 months, wrong. Within a period of not more than 12 months, yes guys, SR will have validity of 12 months only. 6 months is wrong. 9 months is also wrong. So your option will be, correct option will be option B. The SR will have validity of 12 months. Within 12 months, company must finish the allotment of the sweat equity shares. Then, according to the case scenario, Green Wave Beverages Private Limited established a 6th branch in Lisbon, Portugal. So the company has a foreign branch after establishing 5 Indian branches in a row. As regards auditing the accounts of this overseas branch, who according to you is authorized to audit? Tell me guys, branch audit. The branch is situated in a foreign country. It can be audited by how many people? 3 people. Foreign branch, 3 people, either by the company's auditor or by an accountant or by any other person who is authorized to be the auditor as per the laws of that foreign country. 3 options we have. So option A, auditing of 6th branch by Green Wave Beverages, only the company's auditor. Wrong. 3 options we have, not only company's auditor. Option B, it can be audited by company's auditor, that is option 1, or an accountant, option 2, or any other person qualified to act as auditor as per the laws of Portugal. Correct guys, option B is correct. 3 options we have, either the company's auditor or accountant or any other person who is qualified to be the auditor as per the laws of that foreign country. So option B. Then comes your fifth question. It is evident that Green Wave Beverages Private Limited issued 5 lakh sweat equity shares for consideration other than cash to the top employees. Keeping in view the applicable provisions, select the apt answer from the options given below as to when the holders of sweat equity shares will rank pari passu. We just learned, right? The sweat equity shareholders will be equal. They will be pari passu to the other equity shareholders. But they will be equal from when? Immediately, guys. Immediately upon allotment, as soon as the allotment happens, immediately they will be pari passu. So, immediately. Only after the expiry of 3 years? Wrong. Only after the expiry of 4 years? Wrong. Immediately from the date of allotment, this would be your correct answer. Option C. Okay, so this was your question, your mixed questions. So with this, I think your mixed questions are over. Now we will start off with our LLP Act and then the other laws. Now, coming to the first question over here, it's a descriptive question. Let me quickly give you a reminder of the concepts. See, once LLP is incorporated, LLP agreement has to be filed with the ROC in E-Form 3 within 30 days of incorporation. So, I want you to remember the time limit that LLP agreement has to be filed with ROC within 30 days of incorporation. Okay, point number 1. Point number 2, in an LLP, every partner will bring in capital contribution, guys. That capital contribution can be in any form. It can be in the form of tangible property, intangible property, movable, immovable property. It can be in money. It can be in the form of an agreement to contribute cash later. It can be like a contract for service to be performed. So the contribution, the capital contribution need not necessarily be only money. It can also be in kind. It can also be in the form of services. It can also be in the form of intangible property, like for example a copyright. So therefore a capital contribution is not just money. Alright, this is the second point. Then comes a third point, who can be a partner and who cannot be a partner in an LLP. See, in an LLP, an individual can be a partner. Individual may be resident, non-resident, Indian citizen, foreign citizen, doesn't matter. Then even an LLP can be a partner in another LLP. Even a foreign LLP can be a partner in another LLP. And companies, whether Indian company, whether foreign company, all of these can be partners in an LLP. But however, a cooperative society cannot be a partner in an LLP. A corporation sole cannot be a partner in an LLP. Then HUF cannot be a partner in an LLP. Your charitable trust cannot be a partner in an LLP. Understanding? So 3 simple concepts, guys. Very easy discussion this was. Point number 1, LLP agreement has to be filed with the ROC within 30 days after incorporation. Then point number 2, capital contribution need not necessarily be money. It can also be in kind. It can be in the form of tangible or movable or immovable or intangible goods also. It can also be in the form of a service. And lastly, who can be partners, who cannot be partners? A cooperative society cannot be a partner. Individual can be a partner. LLP, Indian LLP or foreign LLP, both can be partners. Company, Indian company, foreign company, both can be partners. Alright, that's all, guys. Keep this in your mind and come on, let's have a look at the question. The question says, Harish, Priyam and Priyesh are 3 advertising professionals specializing in the field of creating short advertisement films for various FMCG companies. They have been engaged in their business separately as sole proprietors, but now have decided to join hands and form LLP. So, long story short, Harish, Priyam and Priyesh, these 3 people, they are going to make an LLP now. On 10th April 2024, E-Form Run LLP is filed thereby to reserve the name of LLP as HPP and Associates LLP. So the name of the LLP is going to be HPP and Associates LLP. They have already reserved the name. They have already filed E-Form Run LLP. I hope you know E-Form Run LLP is the form that is used for reservation of name of LLP. Then the ROC has also approved the name. The E-Form Philip has also been filed containing details of the partners and their consent. Meanwhile, even after incorporation as HPP and Associates, on 30th April 24, LLP could not finalize the LLP agreement as Harish and Priyam have agreed to contribute 1.15 crore to the LLP, whereas Priyesh has desired and insisted to monetize his future services for 1 year to the LLP as his capital contribution, which has been opposed by the other 2 partners as beyond law. So listen to me now. when did this LLP get incorporated? It got incorporated on 30th April 24. Now, within 30 days, the LLP agreement has to be filed with ROC. But they're not able to file it because one of the partners, that is Mr. Priyesh, he desired to monetize his future services for 1 year as his capital contribution. Tell me, everybody, can his services be capital contribution? Yes, we spoke about it. Contract for services performed or to be performed, this also can be capital contribution. It is not necessary it has to be money only, it can also take the form of services. Now, this has been opposed by the other two partners as beyond law. No, it is not beyond law. It is perfectly allowed. Your capital contribution can be in the form of services, so the other two partners' opposition is not right. However, a consensus was drawn between the above three, and a common consensus LLP agreement was finally submitted on 20th May 24. So tell me, guys, was the LLP agreement submitted on time? Yes, of course, it was submitted on time. The LLP got incorporated on 30th April 24. We are supposed to submit the LLP agreement to the ROC within 30 days, and here they have submitted on 20th May itself, which is definitely within 30 days period, guys. So therefore there is no violation even over here. Now come on, let's have a look at the questions. LLP has further planned to induct Srijan Cooperative Society as one of the partners. This is not allowed. A cooperative society cannot be a partner in an LLP. Now look at this. Whether the registrar would accept LLP agreement so submitted after 20 days in compliance with law. Yes, we have 30 days time to submit LLP agreement. LLP has submitted within 20 days itself. It is well within the time limit. Second question, whether the opposition of the desire of Priyesh on matter and form of capital contribution, is it correct? See, the opposition is not correct. The capital contribution can be in the form of a service. The other two partners are opposing it, right? That opposition is not correct. It can be in the form of service. What Mr. Priyesh wants to do is perfectly fine. So the opposition of the other two partners is not tenable in law. And lastly, whether Srijan Cooperative Society, can they be inducted as a partner? No, the cooperative society cannot be a partner in LLP. Alright, guys, so always read the question, see exactly what the question is asking you and answer that. Are they asking you over here for the second question, are they asking you that can Priyesh give capital contribution in the form of service? They're not asking you that. They're asking you whether the opposition is correct or not. The other two partners are opposing Priyesh's capital contribution, right? So is that opposition correct or not? No, that opposition is not correct. Priyesh can give capital contribution even in the form of service. So the other two partners opposing it is not right. Okay, so this was your question number 40, covering 2 to 3 concepts from your LLP chapter. Now come to question number 41. Question number 41 is a simple question, guys. Just a few concepts I have to discuss about with you first. See, financial year generally is April to March. Even under LLP Act, also the financial year is same April to March only. But in Companies Act, I hope you remember, you would have learned that if the company is incorporated in Jan, Feb or March, then the first financial year will end not on the coming 31st March, instead on the next 31st March, guys. Because of which under Companies Act, the first financial year can be up to 15 months long also. Something similar we have even in LLP Act. In LLP Act, if the LLP is incorporated after September, that is October, November, December, Jan, Feb, March. From October to March, if the LLP is incorporated, then the first financial year may end not on the coming 31st March, but on the next 31st March. Okay, so under LLP Act, your first financial year can be even up to 18 months long. So, understanding, if the LLP is incorporated in the period of October to March, then the first financial year may end not on the coming 31st March. Instead, it will end on the next 31st March, because of which your first financial year can be up to 18 months long. Now, come on, let's have a look at the question. The question says, Sulagna Sukanya and Associates LLP was formed on 1st November 24. So, this is the date of incorporation of the LLP to be engaged in the business of fashionable accessories of manufacturing affordable range for women. So, Lagna is a fashion designer. She appointed Shirish as a qualified CA to maintain and finalize accounts on Jan to December basis. Tell me, can LLP decide that their financial year will be Jan to December? No, they can't decide like that. Even for LLP also, it has to be April to March only. Then what happened? Thereby preparing the financial statements for the first 2 months ending 31st December. Shirish differed from the view and advised her for April to March as a financial year, thereby urging upon such account finalization from November 24 to March 25 instead. See, when did this LLP get incorporated? It got incorporated on 1st November 24. So 1st November 2024 to, see, the LLP is getting incorporated in the period October to March. So the first financial year may end on the next 31st March, not on the coming 31st March. Coming 31st March would be 31st March 2025. But however, because it is incorporated in this period, the first financial year may end on the next 31st March, which is 31st March 2026. But please know that this is a directory provision, which means it's not a mandatory provision, because the law uses the word may. The law says that if the LLP is incorporated between October to March, the first financial year may end on 31st March of the next year. So which means this point becomes a directory provision, it's not a mandatory provision. Okay, so if the LLP wants, LLP has the option of ending the first financial year on the next 31st March, or as usual, they can end the first financial year on the coming 31st March, which is 31st March 2025 also. Both will be allowed, both will be possible. It's only a directory provision. Okay. Now, if you see, the question says that one of the partners, Sulagna, she wanted the financial year to be Jan to December. But however, Shirish differed from the view and advised April to March as a financial year, thereby urging upon such account finalization from November 2024 to March 2025. So the chartered accountant wants to follow this option, guys, that is 1st November 24 to 31st March 25. He does not want to take the option of ending the first financial year on the next 31st March, and that is perfectly fine, because this is only a directory provision and not a mandatory provision. Then the question says, meanwhile, Dilip, a Karta of a HUF in which Sukanya is also a member, has approached the LLP and offered to be admitted as a partner. Can a HUF be a partner in an LLP? No, a HUF cannot be a partner in an LLP. Now they're asking us three things over here. Thing number one, whether the advice of Sulagna for maintaining accounts Jan to December, will it hold good in law? It will not hold good in law. See, the financial year has to be April to March only. Only the first financial year, okay, fine, it may be from November 24 to 31st March 26, or it can be from November 24 to 31st March 25. But ideally, it has to be April to March only. So can it ever be Jan to December? No, that is not permitted at all. Then whether the offer given by Dilip to induct the HUF as a partner be considered? No, guys, a HUF cannot be a partner in an LLP. Only an individual can be a partner, an LLP can be a partner, and another company can be a partner. HUF, cooperative society, corporation sole, they can't be partners in an LLP. And lastly, what would be your answer if instead of Dilip, a charitable trust had approached to become a partner in the LLP? A charitable trust also, guys, cannot be appointed as a partner in an LLP. Got it, guys? So that is it with question number 41. Your learnings, your first learning is about the financial year. Even under LLP Act, the financial year has to be April to March. Only if the LLP is getting incorporated between October to March, then they have an option that either the first financial year can end on the coming 31st March also, or it can end on the next 31st March, because of which the first financial year in an LLP can even be up to 18 months long. Okay, then HUF cannot be a partner in an LLP, even a trust cannot be a partner in an LLP. Alright, now come on, let's move on. Let's come to question number 42. Question number 42 deals with the assignment concept. See, this whole concept of assignment is a very simple concept. Okay, now let us say I am a partner in the LLP. Alright, so I only have the right to get the share in the profits of the LLP. In case the LLP suffers a loss, I'll have to bear the loss also, and I only will have the right to enjoy the distributions from the LLP. But what I can do is I am allowed to assign, or I am allowed to transfer my rights to enjoy all this to another person, let's say to you. So when I do this, I become the transferor of the rights and you become the transferee of the rights, or I become the assigner of the rights and you become the assignee of the rights. So point number one, question number one, is it allowed? Is it permitted for a partner to assign the share in the profits or the right to receive distributions to another person? Is it allowed? Is it permitted to assign? Yes, it is permitted to assign. Now comes the second question. Just because I have done this assignment, does it mean that I will not be a partner in the LLP anymore? Does it mean now you will become a partner in the LLP? No. Just because I have assigned does not mean I get disassociated as a partner. No. I continue to be the partner of the LLP, and just because you are now going to enjoy the share in the profits, because of that reason alone, you will not become the partner in the LLP. Understanding? So just because I have done this assignment, the partner will not get disassociated from the LLP. LLP will not get dissolved. LLP will not get wound up. Just because the transferee is now going to enjoy a share in the profits of the LLP, because of that reason alone, the transferee does not become the partner, the transferee cannot participate in the management of the LLP. The transferee cannot access information and all about the LLP. The transferee cannot ask for books of accounts of the LLP and all, not allowed. In simple words, even though I have done this assignment, life will continue as usual. The assigner will continue to be the partner, and the assignee, just because you are going to get the share in the profits now, because of that reason alone, you will not become a partner in the LLP. Okay, now come on, have a look at the question. The question says, Raman, Sita and Mohan are partners in an LLP firm, RSMN company, engaged in consultancy services. As per the LLP agreement, the profit and losses are shared equally. Raman, requiring funds for personal purposes, he transfers 40% of his share of profit to his friend Arjun. First of all, tell me, is this permitted? Can a partner transfer his share in the profits to another person? Yes, guys, this is permitted. But just because Raman has done this transfer, because of that reason alone, can I say Raman is not a partner anymore? No, Raman continues to be the partner. Just because now Arjun also will get a share in the LLP's profits, will Arjun become the partner of the LLP? No, Arjun will not become a partner of the LLP. So after the transfer, Arjun, who is Arjun? The transferee. He claims that he is entitled to participate in the management of RSMN company. No, transferee, you cannot participate in the management of the LLP. You cannot access information and all. Since Raman has transferred part of his rights, he is deemed to be disassociated as a partner. Even this is wrong. Even though the partner has given his share in profits to Arjun, still doesn't mean that Raman will get disassociated. Raman will continue to be the partner. His disassociation will not happen just because he has done this assignment. So Arjun is saying two things, and both the things are wrong. Thing number one, no Arjun, you cannot participate in the management of the LLP. And thing number two, no Arjun, just because Raman has done the transfer does not mean Raman is not a partner anymore. He continues to be the partner. Easy question, guys. You are required to advise with reference to the LLP Act whether Raman's partial transfer of rights will lead to disassociation or dissolution of LLP. No. Life continues as usual. Raman continues to be the partner. The LLP continues to function. The LLP does not dissolve. The partner does not get disassociated just because of an assignment. Then question number two, whether Arjun is entitled to participate in the management of RSMN company. No. Arjun is only an assignee. He is only a transferee. He is not a partner of the LLP. So he cannot participate in the management of the LLP. He cannot access information in books of accounts of the LLP. Not allowed, not permitted. Okay. This was your question number 42. So we've discussed 3 descriptive questions relating to your LLP chapter. Now I have 2 case-based MCQs for you. Come on, let's have a look at the first case-based MCQ over here. See, this case-based MCQ is about cessation of partnership interest. That is nothing but what happens when a partner leaves the LLP. Like for example, what happens when a partner resigns from the LLP. Then in that case, guys, the LLP has a responsibility to inform the ROC about it within 30 days. Alright. But however, in case LLP does not inform the ROC about it, the partner who is resigning, the partner who is leaving, he himself also can give a notice to the ROC. In that case, ROC will give a show cause notice to the LLP and will ask for confirmation within 15 days. So in simple words, guys, there are 2 options. Whenever a partner leaves the LLP, there are 2 options. Option number 1, the LLP itself should inform the ROC about it within 30 days. This is the ideal situation. But in case LLP does not inform the ROC, then in that case, the partner who is leaving the LLP, he himself can inform the ROC. But in that case, just because the partner is informing the ROC about it, ROC will not accept that information. ROC will now give a notice to the LLP and ask for confirmation from the LLP within the next 15 days. Only then ROC will go ahead and register this change. See, it is so important to inform the ROC about this cessation, because when a person ceases to be a partner, when he resigns, his liability will come to an end only when the ROC is informed about it. That is why it is so important to inform the ROC when a person ceases to be a partner. Understood, right? Generally, ideally, LLP should inform within 30 days. But in case LLP does not inform, the partner himself will inform the ROC. But ROC will not just like that accept it. ROC will give a show cause notice to the LLP and will ask for confirmation within 15 days. Okay. Now come on, have a look at the question. The question says KLP and Associates LLP comprises of 3 partners, Kamlesh, Lavkush and Pradeep, and it was incorporated under an agreement in the year 2020. 3 partners. Mr. Pradeep, one of the partners, has decided to leave the LLP. So who is my outgoing partner now? My retiring partner, the partner who is resigning, Mr. Pradeep. He has informed Mr. Lovecush, one of the designated partners of the LLP, of his decision to leave, and he has urged to proceed with the formalities. Even after 1 month of leaving the LLP, Mr. Pradeep was continuously receiving phone calls from the creditors of the LLP for payment of dues, and thus convincing him to believe that the LLP has neither informed the outsiders nor the ROC about his leaving the LLP. So, what has happened now? My whole subject matter, my whole question is about Mr. Pradeep. He was a partner in the LLP. Then he resigned, he left. But however, the LLP has neither informed the outsiders about him leaving nor has the LLP informed the ROC about it. LLP was also not responding to Mr. Pradeep's queries, referring to the provisions of the LLP Act. What is a step that Mr. Pradeep can take to escape his liability post quitting LLP? Listen, Mr. Pradeep, even though you have left the LLP, you will still continue to be liable unless and until the ROC has been informed about it. The ideal situation should have been that the LLP should inform the ROC about it. But LLP has clearly not informed the ROC about it. It's okay. Mr. Pradeep, you go and inform the ROC about it. ROC will give a show cause notice to the LLP and will ask for confirmation within 15 days. That way, your liability will come to an end. So come on, they're asking us, what is a step Mr. Pradeep can take to escape his liability? Option A, Mr. Pradeep should further follow up with LLP and ask it to submit Form 4. No, it is evident that the LLP is not informing ROC. So now Mr. Pradeep, he himself has to go and inform. Mr. Pradeep should himself file Form 4 with registrar, who would then send a show cause notice to the LLP and ask for confirmation. Yes guys, option B. Option C says Mr. Pradeep can himself issue a public notice. There is no concept of issuing public notice and all. All that is an Indian Partnership Act, not an LLP Act. Then registrar would himself contact the LLP. No, not possible. So your correct answer would be option B over here. The partner himself will inform the ROC. ROC will send a show cause notice to the LLP and will ask for confirmation. Alright guys, only why is it so important to inform ROC in these cessation cases? It is so important because unless and until we inform the ROC about the fact that a partner has left the LLP, unless we inform ROC about it, the cessation will not be effective. Liability will still continue. So therefore, it is very important to inform the ROC about cessation. Okay guys, this was question number 43. Now come to question number 44. This is also a case-based MCQ. Now the question says, Divine Associates was a well-established partnership firm operating in engineering and infrastructure consulting for over 2 decades. It has 4 partners. Mr. Aryan, he is a designated partner. Miss Simran, she is a sleeping partner. Mr. Junaid, finance head, and Mr. Roy, operations. So there are 4 partners. The firm saw immense growth after securing multiple government infrastructure contracts. As the business expanded, they faced increasing compliance complexities, risk of personal liabilities, and tax inefficiencies. In 23-24, the partners unanimously decided to convert the partnership into LLP for better risk protection and corporate governance. So originally it was a partnership firm which has now gotten converted into an LLP. The firm was registered as Stellar Associates LLP on 20th October 2023. Simple guys. So the only thing that is relevant over here is earlier it was a partnership firm with 4 partners. Now that same partnership firm got converted into an LLP with the name Stellar Associates LLP. 10 days after conversion, due to chronic health issues, Mr. Junaid resigned. We had 4 partners guys, 1 has resigned. So we still have 3 partners. LLP continued the operations with the remaining 3 partners. However, from 1st November 23 to 1st June 24, no new partner was appointed. During this time, significant project contracts and vendor negotiations were executed by Mr. Aryan and Mr. Roy. Everything seems to be fine only guys. We have 3 partners and 2 partners are doing all the work because 1 partner is a sleeping partner. Remember, Simran is a sleeping partner. So everything seems to be fine only as of now. Minimum 2 partners we need and we do have 2 partners. Miss Simran, despite being a silent partner, she extended a 20 lakh personal loan to the LLP for temporary working capital. So this is not capital contribution guys, this is a loan. One of the partners has given a loan to the LLP. She signed a standard loan agreement and expected repayment within 18 months. LLP treated this as external borrowing with interest and principal obligations to her similar as a non-partner lender. Is this right, guys? One of the partners has lent a loan to LLP, but LLP is treating it like an external loan, which means LLP is treating it just like any other loan. Perfectly right. When a partner gives a loan to the LLP, you cannot equate it to a capital contribution. It will still be treated like an external borrowing. Just like how an LLP will repay other loans if it borrows from outsiders, same way LLP has to repay this loan also. Just like how LLP will pay interest on loans that it borrows from outsiders, same way it will have to pay interest on this loan as well. So LLP is perfectly right in treating it just like any other external borrowing. Then what happened? In April 2025, LLP faced internal disputes regarding transfer of Mr. Roy's profit share to Mr. Ketan, a third-party investor. Investor insisted on participating in the decision making after acquiring 20% profits, which was denied by the remaining partners. This point is again nothing but assignment, guys. Mr. Roy, one of the partners of the LLP, has transferred his profit share to Mr. Ketan. So Mr. Roy becomes a transferor and Mr. Ketan becomes a transferee. Nothing but the assignment concept which I discussed with you just in the last question only. Now over here, just because Mr. Roy has transferred his share of profit to Mr. Ketan, will Mr. Ketan have decision making power in the LLP? Will the transferee be able to participate in the management of the LLP? Of course not. Now come on, let's have a look at the questions. Mr. Junaid resigned from Stellar Associates LLP on 30th October 23. Choose the correct option. LLP should file a notice with the ROC within 30 days from the date on which Mr. Junaid ceases to be a partner. Yes, guys, we had spoken about this even over here. When a partner ceases to be a partner, that is when a partner leaves the LLP is supposed to inform ROC about it within 30 days. So option A is perfectly right. LLP should file a notice with the ROC within 30 days. In case the LLP does not inform the ROC, only then the partner will take the steps of informing the ROC about it. Okay. Then comes the second question. From 1st November 23 to 1st June 24, the LLP functioned with only 2 partners. What is the most critical legal consequence? No legal consequence, guys. We need only 2 partners minimum, and we are having minimum 2 partners. So no legal consequence. Life will continue as usual. So LLP must dissolve immediately. Why? No need. All decisions taken during this period are valid as it needs 2 partners only to run the LLP. Option B is correct. Then, regarding Ms. Simran's 20 lakh loan to the LLP, what is the correct classification and its legal effect? It must be treated as capital contribution? No. If a partner is giving a loan to the LLP, you cannot equate it to capital contribution. Then, it qualifies as partner's contribution? No. It is treated as a third party transaction and must be honored like any other external loan? Yes. Option C. Finally, Mr. Roy, one of the partners, guys, he transferred 20% of his profit rights to Mr. Ketan. So Mr. Roy becomes the transferor and Mr. Ketan becomes a transferee. Now the transferee is demanding management rights. Sorry, Mr. Ketan, just because you're an assignee, because of that reason alone, you do not become a partner in the LLP. You cannot ask for any management rights. You also cannot ask for any information and books of accounts of the LLP. Not allowed. As per the provisions of LLP Act, how will you define Mr. Ketan's position? Transferee automatically becomes a partner? No. Profit transfer does not entitle the transferee to management or access to LLP's affairs. Yes, guys, option B. Just because Mr. Ketan becomes, a person who is entitled to get a share in the LLP, because of that reason alone, he will not get management rights. He cannot ask for information and all. He will not have any rights in the LLP. Okay, so these were your questions with respect to your LLP chapter. So we had 3 descriptive questions and we had 2 case-based MCQs. These were the new questions from your LLP chapter. Now I am taking you to the General Clauses Act. Here we have a nice quality of questions and a nice number of questions also. Both descriptive questions and case-based MCQs. Let's take up the first descriptive question over here. See, very simple question, okay? If I commit one offense and if that same offense is punishable under 2 laws, then you will punish me under any one of them only, guys. You must be knowing about this very common provision. If the same act or omission is an offense under 2 enactments, then the offender will be punished only under any of those enactments, under any one of those enactments, but shall not be punished twice for the same offense. Which means, if I have done one offense, I should get only one punishment. I should not be punished 2 times for the same offense. Okay, but what if I have committed 2 offenses? What if I have committed 2 offenses? Then I can get punished twice, right? That is what is a subject matter of this question, guys. The question says Jumbo Road Lines Limited is a public company engaged in the business of interstate goods transportation. Company owns a fleet of more than 10 heavy-duty trucks which have the capacity to transport 1,000 tons of goods in one consignment as per registration. Transportation company received an order to transport 1,000 tons of goods, particularly plastic parts of automobiles, to be loaded from a production facility in Surat, Gujarat and offloaded in automobile factory in Pune, Maharashtra. Simple. There's a truck. That truck has capacity of carrying 1,000 tons of goods. It has a transportation order now. Goods have to be transported from Surat in Gujarat to Pune in Maharashtra. Okay. Now, the driver loaded the heavy-duty truck to its maximum capacity. So, full 1,000 tons loaded. On its way to Pune, the driver further loaded 100 tons of goods. So, which means, do you agree that the driver has committed one offense over here? He has overloaded the truck, guys. He has committed an offense. So, he further loaded 100 tons from a local trader who lured him with some extra payment. Driver on his way with his overloaded truck rammed into a road divider, causing damage to the public property. So he has committed one more offense over here. Two offenses he has committed, guys. Offense number 1, he has overloaded the truck. Offense number 2, he has rammed into a road divider and he has caused damage to public property. He has committed 2 offenses. So he can be punished 2 times, right? See, if the offenses are distinct, if the offenses are not identical, if they are 2 different offenses, of course he will be punished 2 times because he's committed 2 offenses over here. The question says the local traffic police charged Jumbo Road Lines Limited for overloading the truck under the Motor Vehicles Act. This was the first punishment, and filed a suit against the transport company. Further, the Highway Authority filed another suit against the company under the Prevention of Damage to Public Property Act in 1984 for damaging the dividers and iron girders installed on the roadsides. So over here, there are 2 offenses. Offense number 1, the overloading of truck. Offense number 2, damaging the dividers. So 2 different laws are being involved, Motor Vehicles Act and the Prevention of Damage to Public Property Act, and there are 2 offenses. Okay, the Jumbo Road Lines Limited opposed the suits on the plea of double jeopardy and double punishment for the same act under 2 different legislations. So basically the company over here is trying to take protection under section 26. Double jeopardy means what? It means it's a legal principle which says that one person cannot be punished 2 times for the same crime. So this company is trying to take protection under the legal principle of double jeopardy. They're trying to take protection under section 26 and they're saying that why are you punishing us under 2 laws? Why are you giving us 2 punishments? Whether the plea given by the road lines will be accepted by the court? Definitely not, guys. See, listen, you can apply the concept of double jeopardy. You can apply the concept of section 26 only when the company has committed 1 offense. Then we can say, okay, you should be punished only 1 times or only 1 time. But however, here the company has committed 2 offenses. Number 1, overloading of the truck, and number 2, destroying the public property. So therefore, there are 2 offenses. Because there are 2 offenses, there will be 2 punishments. There is no question of double jeopardy over here at all. Alright guys, nice interesting question. Now come on, let's come to question number 46. Now question number 46 deals with section 8 of your General Clauses Act. Section 8 says that even if a particular law has been repealed, okay, and a new law has come in its place, even after that, some laws may still give reference to the old law. For example, the Companies Act 1956 was repealed and the Companies Act 2013 was brought in its place. But still in some places of the Income Tax Act, reference is still given to Companies Act 1956. In those cases, you will read it as if reference is being given to the new act, to the 2013 Act. So reference to the repealed provisions will be deemed to be reference to the reenacted provision. So you're getting my point. The repealed provision over here is Companies Act 1956. Even though Companies Act 1956 has been repealed, even though Companies Act 2013 has been reenacted in its place, still other laws like for example Income Tax Act may still have reference to 1956 Act. In all those places it will be read as if the reference is to 2013 Act. You'll understand through this question. The question says ABC Foundation, a non-profit company, was registered under Section 25 of Companies Act 1956. Okay, then the question says, as per Section 218AA of the Income Tax Act 1961, a company is considered to be one in which public is substantially interested if it is registered under Section 25 of the Companies Act 1956. Very simple, guys. We're talking about the Income Tax Act 1961 over here. Income Tax Act 1961 has made a reference to Section 25 of Companies Act 1956. You must have learned, right, in Income Tax Act, closely held company, widely held company, right? Widely held company is nothing but a company in which public is substantially interested, and they have given in the Act itself list of companies where public is substantially interested. So one of those points in that list is companies which are incorporated under Section 25 of Companies Act 1956. So now continue reading the question. After the enactment of Companies Act 2013, Section 25 of Companies Act 1956 was replaced by Section 8 of Companies Act 2013. So don't you think, guys, if Section 25 of Companies Act 1956 has been repealed and in its place if Section 8 of Companies Act 2013 has been enacted, then don't you think, guys, even in the Income Tax Act they should make the amendment? They should remove Section 25 of Companies Act 1956 and they should mention Section 8 of Companies Act 2013. However, the Income Tax Act 1961 still continues to make reference to Section 25 of Companies Act 1956 in Section 218AA. So now how to do this interpretation, guys? Even though the Income Tax Act still refers to Companies Act 1956, it will be deemed as if they are referring to Companies Act 2013. Even though the Income Tax Act still says Section 25 of Companies Act 1956, still we will deem it, we will read it as if it is Section 8 of Companies Act 2013. Now are you understanding? If any other law gives reference to repealed provision, it will be deemed as if it is a reference to the re-enacted provision. In this situation, how should the reference to Section 25 of Companies Act 1956 in 218AA of the Income Tax Act be construed after the commencement of Companies Act 2013? So how will you interpret Section 25 of Companies Act 1956, guys? You will deem it as if they are referring to Section 8 of Companies Act 2013. You're getting my point? If other laws are still referring to the old provisions, it will be deemed as if they're referring to the new provisions. So ideally, yes, Income Tax Act should be amended. They should mention Section 8 of Companies Act 2013 now. But if they're still referring to the old law, it's okay. We will do the correct interpretation. We will read it as if they're referring to the new law. Okay, this is Section 8, which talks about re-enacting of the law repealed. If an act is repealed and re-enacted, reference in any other enactment, like for example reference in Income Tax Act to the provision so repealed, will be construed as reference to the provision so re-enacted. Alright, that's it. This was your question number 46. Now coming to your case-based MCQs relating to General Clauses Act, I have two questions for you, two case-based MCQs for you. The first one, question number 47. Let's read the story and let's try to understand what exactly has happened in the story. So they have given us a nice big discussion and then under that they have given us 3 questions. Okay, so the question says, Mr. Famous owned a firm operating a fleet of 18 taxis engaged in the transportation of passengers in and across Madhya Pradesh. Okay, business started way back in 1986 wherein the vehicle permits were obtained and business was being run successfully. So only thing relevant for me over here is that this person, Mr. Famous, he is in the business of transporting passengers. Okay. Then what happened? Registration for the vehicle expired in 1988 and the firm applied for renewal of registration of the vehicles under Section 58 of the Motor Vehicles Act. So the registration of the vehicle expired and the firm has applied for renewal of the registration of vehicles under Motor Vehicles Act 1939. The application under the aforesaid act was still pending when such act was repealed and replaced by Motor Vehicles Act 1988. So what has happened? We have filed an application to renew the registration certificate of motor vehicles under the Motor Vehicles Act 1939. The application is still pending and meanwhile Motor Vehicles Act 1939 gets replaced, it gets repealed and a new act is enacted in its place, and that is your Motor Vehicles Act 1988. Okay, then what happened? To get the application processed, Mr. Famous applied to the authorities to consider the application under the Motor Vehicles Act 1988, taking plea of Section 6C of GC Act. Now see, what does this section 6C of the GC Act says? Section 6C says that in case any law is repealed, it will not affect any claim, privilege, responsibility or debt which is incurred under the old law. Which means, for example, over here, under the old law, an application is filed. That application will not get affected just because the law has been repealed. Alright, so what has happened over here? Mr. Famous, he had filed an application for renewing the registration of his vehicles under the old act, but before his application could get approved, before that itself, the act got repealed and a new act got implemented in its place. And Mr. Famous is taking, protection under section 6C, and he's claiming that his application should not get affected just because the law has been repealed. The application was not entertained by the authorities on the pretext that since application was filed under the repealed law, old application would not be considered and application should have been filed within time. No, the authorities are not right. When the application was filed, that time old law only was prevalent. That is why it was filed under the old law. Now, even though the law has been repealed, even though new act has been enacted in its place, still that application will still be valid. Later, Mr. Famous died, leading to the closure of business. The family of Mr. Famous still lives in one of the flat bought by Mr. Famous during his lifetime from Mr. Rich, a builder and contractor. Mr. Rich was the owner of 6 flats in the city of Indore. He was advised by one of the finance consultants to rent his unoccupied flats and thereby earn handsome passive income in the form of monthly rents. So all this information is about Mr. Rich, who's a builder. The advice was given to him in 2017 and he has been renting out properties since then. DB Motors Limited, an automobile dealer, opened his office in one of the flats for commercial purposes for a rent of 3,15,000 per month. Initially, the rental dues were timely paid by the dealer, but later the automobile dealer defaulted in paying the above, resulting in cumulative arrears of rent 1.2 crores. So, Mr. Rich, one of the builders, he has given one property on rent to DB Motors Limited. Now, DB Motors Limited is not paying the rent properly. So, arrears of rent, 1.20 crore arrears of rent is existing. Mr. Rich filed a suit for recovery of rental arrears on immovable property, pleading to the court to treat such arrears as benefit out of land as defined under 326 of GC Act under the head immovable property. Tell me guys, arrears of rent, can this be considered as immovable property? No. Arrears of rent is not immovable property, it is past benefit. See, future rent will be considered as immovable property, but arrears of rent is not considered as immovable property. Then what happened? DB Motors Limited offered Mr. Rich a passenger family car worth 3 crore at 1.80 crore to compensate the loss incurred by Mr. Rich on rental dues. Color selected by Mr. Rich was unavailable at the selected purchase date. The marketing manager informed and assured that color will be available after a waiting period of 3 months. DB Motors Limited further asked Mr. Rich for an advance check of minimum 50% of the sale value to shield the purchaser from any future price enhancement. A post-dated check of 90 lakhs was handed over to the dealer as booking amount. Check was kept with the showroom owners but could not be deposited by them in their account till the last day of the 3rd month. Check will have a life of 3 months. Till the last day of the 3rd month, the check was not presented only. When Mr. Rich came to know about the above failure on part of the car dealer insisted that Sunday being the last day of the 3rd month, the bank was closed and the check could not be deposited, thus showing his inability to deliver the car which had arrived on Saturday. The dealer insisted on issuing a fresh check. Is a fresh check required, guys? See, there's a check which Mr. Rich has given to DB Motors. The check has a life of 3 months. Now, it is the last day of the 3 months period. The last day is Sunday. Now, Sunday the bank will be closed. So, in such case, does it mean that the check has become invalid? No. We know very well that in case on the last day, if the bank is closed or if the office is closed, then if the same thing is presented on the next working day, then it will still be valid, guys. Computation of time, you have this GC Act concept. In case any office or court is closed, alright, on the last day of a particular period, then in that case, if the act is done on the next day, next working day, whenever the office or the court reopens, then it will be considered as if the act has been done on time. So even though no doubt check has to be presented within 3 months, no doubt about that, but however, because on the last day of the 3 months period, the bank is closed, now whenever the bank reopens again, the next working day, on that day, if the check is presented, it will be as if the check has been presented on time. So new check and all is not required over here. LDR. Okay, now have a look at the question. Which of the following is true on the validity of rejection of the application made by the firm of Mr. Famous regarding renewal of registration of the vehicles? So Mr. Famous had made an application, right, under the old act for renewing the registration of the vehicles, and that application was rejected by the authorities, saying that the application was made under the old act. Now, is that rejection valid, guys? The rejection was not valid. The application was still valid. The authorities are rejecting the application. So the authorities, their rejection of the application, that is going to be invalid. It can't be justified. Why can't it be justified? Because the law section 6 of GC Act very clearly says, even though a law has been repealed, it will not affect any claim, privilege, responsibility or debt incurred under the old act. So whatever application has been filed under the old act, it will still be valid only. So therefore the authorities are rejecting the application. The rejection is not justified. So rejection was not justified, and the same old application should have been considered as per the new Motor Vehicles Act. Yes, guys. Option A, the rejection was not justified. Same application should have been considered as per the new act. Then, whether the plea of DB Motors towards refusal to treat arrears of rent as immovable property as per GC Act, will it hold good? DB Motors is saying that arrears of rent is not immovable property. Yes, guys, they are right. Future rent is immovable property, but arrears of rent is not immovable property. Plea of DB Motors Limited shall not hold valid in this case. Arrears of land revenue will be included in the definition of immovable property. Wrong. Plea of DB Motors will hold good as rent have already been arisen, hence cannot be termed as benefits from land, although future rent can be included in the definition of immovable property. Yes, arrears of rent is old transaction. It has already arisen. It is not a benefit that is going to arise now. It has already arisen. So therefore, your arrears of rent is not immovable property, but future rent is immovable property. So option B. Then comes the last question. Which of the following is true on the validity of the check which could not be deposited on the last day of the third month being a holiday? This we discussed. Check will still be valid only. The next day, whenever the bank reopens, on that day, if the check is presented, then it will be valid only. So a check is valid as the last day of the third month being Sunday. Hence, the same can be deposited on the next working day. Then option B says old check is invalid. Wrong. It is still going to be valid. Till the next working day, it will be valid. Then check can only be deposited only if the dealer applies to the bank for condonation of the delay. No. Check can only be accepted by the bank in case the issuer files a suit against the dealer. No. So option A, even though the 3 months period has expired, because the last day was a holiday, we will wait for the next working day. On the next working day, if the check is presented, then everything is on time. It will be as if the presentment has happened on time and the check will be honored. So the check will still be valid till the next working day. The check will be valid. Alright, so this was your question number 47. What were your learnings from this question? Learning number 1, any application filed under the old law, that application will still be valid even after repeal of the old law. Then learning number 2, arrears of rent is not immovable property, but future rent is immovable property. And our last learning, guys, if the last day on which the check has to be presented happens to be a holiday on which bank is closed, then in that case, the next working day if the check is presented, then it will be deemed as if the check was presented on time. So the check will remain valid till the next working day. Okay. This was question number 47. Now come to question number 48. One more case-based MCQ, guys. Here I will straight away take you to the questions itself. Without even reading the story, I'll show you how. Just by looking at the questions itself, we can straight away answer the MCQs. So question number 48. The question says, among the assets acquired by EAEPL, which of the following would not be classified as immovable property? So what is not immovable property? See, warehouse is an immovable property. 30 acres of farmland is immovable property, but tractors are not immovable property. Plantation of 200 timber trees will be immovable property. The trees, till they are rooted to the soil, they will be immovable property, right? Only when the tree is cut and we take the timber, only timber is not immovable property. But tree rooted to the soil, it is immovable property. So what is not immovable property? 150 tractors. Then, if the requirement was to obtain regulatory clearance within 45 days from the date of establishment, which was 28 February 24 and 13th April 24 was a public holiday, by which date must the clearance be obtained? assuming 13th April is Saturday. So the question is saying we have to obtain regulatory clearance within 45 days from the date of establishment, which is 28 February 24. So 28 February 2024 plus 45 days. How will you calculate, guys? When you say within 45 days from the date of establishment, you will ignore the date of establishment. When we say from, you ignore the first day, right? And you start counting only next day onwards. So when I say 45 days from 28 February 24, I will ignore 28 February. I will start counting only next day onwards. Now if you see 2024, guys, so February will have 29 days. So one day I have in February, 31 days I will have in March. Total 45 days is what I am calculating. So in April month, how many days will I take in April month? I will take 13 days in April, guys. So 45 days will actually end on 13th April 2024. But the question says 13th April was a public holiday. So which means next day, 14th April 2024. But 13th April is a Saturday. So 14th April will be Sunday, which will again be a holiday. So the next working day will be 15th April 2024. So your correct answer will be option D. Alright. Then comes the third question. The government notification dated 15th March 24 was sent to EAPL via registered post on 18th March 24. Company returns it with an endorsement of refusal. See, if this is nothing but a service by post, so we learn in General Clauses Act that if a document has to be served by post, if it is properly addressed, postal charges are prepaid, and it is also sent by registered post. If all these three conditions are fulfilled, then it will be treated as if the post has been served, guys. So here if you see, it was sent by registered post, and let's assume it was properly addressed and it was prepaid. So in that case, it will be presumed that the notice has been served. Even though the company is returning the letter with endorsement of refusal, still, if all these three conditions are fulfilled, then it will be as if the post has been properly, duly served. Alright, so this was your question number 48. Now come to question number 49. Same, even 49 is relating to section 27 only. Under the statutory rules, a notice is required to be sent by registered post, acknowledgement due. If the notice is sent only by registered post, what is the legal implication? See, guys, we can apply section 27 only if the law is silent. If the law is silent and the law just says that you have to send the letter by post, then in that case, we say that send it by registered post, properly prepay, and address it properly. Alright, if you do these three things, it will be as if the post has been served. But however, if the law itself says that the post has to be by way of registered post, acknowledgement due, then you have to send the post by the specified mode only, by registered post, acknowledgement due only. Now if you send it by registered post, it will not be compliance of law, guys. So service of notice is deemed valid? No. Service of notice is not valid as the statutory rules specifically require registered post, acknowledgement due. So the post should have been sent by that mode only. Understanding? If the law itself specifies by what mode the post has to be sent, then follow that. Only if the law is silent, only then you will apply section 27. Okay, so this was a small question from your September 25 mock test paper. Now coming to the next question, question number 50 from your Jan 26 mock test paper. The Government of India, by an order dated 19th August 25, appointed a commission of inquiry to investigate alleged environmental violations in Maharashtra. Notification was published in the official gazette on 24th August 25, and the commission was required to submit report within 90 days from the date of notification. So when do they have to submit the report? The notification was published on 24th August 25. So 24th August 2025 plus 90 days, guys. By this time, the report has to be submitted by the commission. Alright. So how will you do this calculation? Now tell me. When we say within 90 days from the date of notification, I will ignore the date of notification. I will start counting only next day onwards. So in the month of August, one second. Yeah, in the month of August, I will ignore 24th. I'll start counting from 25. So 31 minus 24, I have 7 days in August. September, I have 30 days. October, I have 31 days. Totally, I'm trying to count 90 days. So in the month of November, how many days will I take? Month of November, 22 days. So your time limit for submitting the report will be 22nd November 2025, guys. Okay, simple computation of time. Then subsequently a dispute arose regarding the territorial jurisdiction of the commission. Notification stated that investigation would cover all environmental violations occurring within 10-kilometer radius of the Godavari River. Several industries challenged this, arguing that the 10-kilometer distance should be measured along road distance rather than in a straight line. Wrong, guys. What does the GC Act say? How do we measure distance? We measure distance on a straight line in a horizontal plane. Right, guys? So, not on the basis of roadways, not on the basis of waterways and all, in a straight line on a horizontal plane. Then, another issue arose regarding the service of notice to industries suspected of violation. Commission sent notice to registered post, and some industries contended that the notice had not been effectively served. No, guys, if you send by registered post, same again section 27. If you send by registered post, prepay the postal charges and properly address it, then it is as if it is properly served. Okay. Now come on, have a look at the next part of next para. The commission's tenure was to expire on 17th November 25. However, before that date, the central government issued an order extending the tenure until further notice. See, if you notice in the beginning part of the question, it is mentioned that the government of India, by an order dated 19th August 25, appointed a commission. So the government is having the power to appoint the commission. When an authority has the power to appoint a person or to appoint a commission, then the same authority can also extend the tenure. They can also rescind the tenure, which means they can cancel the tenure. So if you have the authority to appoint a person, you can also extend that person's tenure. You can also rescind that person's tenure. So the government of India had the authority to appoint the commission. They appointed the commission for a certain tenure, and now they are extending the tenure. Yes, this is going to be allowed because the same authority who is appointing the commission, that same authority only can extend and rescind the tenure also. It is permitted. Then a public interest litigation was filed in the Bombay High Court challenging the legality of this open-ended extension. Additionally, government appointed Mr. Arvind Rao as a chairman of the commission. Mr. Rao resigned on 25th September due to health reasons. Through an office memorandum dated 30th September, government appointed Ms. Kavita Mehta as his replacement, and she assumed charge on 5th October. Let's have a look at the question now. When does the period for submitting the report expire? We already counted the 90 days period, 22nd November. Then, how should the 10-kilometer distance be measured? Even this we spoke about it. Not on the basis of road and all. Straight line, horizontal plane. So option B, in a straight line on a horizontal plane. Last question, whether the government of India has the power to modify the tenure until further notice. Yes, guys, government of India only has the authority to appoint the commission. So government of India will also have the authority to extend the tenure of the commission. They will also have the authority to cancel or rescind the tenure of the commission. So do they have the power to extend the tenure? Yes, they do. So your answer is yes. It can't be no, no, no. So option A, yes, because the authority to appoint includes the authority to vary the terms of appointment, including extending the tenure. Okay, so nice question. This was from your GC Act recent mock test paper, guys, your Jan 26 mock test paper. Alright, so with this, I think we're good to close our GC Act as well. And now I'll take you to the last chapter. We'll take up our FEMA discussion, starting with question number 51. Now, we have 5 questions in our FEMA discussion. Out of these 5 questions, the first 2 will be descriptive questions and the remaining 3 will be case-based MCQs. Okay, so before I start the 51st question over here, I first have to give you one quick reminder of the provision which is involved in this question. Listen to me. See, 2 concepts are involved in this question. Concept number 1 is a definition of export. Export means taking out of India to a place outside India any goods or providing any services from India to any person outside India. Basically, export means there is an outflow. From India, goods are going to outside India, or from India, services are being provided outside India. Simple, guys. Simple definition of export. Export is nothing but taking from India, taking out of India to a place outside India, or providing services from India to outside India. Okay. Then listen to the second concept. We know about current account transactions. We know about the 3 schedules. The first schedule talks about prohibited transactions. Now, one of those prohibited transactions is payment of commission on exports made towards equity investment in joint venture or wholly owned subsidiary abroad of Indian company. I'll explain it to you. Imagine there's an Indian company, and this Indian company is exporting goods outside India. And from this export, of course, they're having export proceeds. Now, those export proceeds are repatriating, they're bringing it into India. So, tell me now, will we encourage this export? Yes, isn't it? Because of this export, there is foreign exchange coming into India. So, we will encourage this export. Now, in relation to this export, even if we have to pay any agent commission, and for this agent commission, even if we require drawal of foreign exchange, we will permit, because net, if you see, we are having huge amount of foreign exchange flowing into India. Now, in relation to this, even if we have to make a small payment of foreign exchange to agent for agent commission, it will be permitted. Okay. But however, if the Indian company is exporting goods outside India, but the export proceeds are not being brought back to India, those export proceeds are being invested in equity of some joint venture or some wholly owned subsidiary of an Indian company abroad. Like for example, Indian company is exporting goods to US. Now those dollars have to be brought to India, no? Instead of bringing the dollars to India, the export proceeds are being invested in some wholly owned subsidiary of an Indian company in US itself. So which means the export proceeds got converted into equity investment outside India. The export proceeds did not even come to India. So that there is no inflow of foreign exchange over here now. Now in relation to this export, if you say that you want to pay agent commission in foreign exchange, we will not allow. Because tell me, see in the first example, if you notice, there was an inflow of foreign exchange. So because there's an inflow of foreign exchange, now if you want to make an outflow of foreign exchange to pay agent commission, we were allowing. But in my second example, there is no inflow of foreign exchange, guys, because the export proceeds are being invested in equity outside India itself. So when there is no inflow of foreign exchange, if you say that you want an outflow of foreign exchange to pay agent commission in dollars, we will not allow. That's all, guys. So come on now, have a look at the question. The question says Heavy Loaders Limited is a public company incorporated in India. So Heavy Loaders Limited becomes an Indian company. Then what happened? It is engaged in the manufacture of loader vehicles used for commercial construction purposes. It is planning to expand its business outside India. It has come in contact with Mr. Fred, an American citizen working as an agent of companies planning to secure business in US. Mr. Fred has informed the directors of Heavy Loaders Limited that another Indian company engaged in commercial construction business has a requirement of 25 loader vehicles for its wholly owned American subsidiary company. So understanding what has happened, my company is an Indian company, Heavy Loaders Limited. It wants to expand business in US. So there's another person that's entering into the story, Mr. Fred. He's an American citizen and he's an agent. And this Mr. Fred is telling Heavy Loaders Limited that there is one more Indian company, that one more Indian company has a wholly owned American subsidiary. That wholly owned American subsidiary requires 25 loader vehicles. Okay, so Heavy Loaders Limited supplied the required loader vehicles with an invoice value of $350,000 in exchange of allotment of equity capital of the same worth in the American company. Gone, guys. What has happened? So we have this company, Heavy Loaders Limited. This Heavy Loaders Limited, and there's one more company, an American company. This American company is a wholly owned subsidiary of an Indian company. Okay. Now Heavy Loaders Limited has exported vehicles, guys. It has exported 25 vehicles to the American company for how much? For $350,000. Okay. Now American company will give $350,000 to Heavy Loaders Limited, but instead of taking the consideration in money, the export proceeds of $350,000 are not being repatriated to India, guys. Instead, the export proceeds of $350,000 are being reinvested as equity in the same American company. So don't you think over here the exact second situation has applied? The Indian company Heavy Loaders Limited has exported vehicles outside India. The export proceeds are not being repatriated to India. Instead, the export proceeds are being invested in equity of another wholly owned subsidiary of an Indian company in the US. So now tell me, if Mr. Fred, the agent, asks any commission, for that commission, will drawal of foreign exchange be permitted? It will not be permitted. So look at this now. Mr. Fred asked for export commission of 15% of the invoice value of goods supplied from Heavy Loaders Limited, to which Heavy Loaders Limited has refused the payment on the ground that maximum commission that can be paid is 10%. Forget about 10%, forget about 15%. Any drawal of foreign exchange to pay commission to Mr. Fred is going to be a prohibited current account transaction. Drawal of foreign exchange to pay commission to Mr. Fred will not be permitted under Schedule 1. You're getting the point, right? See, if the export proceeds of $350,000, if they were repatriated to India, then we will allow the payment of commission to Mr. Fred in foreign exchange. But the export proceeds are not repatriated to India over here. Instead, the export proceeds are staying in US only. They're getting invested in a US company. So therefore, there is no inflow of foreign exchange. So outflow of foreign exchange in the form of commission will become a prohibited transaction. Now, considering the provisions of Foreign Exchange Management Act decide whether the above transaction of supplying machines in exchange of equity, can it be considered as export? Of course it can be considered as export, because see, export means what? Taking out of India to a place outside India any goods, or providing services from India to a person outside India. This has happened over here, guys. In this question, we have supplied vehicles from India to US. There is an export. In the export definition, is it written anywhere that the export proceeds should not be invested in equity outside India? Nothing of that sort. So even though we have not repatriated the proceeds back to India, still it will be considered as export because it is clearly fitting in this definition. Then, whether the rate of export agent commission demanded by Mr. Fred be paid or confined to only 10%. Here your answer will be, it's a prohibited transaction. 15%, 10%, nothing will be allowed. Any drawal of foreign exchange to pay commission to Mr. Fred will be a prohibited current account transaction under Schedule 1. Okay, so this was your question number 51 from your September 25 examination. Come on everybody, let's move on to the next question now. Question number 52. Don't slow down at this point. We're almost nearing the end. We've done an amazing kind of learning, guys. Listen to me carefully. One small simple question now. See, if a non-individual, like for example a company, if a company wants to make a remittance for consultancy services procured from outside India relating to infrastructure project, if it is more than $10 million per project, RBI approval will be required. So, it's a current account transaction. Schedule 3 current account transaction, guys. This is for non-individuals. So, if a non-individual requires foreign exchange, if a non-individual wants to make payment of foreign exchange for consultancy services relating to infrastructure project, if it is within $10 million, then no need of RBI approval. If it is more than $10 million, then RBI approval is required. If the same non-individual wants to remit foreign exchange for consultancy services but not relating to infrastructure, other consultancy services, then in that case, if the amount is more than $1 million, then only RBI approval will be required. Okay, that is what this question is all about. The question says, Star Tech Private Limited, an Indian company, is planning to remit $12 million to a consultancy firm based in Germany for advisory services related to a new highway infrastructure project in India. $12 million, guys. An Indian company wants to pay a non-individual. It is relating to consultancy services. It is relating to infrastructure. $12 million, it is more than $10 million. So therefore, guys, RBI approval will be required for the first transaction. Then, company also engaged another foreign consultancy for a software upgrade on a different project and wants to remit $900,000 for that service. So, there's one more transaction. Even this is going to be a consultancy service, but this is not relating to infrastructure. This is relating to software upgrade. So, any other project. So, here the limit is $1 million. But however, here we want to remit only $900,000, guys, which is within $1 million. So therefore, for the second transaction, RBI approval will not be required. Understanding? If for infrastructure project, if you want to remit more than $10 million, only then RBI approval will be required. For other projects, if you want to remit more than $1 million, only then RBI approval will be required. Here, for infrastructure, we are emitting $12 million, which is more than $10 million. So, RBI approval is required. But for the software upgrade, we are emitting only $900,000, which is not more than $1 million, and therefore RBI approval is not required. Okay, so these were your two questions, two descriptive questions. Now we have three nice case-based MCQs from FEMA. Let's take them up one by one. So the question says, Mr. David, an Indian doctor residing in Panjim, Goa, was married to Miss Ruby, another resident in the same profession. So Mr. David married Miss Ruby. The couple had three children by the name of Christopher, Sebastian and Aliana. Ruby left India in 2020 with her daughter Aliana and son Sebastian to the US to pursue her master degree in the field of medicine, leaving behind Mr. David in India along with Christopher. So in this family, guys, there are totally how many people? There are totally 5 people. We have the father, Mr. David. We have the mother. Oh wait, let me do the writing over here. I'll have more space. We have the father, Mr. David. We have the mother, Miss Ruby. And we have 3 children, Christopher, Sebastian and Aliana. The question says that David and Christopher stayed in India, but Ruby, Sebastian and Aliana left India. They went to the US. Now Ruby is leaving India for the purpose of education, guys. For the purpose of education in US, he wants to pursue her master degree. We know as per the RBI circular, if a person leaves India for the purpose of education, that person becomes PROI. Then Sebastian and Aliana, they are also leaving India, and they are leaving India for what purpose? They are just accompanying their mother, and this would become a case where they're leaving India for an uncertain period with no intentions of when to return. So even both of them will also become PROI. Okay. Then what happened? In 2021, Sebastian, one of the PROIs, so he's a PROI, and he has purchased a piece of land in Chicago as an investment. So PROI has purchased a land in Chicago outside India. No restrictions, guys. You're a PROI. Do whatever you want to do. Meanwhile, Christopher is still in India only. He had incorporated a public company in India engaged in medical research and manufacture of life-saving drugs with head office in Goa, and this company has earned foreign exchange worth $12 million, $12.5 million in the past 3 years, and was also planning to extend business by collaborating with an American company engaged in the same field. So understood till here? David and Christopher are still in India only. Christopher has started one company relating to medicines, and this company has made foreign exchange. His company has earned foreign exchange of $12.5 in the past 3 years, and Christopher wants to expand this company. And remember that Ruby, Sebastian and Aliana, they are all PROIs. Then what happened? He called Sebastian to India on 31st May 23 to help him in his business venture after being inducted as a director in the company. So Christopher is asking Sebastian to come back to India. Now why is Sebastian coming back to India? He's coming back to India for those 3 purposes, guys. For his employment in India, or for the purpose of business or vacation in India. So it doesn't matter how many days he has stayed in India, he will immediately become a PRI now. So earlier he was a PROI when he left India. Now when he comes to India, he becomes a PRI. Till here, crystal clear? Okay. Then what happened? The American company. Which American company? Remember, guys, Christopher started one company in India, right? Relating to medicines. He wanted to expand that company. For that expansion only, he called Sebastian also. Now, Christopher wants to do this expansion by collaborating with some American company. Now, that American company has offered to purchase the land owned by Sebastian in Chicago, wherein the production facility can be set up. Understanding, nice interlinking is happening over here. Sebastian, when he was a PROI, that time he purchased one land in US. Now an American company wants to buy this land from Sebastian. See, today Sebastian is PRI. When he's a PRI today, the American company wants to buy from him this land in Chicago. Can he sell away this land, guys? See, I'll remind you about the provision. Today you are a PRI, fine, but you have some immovable property outside India which you had acquired when you were a PROI. Such immovable property you are free to HOTI. Remember, you are free to hold, you are free to own, you are free to transfer, and you are free to invest. Right? So today you are a PRI, but you have some immovable property outside India which you had acquired when you were a PROI. This immovable property you can hold, own, transfer or invest, no problem. So now this American company wants to buy this land from Sebastian. Can Sebastian transfer the land? Yes, he can transfer the land, no problem, because this land was acquired by him when he was a PROI. So he can freely transfer, no problem. Then what happened? Mr. John The CEO of the American company, acting on advice of Mr. Christopher, has shown interest to invest $150,000 in Bioseeds Limited, an Indian company engaged in the plantation and harvest of medicinal plants and herbs in the hills of Kangra in Himachal Pradesh. See, Mr. John is PROI. Now, can a PROI invest in an Indian company involved in agriculture or plantation? No, guys, it is a prohibited capital account transaction, right? A PROI cannot invest in an Indian company which is involved in agriculture or plantation activities. So, Mr. John, sorry, you can't invest in this company in Bioseeds Limited. Then what happened? Mr. John suggested that the company owned by Christopher should donate an amount towards sponsoring annual salary of a professor at the Chicago Institute of Medical Sciences to gain popularity and fame amongst the medical fraternity in Chicago, thereby creating a chair in medicine. See, if you have to make any donation to create a chair and all, there's a limit. The limit is, it's a current account transaction, guys. We have a limit. The limit is 1% of the foreign exchange earnings of the company of the three preceding financial years, or $5 million, whichever is lesser. So if the company wants to make a donation which is within this limit, RBI approval is not required. If the company wants to make a donation more than this limit, then RBI approval will be required, guys. So what is the foreign exchange earnings of the three preceding financial years of the company? Foreign exchange earnings in three preceding financial years is 12.5 million. So 12.5 million into 1% would be 1,25,000. So 1,25,000 or 1,25,000 or $5 million, whichever is lesser. Obviously $125,000 is lesser. So if the donation is going to be for more than $125,000, then yes, RBI approval will be required. Okay. So giving you a quick recap of what has happened over here, there's a family with 5 people. Now the father and one of the sons has stayed in India, but the mother and 2 children have gone to the US. And the mother and the 2 children who went to the US became PROI. After becoming PROI, one of the children, Sebastian, purchased one land outside India. Meanwhile, in India, one of the children, Christopher, he started with one company relating to making medicines and all. He wanted to expand, so he wanted to collaborate with an American company. He called Sebastian back to India. So Sebastian has now become PRI. Now that American company wants to buy the Chicago land which Sebastian had purchased in US when he was a PROI. Yes, today you are a PRI, but you have an immovable property which you had acquired when you were a PROI. So you are allowed to transfer it, no problem. Then after that, what happened is the foreign company, the American company, wanted to invest in Bioseeds Limited, an Indian company which is involved in plantation activities. This is not allowed. PROI cannot invest in Indian company involved in agriculture or plantation activities. Then after this, the Indian company, Christopher's Indian company, wanted to donate money to Chicago Institute of Medical Sciences to create a chair in medicine. Now, if you want to make a donation to create chair and all, if it is more than this limit, then only RBI approval is required. We calculated the limit. The limit is $125,000. So, if the company is going to donate more than $125,000, then RBI approval will be required. Okay, till here all clear. Then what happened? Meanwhile, Mr. David, now being aged, Mr. David, guys, father, he has been suffering with a life-threatening disease himself, and he has urged his wife residing in Chicago, US, to search a suitable hospital where he can be treated for his ailments and get cured. Mrs. Ruby, being a doctor herself, suggested the name of a Pennsylvania Institute of Research and Medicine. She consulted the specialized doctors in the institute who are of the view that the cure of the disease of Mr. David is possible, but the patient must spend minimum 6 months. So basically the crux of the story is that Mr. David is sick and he needs treatment in the US. The institute has given estimate of expense of $269,000 for the treatment of the and the said estimate has been provided on the letterhead of the hospital. LRS concept, guys. Mr. David is PRI. For PRI, LRS will apply. Medical expenses is a current account transaction, a permitted current account transaction. Even though it is more than the limit, it is as per the estimate. So therefore, RBI approval and all is not required. Then cost of emigration certified by the authorities for Mr. David is $15,000. So for all this, RBI approval will not be required because you know, right, for medical expenses, then for immigration expenses, then for studies abroad. Even if you want foreign exchange more than $250,000, still RBI approval will not be required if it is as per the estimates given. So yes, all of these transactions, if you see, there is a medical treatment expense of $269,000, immigration expense of $15,000. Total put together, if you see, we are crossing $250,000, but it is as per the estimates given. Therefore, no RBI approval will be required. Okay, and so he requested the hospital to reduce his treatment expenses to $200,000, but the same has been refused by the institute. Mrs. Ruby decided to help her husband and is willing to sell a property owned by her in Panjim, Goa, which was earlier bought while she was in India along with Mr. David. So Mrs. Ruby wants to sell a property in Panjim. Mrs. Ruby is right now a PROI, but guys, she has a land in India. She has a land in Goa, which she had bought when she was in India. So she's a PROI today, but she has an immovable property in India, which she had purchased when she was a PRI. Same concept, guys. Even though today you're a PROI, you have an immovable property in India which you had acquired earlier when you were a PRI. That property you can hold, own, transfer, invest, no problem. So Mrs. Ruby will be allowed to transfer this Goa property, not an issue. Now look at the question. Whether Mr. Sebastian as well as his mother Ruby can be allowed to transfer the properties? Yes. For Mr. Sebastian also we applied the same concept. For Ruby also the same concept. For Sebastian, he's a PRI today. He has an immovable property outside India which he had purchased when he was a PROI. He is free to hold, own, transfer and invest it. Similarly, Ruby, today she is PROI, but earlier when she was a PRI, she purchased an immovable property in India. So that she can freely hold, own, transfer, invest, no problem. So both of them are allowed to do the transfer. So Mr. Sebastian would be allowed to sell his property, but Mrs. Ruby would not be allowed. Wrong. Mr. Sebastian and Mrs. Ruby must apply to RBI. No RBI approval required. Mr. Sebastian and Mrs. Ruby can sell the properties to each other and not to third parties. No such rule. Both Mr. Sebastian and Mrs. Ruby can freely sell their respective properties to the buyers of their choice without any intervention or approval of RBI. Option D. Okay. Then comes the second question. Decide whether both Mr. John and Mr. Christopher can act on the advice of each other for an investment of $150,000 in Bioseeds Limited as well as donating 1 year salary to medical chair. See, we learned that this investment of $150,000 in Bioseeds Limited, this is a prohibited capital account transaction. Remember, Mr. John is a PROI. PROI cannot invest in an Indian company in agriculture or plantation activities. So investing $150,000 in Bioseeds Limited is prohibited, and donating 1 year salary, if it is more than $125,000, the limit we calculated, then RBI approval will be required. So if you see option D, guys, Mr. John would not be able to invest $150,000 in Bioseeds Limited, prohibited capital account transaction, although Mr. Christopher can donate 1 year salary to the medical chair after getting RBI approval. Option D. So the investment in the plantation company is prohibited for PROI. Then making a donation to create a chair in a foreign institute is allowed, provided it is within the limit. We calculated the limit, it was $125,000. So if you're donating more than the limit, then RBI approval will be required. So option D. Then comes the third question, whether it is possible to pay Pennsylvania Institute of Research and Medical Science and the immigration authorities the respective amounts of money for the purpose of medical treatment. Here also we applied the LRS concept. We discussed that even though the total amount is more than $250,000, but it is as per the estimates. So therefore no approvals will be required. Freely it can be remitted. So Pennsylvania Institute of Research and Medical can be paid $269,000 against a certificate to be issued under the seal that the medical procedure would require the above amount. Basically, we can pay this much amount provided we have a proper certificate. Immigration expenses can be paid under LRS. Yes, guys. Then option B says Pennsylvania Institute cannot be paid $269,000 under any circumstance. Wrong. There is no limit towards payment of medical expenses. The Pennsylvania Institute can be paid $269,000 without any certificate. Wrong. No payment can be allowed. Wrong. Option A. We can make payment to the hospital. Even though it is more than $250,000, we can pay without RBI approval provided we have a proper certificate. Emigration expense, if you see, it's only $15,000. It is within $250,000. Hence, of course, it will be freely permitted under LRS itself. Okay, so this was a nice, interesting question. What were our learnings over here? One is the Section 6 discussion of PRI. Today you're a PRI, but earlier you were a PROI. That time you acquired immovable property outside India. That property now you can hold, own, transfer, invest, no problem. So that concept got tested twice. Then even the donation concept got revised over here for us. LRS also got revised a little bit, and even that concept with respect to donation, creating a chair, even the limit got revised for us. 1% of the foreign exchange earnings of the last 3 years, or $5 million, whichever is lesser. If the donation is more than this limit, then RBI approval will be required. Okay, so this was question number 53. Now come to question number 54, guys. Question number 54, we'll have to read the whole question over here. The question says, Mrinal Kaur, an Indian citizen and an acclaimed fashion entrepreneur based in Milan, has built a successful career over the past 10 years. In Jan 24, she decided to extend her brand's presence to India by incorporating a company named Style Aura Private Limited. Okay, so right now she is based in Milan, she is based outside India, but now she wants to come back to India, so she is creating a company in India. Her comprehensive business plan includes establishing a flagship design studio in Delhi, importing premium fabrics and embellishments from Italy, launching a digital retail platform for luxury fashion, and forming strategic partnership with renowned European fashion houses. So all these are her plans. In Feb 24, Style Aura Private Limited, basically the Indian company which she created, undertook the following initial transactions. Received 500,000 euros from Mrinal's Milan-based business account, acquired commercial property in Delhi to set up the studio, engaged fashion experts, and opened a foreign currency account with the Delhi branch of an international bank. Company also aims to showcase its designs at global fashion events and accept advance payments from international clients. Now, what are they asking us? What would be Mrinal Kaur's residential status under FEMA if she relocates to Delhi? See, if she relocates to Delhi, she's relocating for the purpose of a business, guys. 3 purposes. So I don't care about the 182 days criteria. If she's relocating, if she's coming to India for the purpose of business, vacation, employment and all, then in that case, immediately she will become a PRI. So she immediately becomes person resident in India. Then, SAPL's receipt of advance payments from foreign buyers. If you receive advance payment from foreign buyers, this would be a current account transaction permitted freely. Then comes the next question. Style Aura intends to remit $1.2 million to consultants. Non-individual, we just learned some time back, remember, non-individual making remittance for consultancy services. If it is for infrastructure project, the limit is $10 million. Others, limit is $1 million. So here this is not for infrastructure. This is relating to design services. You are making payment to a consultant. So consultancy services, limit will be $1 million. So we're remitting more than $1 million. Prior approval of RBI will be required. Okay, this was a simple question. Question 54. Now coming to one final question. Question 55. Now have a look at this. Straight away come to the questions. The question says Arnav requires $55,000 per year tuition plus living expenses. Can he obtain this foreign exchange? LRS, guys, it is clearly within $250,000. So therefore no RBI approval and all will be required. So yes, up to $55,000 per academic year without RBI approval. He can obtain full $55,000 he can obtain. No RBI approval will be required. Then Mr. Rajesh Mehta won a local lottery. He wants to remit a part of the winnings to Arnav in Switzerland. Guys, current account transaction, schedule 1, prohibited current account transaction. You cannot draw foreign exchange and remit money out of lottery winnings. Right, guys? So he won a lottery. He wants to remit a part of the winnings to Arnav in Switzerland. Not allowed. So the authorized dealer will allow the remittance? No. Authorized dealer will allow the remittance freely since it is below $50,000? No, it's a prohibited current account transaction. So AD will allow the remittance? Again, no. AD, the authorized dealer, will reject the request because lottery winnings cannot be remitted under any circumstance as it falls under prohibited current account transaction. Yes, option D. Then comes the last question here. If Mr. Raghav submits medical estimate from the US hospital showing expense of $4 lakh, what can the authorized dealer do? See guys, medical estimate we are having. more than $250,000, it is more than $250,000, but still, because we have a medical estimate, RBI approval and all will not be required. Under LRS itself, we can freely remit. So option A, release only $250,000. No. Then option B says release any amount without limit because it is a medical emergency. That is not right. I mean, just because it is a medical emergency doesn't mean you can release any amount. See, if we have a medical estimate, then we can release any amount. So option A, B, both are wrong. Option C says authorized dealer can release up to $250,000 without approval and release additional amount if supported by medical estimate from the doctor or hospital without referring to RBI. Yes, option C. Up to $250,000, whether medical estimate is there or not doesn't matter, we can freely remit. Beyond $250,000 also we can remit provided we have medical estimate. So option C. Okay, so that is it, guys. This is it with the 55 new questions that I wanted to discuss with you with respect to your law examination for Jan 2026 exams. Now, with these 55 questions, we have covered each and every new question in your September 25 mock test paper 1, September 25 mock test paper 2, your September 2025 question paper, your Jan 26 mock test paper 1 and 2, and your Jan 26 RTP. I think the biggest value add for you through this entire discussion would have been the September 2025 question paper questions that we were able to discuss in the course of these 55 questions. Right, guys, I think each and every question of the September 25 question paper we have discussed. So that is it, guys. With this, we are done with this session that I wanted to do for you, covering all the new questions in law which are relevant for your Jan 26 exams. With this, I think it's like the cherry on the top of your law preparation, your entire revision that you've already done. And with that revision, these special extra questions, with this, you are now exam ready. So go and rock the exams now. I really hope through all these discussions, I hope you found some new points. I hope you found some new perspective relating to some questions. I hope it was like a nice value add for you, all these new questions that we did. So yes, it was of course not like a typical exam marathon where we do concepts only. Instead, what I did is I divided all the questions into chapters first so that you can first finish your concept revision of the respective chapter, then come to this video and finish the questions of that particular chapter. With that, you can be really confident that yes, you have actually completed the chapter from end to end. Then go to the next chapter, do your concept revision, then come to this video, and in this video take up the questions that we have discussed in that particular chapter. So that's it, guys. I really hope all this hard work was worth it. I'm not sure about you, but right now I'm feeling really content with the amount of revision that I was able to give you through these questions, because actually if you see, we did not just discuss the questions, so many concepts which were involved in these questions, we discussed so many concepts as well, right, guys? So through this, like the highlighted adjustments, the most important adjustments, the most important concepts are now revised for you. So now with a lot of confidence, go and ace your exams. Thank you, guys. Bye bye.